Hey, it's Mike, and I just want to thank you for picking up the Orderflows Absorption course. Now, I'm creating this quick video just sort of get you started on the Absorption course. Now, Absorption is one of the most important concepts of trading with order flow, yet not many fully understand what it is and how to look for it. That's why I created this course, because I want you to be able to capitalize on absorption when it occurs by recognizing the absorption so you can determine if a trend is beginning, ending, or pausing. Now, in this course, all the videos can be watched online as well as downloaded to your computer, tablet, or smartphone. All the modules also have the accompanying PDF slide deck so that you can print out and write your own notes on. The course is broken down into 7 modules. Module 1, what is absorption and why it matters. Module 2, understanding the players. Module 3, recognizing absorption. Module 4, accumulation and distribution. Module 5, reversals and continuation. Module 6, absorption trade setups. Module 7, putting it all together. Now, I suggest you start at Module 1 and work your way through before you get to the trade setups. It'll just put everything in better context for you, but of course you're free to jump around however you see fit. For consistency of this course, I use the following. I use 5-minute charts in the major futures markets, E-minis, crude oil, euro currency, bunds. Sometimes I do throw in a chart in, like, say, wheat or gold, but again, that's just to drive home a point I'm trying to make. And I use mainly the volume bid-ask footprint chart. I do switch to linear delta charts, which is the delta at a price level, not the diagonal delta. And even sometimes I use the actual volume footprint chart, which is actually the volume, total volume traded at price. And again, the reason I do that is to make points more clear. Sometimes it's a little bit easier to see it on a slightly different chart. So to get started, what you're going to do is you're going to go to the sign-in page. Just copy and paste it from your email is easiest. It's absorption course.site.invanto.com/login. It's kind of a long one to type in. Enter your email address and password. That's your username and password that has been sent to you. Your username is generally your PayPal email address, but for some of you it's slightly different. Now you're going to come home to this welcome page. Welcome to Orderflows Absorption course. Now, what you're going to do is you click on this button here, Absorption course, or you click here that says View All, either one. And it's going to take you to the actual contents of the course. Getting started, that's just basically this video. But the different modules are here, 1, 2, 3, 4, 5. You don't click on here where it says module. What you do is you click where it says View Now. Or alternatively, you could click on this menu on the side here. But I think it's best to start here at the table of contents. Click View Now, right? Not where it says Module 1, what is absorption. You click View Now for Module 1, and it takes you to the course contents. And what you have here, you have the video. You could watch it here. Click play. If you want to expand it, you click these little 4 arrows pointing out. That will expand it, as you can see there. If you want to download it, you click here, download. This is the download link. And this is the PDF, the accompanying PDF. If you want to download that, you can click there and download it. On my computer here, this is the button to download. It opens up in a new window. If you want to go to the next module, you click next. That will show that you've completed that module. So, for example, click next, module 2. Again, you can also navigate through this side menu here. Again, the video, you can expand it here, you can download it here, and the PDF is here. Now, if for any reason you get lost, you click this button here, membership. It takes you back to the beginning. You shouldn't get lost. This is not a very complex website, and it takes you back here. Now to log off, you just click log out here. But again, anytime you're lost, just click absorption course, it takes here. Click view details, it takes you back to the beginning. So that's all. Basically, let's get started, and I'll see you on Module 1. So bye-bye. Hey everyone, it's Mike, and welcome to the Orderflows Absorption course, Module 1. What is absorption? Now, before I get started, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Passive performance is not necessarily indicative of future results. All right, so what is absorption and why it matters? Well, the easiest way to think of it is think of a sponge. what does a sponge do? Right? It absorbs and holds water until it releases it back. And big traders act in the same way. They absorb all the supply in the market, often at low prices, and then release it at higher prices, just as the way the sponge acts. And even though absorption is easy to learn, it does take time to learn and become familiar with it, enough so that you can apply it to the market. Now, the learning curve and process will vary from one trader to another. However, with the right education, it's just as easy for a beginner to learn as it is for an experienced trader. Now, the first step in understanding absorption is understanding the importance of volume in order flow. Now, volume is a raw form of market-generated information that doesn't need much explanation. It's simply the number of contracts traded. Now, within volume, you have bid volume, you have ask volume. From the bid volume and the ask volume, also known as offer volume, delta is derived. Within delta, you have max delta and min delta. And it's through volume, delta, max delta, min delta that a trader can really understand absorption in the market. Now, this is just, your normal footprint chart, right? To really understand absorption, you got to be looking at a footprint chart. If you're looking at a normal bar chart, you're not going to know when absorption is occurring, because how can you tell, right? You're not looking at volume. You don't know if a price level traded 50 contracts or traded 5,000. I mean, it's just impossible to tell that on a normal bar chart. But on a volume footprint chart, right, you have delta, you have max delta, you have min delta, you have volume. You can see the volumes traded at a price, and that's important information to a trader. I bang my head against the wall sometimes. I don't understand why people are so resistant to looking at a chart with more information on it. Now, it's not a chart full of different indicators. It's just the information that's market generated. What traded at a price, what traded on the bid at that price, what traded on an offer at that price, and you can see how the auction process developed. Now, in technical analysis, volume 101, right? The basic belief is when price moves up with higher volume, that's bullish. When price moves down with higher volume, that is bearish. When price moves up on decreasing volume, that is bearish. And when price moves down on declining volume, I left out the word volume, that is bullish. Okay, I mean, that's just basic stuff, right? I mean, hopefully everybody already understands that concept. But you can see here, right? Making new highs, boom. Big volume. This is crude oil. This is a 5-minute chart, and you're getting about 1,000 contracts every 5-minute period. Then boom, 9,000 contracts traded, new high. And then you're seeing, as you're making these new highs, higher volume than what you were looking at earlier. You're looking at 3,000, 1,600, 2,300, 2,900, 2,400, versus before you're looking at half of that. 1,500, 1,500. Now, it doesn't mean that, we make a new high, we got 9,000, the next bar, new high should be 10,000 contracts and 11,000. It's still increasing volume, much relative to what it was previously. If you're looking at, a daily chart, right? If you go back to the old books on trading with volume, written in the 50s and 60s, the daily charts will show each bar having increasing volume. But, this one bar, right, this doesn't mean this sets the new level, that 9,000, that for it to be increasing, it has to go to 10,000, 11,000. You've already got the jump, and you've sort of jumped to a newer level in here as you're going up. Can it be nice? Yeah, it'd be nice if every bar had massively increasing volume. This one was just a lot. But then you're 3,000, 2,000, 2,900, 2,400, 2,800. It's still increased over what it was previously. Now, volume is what differentiates prices, right? The key difference between a market exhibiting absorption and a market exhibiting consolidation is volume. With absorption, volume will be stronger than normal. And when I say normal, I mean what it was preceding the area that you're in, right? If you're looking at, like for example, right? All the charts I use in this course are 5-minute charts, and the reason is I wanted to keep it constant throughout the course, so you can see it on one set of charts on a certain time period, rather than, here it is on a 4-range chart, then here it is on an 8-range chart, and a 30-second chart, a 1-minute chart, 5-minute chart, and just jumping around. I think it might confuse people a little bit. Now, when I get to the last part of wrapping it up, I delve into different types of charts, 4-range, 8-range, 1-minute, 5-minute, etc. So you can see how it looks on different types of charts. But for the main instruction courses, it's on 5-minute charts. And when I say, again, stronger than normal, okay, what it was previously, right? Now, you can, honestly, I don't think it's worth the work as a retail trader to go back historically and say, yeah, between 5 and 5:30, your average volume for the last 30 days is 1,200 contracts, okay? And then compare that. That would be your normal, but in trading on the fly, you're not going to really do that. It's just as easy to go back and compare what it was earlier, rather than set a benchmark for the last 30 days and do the research. You can. It's a lot of work. And maybe some of you that are technically inclined could write some program to do that. That'd be great, I think, because I know that when I worked at JP Morgan, that's how we would create the VWAP algos. Is we would look at a time period and take a snapshot of that each day, going back a certain amount of days, so that we know what we should be executing at that time. But for most people, you don't have those resources. Now, consolidation is generally average to less than average. And a perfect example is you're going to see consolidation before a major announcement or a number. Like, you're going to see the market consolidating, going sideways, doing less volume than normal, like before a Fed announcement, like the hour before a Fed announcement, or a few hours leading up to the non-farm payroll numbers. That's consolidation. That I would not consider that absorption, right? Because generally you're going to have less trading because people are waiting. They're waiting to see what the number is going to come out, and that's not going to be absorption. You're not going to see the heavy volume at that time. People aren't going to really take a position right before a big announcement. So the reason a lot of traders fail is because they use price-based indicators because they think that the indicator will allow them to analyze the market objectively, right? They're like, well, I'm going to put this moving average. I don't have to make a decision. All I got to do, the only decision I have to make is, do I buy it when it crosses the line or not, right? They think that it removes some of the objectivity out of the market, but what actually they're doing is they're going backwards, right? They're looking at the effect on the market and not the cause. And to figure out and understand the cause of the move, you have to think, and when you think, you become subjective and not objective, right? It's, honestly, it's one of those things where, people really want computers to do everything for them. And, as a trader, I find the best traders are the ones that are able to take things in context, right? Yeah, sure, they're using a tool, an indicator to tell them something's happening in the market, but at the end of the day, they're the ones that put it in context to what's happening overall in the market. And by looking at the cause of the move, you can predict the possible effect it will have on the market and price. And for example, like this, right? Indicator madness. That's what I call it, indicator madness. What I got 4 indicators on here, right? I've seen people with 10 indicators on there for some reason. Maybe they rank them. Oh, I got 10 indicators. If 9 are bullish, I gotta get bullish. Well, what's going to happen is that one that tells you not to take that trade is the one that was right. But perfect example is, if you're looking at these indicators, like, oh my gosh, we're in overbought territory here, yet market still went up, right? And everyone's saying, oh, you got to sell it here. You got to sell. We crossed this line. We crossed this line. You got to be getting short. And they're so far behind on the curve. Look at this high. People say, well, we're overbought, but this market's still got another 50-cent move in it till he gets up here and it starts to come off. By time it starts to come off, we come off, from 70 down to 40. Now they're convinced, but you already had that move. If you're looking at the order flow, there's signs in the order flow that are telling you, you should be getting short. There's not much signs in here on this move up really telling you to get short, right? So if you're following an indicator, it's telling you, hey, you got shorted here. We crossed this line. we cross this line, we're in oversold territory or something, or overbought territory. It's just rubbish. And even, in the footprint charts, there's different types of charts you could look at. You have the delta footprint. I find myself looking more and more at a delta footprint because I just find it more information that is available to me, that I want to use it. There's nothing wrong with looking at both a volume footprint and a delta footprint, side by side next to each other. You're not comparing one against the other, but maybe sometimes you might see something on one chart that you're not seeing on another chart. Now it's not a different indicator in the sense that, well, I got RSI, MACD, stochastics, moving average. It's information. It's market generated information, and that you can make a decision from. And when you get up to this first high here with this red bar, right? What are you looking at? Well, okay, let me see. Well, delta is still positive. Okay, is that a bearish sign? No, it's not a bearish sign at all. It's still relatively bullish. I know it's telling me that, hey, you know what? There's still some buying pressure in here. This market might go higher. When we finally get up to the high, what do I got? I got negative delta. Next bar, stronger negative delta. And even if I analyze the delta in the bar, I can see what was traded on the offer, what was traded on the bid. And what does it look like? Right? Well, it looks like someone came in and is hitting all these bids here. Is that bullish or is that bearish? Well, that's bearish, right? You got the delta confirming it, obviously. And more importantly, you start taking in context with what's happening. I get into this in the trade setups on what this bar looks like. This bar looks like, this is what I call euphoria. Everyone is just tripping over themselves to get into the market, lifting all the offers here, lifting all the offers here, lifting all the offers here. I mean, there's counter trade, 10, 130, 18, 8, 84. But it's mostly everyone just coming in. Oh, we're making new highs. I gotta get it long. My indicator, my 90% winning indicator says get long. So everyone's coming in here and getting long. Well, at some point, everybody's long. Well, what's going to happen is the sellers are going to come in. You got these high prices. Sellers now are attracted to these high prices, and they just come in and boom, just whack everything, whack everything. So that's why it's important to have, a footprint chart, whether a delta footprint chart or a volume footprint chart, so you can see how things are, how trade is acting, right? If you're looking at this volume footprint chart, you're high, you're seeing selling imbalances, right? If you're looking for the market to go higher, you should be seeing buying imbalances, not selling imbalances. So, when traders rely solely on price, they cannot have a complete understanding of market context. Price versus price analysis has very little meaning in the overall context of the market. Not every traded price is equal to another traded price. And if every trader viewed price the same, the markets would just trade one price. Traders mistakenly use price and value interchangeably, right? They're not the same. Price is what you have to pay for something, right? Value is what the item is actually worth. You can buy something below its actual value and get a deal, or you can pay more than something's worth, right? You go to the store, right? There's a price on everything in the store. You buy something based on what you think the value is, right? If you go into the store to buy your milk, and it's, well, I'll say milk because that's something that's required. But you go in to buy your potato chips, and you're like thinking, wow, a bag of potato chips is $4. That seems a bit expensive. I don't think it's worth $4. Either you'll find one that's cheaper, or you wait for it to go on sale before you buy it because you think the value of that is lesser. Now, if you're going to the store and you're because you got a party this weekend and you need to buy 5 bags of potato chips, and it's not on sale, you just buy it because you got to pay more than what you think it's worth because you have an urgent need. But anyway, that goes back into sort of market understandings in supply and demand. Now, it's important to know that when there's absorption in the market, because oftentimes when you have absorption, that's where traders get trapped, right? Everyone loves to talk about trap traders, but not absorption. And think about it for a minute, right? The market's at its high and buyers are excited, right? They think the market's finally breaking out. but there's supply up at the high and just above it oftentimes. As a result, all the buyers keep buying. The market isn't moving higher anymore, right? Instead, the market starts ticking lower. If you're a trader, you're thinking, what WTF? Right? We've all been in that situation. This is it. This is, the moonshot. We're going up, and you get long. All of a sudden, what happens? There's no follow through buying. Instead, you got sellers all of a sudden hitting all the bids, and the market starts ticking lower. Right? This is a delta footprint chart, but you can see it oftentimes. Like, this is a 5-minute chart, so I spend a lot of time on range bars, but on 5-minute charts, right? On minute-based charts, obviously you're constricted to time. So at 12:40, new bar starts, 12:45 it ends, and so on. So this is where some of the power, I think, comes in on certain types of charts. Is you got to look at the chart, at the bar, and then watch what happens as the next bar is forming, right? We got this volume up here. Look at a new high, right? 12, 93, 11, 154, 148. Okay, everyone's coming in buying. There's people selling up here, right? Look at even here you got 101 traded there. So as you got up here, people are hitting these bids. These traders up here, these guys are trapped, right? They're stuck. We didn't go higher in the next bar. Instead, we started trading lower, right? These guys are trapped up here. Now, people like to, for me, this is the biggest fake news, misinformation out there in the trading world. Is people always talk about trap traders. Oh, you had these buyers up here, and they had to turn around and start selling, and we sold off. Well, you know what? It's only, what is that? About 300 contracts. Honestly, this is a market. Crude oil, it can absorb 300 contracts pretty easily. You see, even here, you got a delta of minus 288. So it's not out of the realm of possibilities that these people are getting out in here. And but people like to talk about trap traders as it causing massive moves up or down. Everyone's trapped up here. Not really. There are traders that are trapped, but what you have is that's sort of the trigger for a trader, like for you or me, to say, oh, there's trap traders. Well, why are there trap traders? You have to think of it in the opposite, is because there's sellers up here with supply. And then they're coming in here at these higher prices, selling the market down. You can see how it's transacting mostly on the bid here. Then as you get down here, there's someone keeping their foot on the neck of the market, offering it out at minus 258, 223, 76. You tick back up a little bit, 131. So you still got sellers in here. Look at this. You still got sellers in here, 200, 153. Now earlier, right, when you got up here, you transacted some decent volume, 248. Okay, that's good. What was the follow through buying? Yeah, positive delta of 3 there. Not much. And then next bar, what's happening in the next bar? Market's just selling, hitting all these bids here. Bid. There's, again, this is a delta chart. This is not a volume footprint chart. This is just telling you what the linear delta at a price level is. So you see it's minus 38, minus 60, minus 35. So it's mostly people hitting all the bids in here. Then you come down here to unchanged, and then boom, everyone's getting excited again, lifting all the offers, a bit of euphoria, buying, get those highs, no follow through buying up there. Next bar comes in red, everyone's hitting the offers, even offering it out lower, offering it out as you go lower. Now, if you're looking at, the indicator madness chart, people say, oh, you got an inside bar in here. They'll justify it when we sell off down in here. When you get down back towards the moving average, this is where they're looking to get short. But where are you going to want to get short? At this moving average, or right up, up here in the red bar right after the big green bar, right? You see the big green bar, a lot of times people get excited. Hey, we're making new highs, got a big green bar, get long. But there's no follow through buying, right? These indicators don't necessarily give you sell signals yet. So, that's why, people talk about indicators, price-based indicators, as being lagging. That's what they mean, right? You can see it in here, right? You get the big, strong positive delta, 1700. Oh my gosh, it's off the Richter scale. Get long. The next bar, minus 86. What the hell? The volume is still decent, 5,000. The big green bar is 12,000. But prior to that, some of the bigger volumes was 5,000, 5,000, but, averaging around 3,000. But you're still averaging, slightly above here, 5,000, 4,600, 5,000 as the market's trading lower, right? So it's not just drifting lower, with lack of participation. You're seeing some strong selling in here with the strong volumes. Okay, so here, what do you do? Okay, this is your indicator madness chart. So you just follow this 9-period moving average or whatever this was. Here, I threw up on here. But, you have this nice low down here. This is very a juicy low to be buying on, right? Let's look at that move that came after it. All right, it's a beautiful move up. But again, if you're trading these indicators, what's the signal down here? There's just so many false signals, in every one of these indicators. You're just sitting there you're scratching your head. But if you're looking at the volume footprint chart, you see this 43, 20, 20, 14, 11. You have a stacked selling imbalance at the low, right? Market came down, probed these lows. Everyone's saying, oh, we're breaking out, we're making new lows. Well, then what happens? Market reacts back up. Where's the follow-through selling? These guys are trapped down here, right? There's very little counter offer, and people aren't offering it down here. Where's, I traded 1 lot on the offer, 2 lots on the offer, 0, 0, 0. Where's the counter trade, right? If you're looking at this, and this is a 5-minute chart, if you're looking at this and you're thinking, you're back up here, right? It's a green candle. So you open in here at what is that, 597. 5 minutes, 4 minutes later, you're trading up here at 615. 20 ticks higher. You see this, trap traders, that's worth getting long on. Catch this move. Next candle, big green candle from 20 all the way up to 40. Next candle by itself is already 20 ticks. So you get that information, you get in a hell of a lot faster than you're getting in this bar or immediately in the next bar to catch some of this move back up. I'm not saying you catch the whole entire move all the way up to the close, but there's enough meat on that steak for you to enjoy. Again, people always say don't try to pick highs or lows. And I think that's bad advice because it's disingenuous, right? There's a lot of money to be made trading around highs or lows. And, when people say don't try to pick highs or lows, I think they mean it in terms of, drawing all these, bat wings and projections and things like that. Let the market tell you if it's forming a high or a low, basically. If the market's at a high and delta is increasing, but price isn't going higher, your ears should prick up, right? Just like, like a horse, right? Here's a sound, well, the ears start standing straight up, turning around. You got to get ready to look for signs to get ready to sell as the high could be forming, right? Imagine, market's trading up near its high. We're got aggressive buying, and delta's getting strong. All of a sudden, the price isn't going higher. Why isn't price following? These are questions you should be asking. They're two obvious signs you should be looking for. Aggressive buying starts to weaken. The buyers are drying up. Positive delta should be getting smaller ideally. Or aggressive selling starts coming into the market, and it's going to show up in two forms. First one will be the delta. So you should either start seeing small positive delta or negative delta in the bars off the highs, or you should start seeing selling imbalances in the bar. So this is what I mean, right? We're going new highs. Volume is increasing, right? You're making that new highs on increasing volume, 7,000, 4,000, 7,000, 11,000. Then you get up at 2,000, 6,000. So you got your big volume bar on your high. But look at the delta, 600, 536, 315. And I discussed this in the one of the foundation courses on delta. This is a bearish sign by itself. But when you add in, what's happening here, then what happens here? These are the questions you should be asking yourself as a trader, right? Market's going higher on positive volume. That's what you expect, right? But at some point, market's going to stop going higher, and it's going to get ready to sell off. And as a trader, you got to look for those signs, right? You can't just say, well, we got the volume dropped off to 6,000, so it dropped in half, so that's a very bearish sign. Well, it just started going sideways. But what you should be looking for are the other signs. Look at this. So for the next 1, 2, 3, 4, even 5 bars, look at the delta. Minus 288, minus 100, minus 300, positive 6, which is nothing, minus 600. You should be already convinced that we're not going any higher, right? And what do you see in here? You're starting to see some selling imbalances come in. Selling imbalances. And then the market falls over. So, I know a lot of traders. I've been blessed in my life, and the trading gods have introduced me to a lot of traders over the years, going back to the 1990s, and many of them are the epitome of success, right? The $1 million home. I knew a guy who bought a house, and this is in Singapore. He bought a house, and before the Asian financial crisis in the 90s, and he paid a lot of money for it, and he literally been underwater on this house until after the crisis in financial crisis in 2008. But by this time he had made so much money he didn't care that he bought a house worth like 10 times the price. But these people, right, they're not the Instagram type of millionaires. Sure, they have the $1 million homes, the fancy cars, they go on the first class vacations, they got the country club memberships. They don't go around posting it up on Instagram. That's funny. I was looking at this. I enjoy Instagram. There's a lot of funny memes. I love memes, and a lot of funny pictures. Sometimes I look at Forex memes and stuff. I saw this Joker. I gotta call him a Joker because he's wearing this outfit. Sitting on a green car. Sort of reminds me of the Joker from Batman. And he's wearing like this Gucci tracksuit and Gucci hat and stuff. I have never ever met a trader in my life that's dressed like that, and trust me, I know a lot of traders. Maybe that's the new wave, but I doubt it. That's what I call these Instagram millionaires. But the thing is, right, if you ask a lot of these very successful traders to explain the method of their trading, you never hear them talking about moving averages, RSI, MACD, ADX. Everything that the popular trading books tell you is the way to trading riches. Can you make money with those? Possibly. I'm not going to discount it completely. I've never found any value in it, and in all my years of working with other traders at an institutional level, I've never seen. I might have seen, but I've never really seen people have them on their desk, charting, looking at moving averages, RSI or anything like that. I take that back. Maybe some moving averages. People, farmers like to look at 200 moving averages, 200 period moving averages, just sort of get an idea of the trend. But other than that, they don't really use technical indicators. They read the market. They listen to what the market is telling them in supply and demand. And while each of them trade differently, there's no exactness in their trading, right? There's no mathematical equation that solves the trading puzzle for them, right? Instead, they watch what's happening in the market and what's happening outside the market. Most traders fail because they start using price-based indicators, which through different mathematical formulas filter out the quote noise out of the market, right? When you use price-based indicators, there's a layer between you and the market, right? You gotta just learn how to trade, right? It's just like, I've used this quote before. I think it was Sir John Gielgud. It was in a movie with was it like Dustin Hoffman, and Dustin Hoffman is like trying to get into character or something like that. He's going through all these steps to get into his character, and John Gielgud says, "Boy, why don't you just act? Rather than having to go through all this different stuff to get into the character you want to play." And it's the same way with the markets. Don't have that extra layer. Just trade, right? Trade on what you know about markets. So the other thing I want to talk about is price exhaustion, because it's kind of related to absorption. Because when price exhaustion happens, it happens for two things. One, buyers or sellers are just tired, right? If you're going high, buyers are just getting tired. The last buyer has bought, or if the market's making lows, the last seller has sold. But the counter side of it is there's absorption there, right? There's going to be somebody that's offering the supply at the high, or bidding at the low. And what it is the market's just lower, then comes back towards the high again and tests it, but on less volume. And at this point, buyers are becoming exhausted, and there isn't much volume on the second attempt at the high. Again, it doesn't have to be like a second attempt. It could happen on the first attempt as well. In other words, less volume at the double top. It just looks better optically sometimes on a double top. But, instead of the big buy orders coming in, you're now seeing, the one lot wonders coming in, trading price action, right? Because price is going up here. So, a price action trader, I got to be buying it. But they're about to get their faces shoved into the dirt. Now, some people, I call it price rejection, others call it price exhaustion, others call it sequential decline, others call it tapering off. It depends really on who you talk to. And, what it's going to look like, something to this effect, the less volume on the way down, down in here, right? People are going to say, oh, this is price exhaustion here. You got 5, 133, 419, 26, 41, 368. They like to have very symmetrical numbers. 183, 1693, 1297. The 1693 should be here in the second level because it has to be very symmetrical for them. And if it's not, then technically it's not price exhaustion. But they'll claim it here. Sometimes I think it's a little bit more of coincidence. I'll say coincidence, but that's just how the numbers land sometimes. Now, that's not to say that price exhaustion, right? You're really looking for lesser volume. I would not, even if this was 183, 1297, 1693, I wouldn't consider that price exhaustion because the volumes are still relatively strong. Really what you would want, is less volume, 5, 133, 419 right up here. But that's the thing is, right, when you're trading, with a quote, computer algo, right, it's just looking at these numbers oftentimes, they don't really take into account the volumes. And that's where you as a trader can make that difference. Say here, 336, 219, look at that, you got price exhaustion here, we're going up. Well, okay. If that's what you want to make of it, and sometimes, people, they don't even differentiate between red bars and green bars. I think you have to look at, red bars and green bars because, you want to have confirmation that the market's happening. You're not going to say, well, you got price exhaustion on this red bar down here, buying price exhaustion 272, 373, 904. Really, you're looking for a reversal, right? Price exhaustion should be a reversal signal, not just happen anywhere. There's some softwares will put a box around here, but honestly, you don't need that. You could just look at your chart. I know everybody likes to have things automated for them so they can trade a million different markets. Hey, if I can make $100 in one market, I could look at 10 markets, make 1,000. Stick to the one market. Oftentimes, I think it's more going to be more effective for you. So again, I hate to bang the drum, beat a dead horse, whatever cliche you want to use, but you need to understand and know what's happening in the markets right now. By right now, I mean understanding the dynamics and trading activity occurring on the bid and on the offer, right? The people who move markets trade based on what's happening right now, not based on price indicators. When you talk to an institutional trader, at the end of the day, if you're out there having beers with him, you ask him why did he buy at such and such a price, oftentimes the reply is going to be something like, well, it looked like a good buy at that price, right? You won't hear him say, touch the lower Bollinger Band or price broke the 200-day moving average, right? The reason I bring this up is not to disparage price-based indicators, but rather to explain and drill into the importance of understanding how the big traders think, right? The insight will help you see what they're doing in the market so you can anticipate and follow what they're doing. Now, there's a lot of good books on trading. Honestly, I think the best books, right? For me, any type of book that is a biography on either on whether it's a trader or athlete or even a politician. Even I get sick of some of these politicians. I like reading biographies and hearing what other people went through in their lives. And if you've read these stories of traders that experience the crash, I'm not talking these little flash crashes, but I mean like the big crashes in the market, and how some of these guys made their fortune. They've come up. There's a few traders. I think it was Louis Borsellino. Bought the S&Ps. He was the one that stood up and said, I think this, as there was no other bidders in the market, he stood up, he put a bid in there. Someone hit his bid. Next thing market rallied. Guy made like $1 million in a minute. Went to the bathroom and immediately threw up because he realized he could have just lost that much as well. Same thing with the Nikkei, right? I remember, back when the Nikkei crashed, some guy on the floor, Nikkei floor, bid 5,000 for the Nikkei. Well, that was the only bid. So people hit it. Next thing market jumped up. The guy made a boatload of money. And that's what you talk. When I talk about, well, it looked like a good buy. These guys aren't sitting here trying to calculate their Bollinger Band on their hands and say, oh, okay, well, yeah, we're at the lower Bollinger Band, I'm going to buy now. It's the big traders are the ones that supply the support or resistance in the market. It's the guy that step up to the plate. Okay, yeah, I'll bid 5,000 on 40 lots like that. So again, don't get caught up in trying to think indicators are the greatest thing since sliced bread. People were trading long before indicators and making a lot of money. Now, generally absorption should occur around the edges in the markets. And what happens when the market's moving? For example, the market's moving up, pauses, a lot of volume goes through. It could be someone trying to hold it down, maybe defend a level. Again, look left on your chart. Get some sort of idea of what the market is doing. Or it could be someone working something against cash. Honestly, you won't know, but you have to make an educated guess. Look for imbalances in the bar. If you start poking through the level, ask yourself, is there aggressive buying going on? Look at the delta. Is it getting stronger? Once you get past that area, watch what happens when you come back to it. Is it being defended? And, perfect example, we're coming up here. We're at our highs here, right? You got your new high. Yeah, you got nice volume. Next high, okay. Yeah, you still got some decent volume. Still got make this new high. Well, you got negative delta. Volume overall is still strong. Next bar a little bit lower. Negative delta. Okay, still decent volume. A little bit less than it was earlier. Now we're down to 10,000, 10,000. So volume is drying up, right? 10,000 again, but then boom, 17,000. You make that new high. But what's changing in here, look at this, negative deltas in here. You sort of saw these signs earlier, right? It might have been worth it to some of you guys to get short in this green bar. And then, the market did tick up, make a new high. When you make this new high, this is what I was talking about earlier, right? The price exhaustion, right? First time you hit that high, 15, 632, 867. Second time, 5 lots, 500, 800, 19. So this little pocket of volume up here is lesser than it was earlier. Not much lesser, but lesser still. And you do have a divergence. You got your new high with negative delta. And all of a sudden, but look at this high, right? What do you see? Selling imbalance, 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 selling imbalance. Where's your buying imbalances? There's not many. You're overwhelmed with selling than buying, right? It's indicative in the negative delta. Do you think this market's going higher or lower? I think it's got more of a chance to go lower than go higher. You got the selling imbalances, you got the negative deltas, volume. It got light in here, but then it's picking up here. 17, 15,000, 13,000, 17,000. It's getting stronger again, and you're seeing stronger negative deltas. And here's one. This is crude oil. It's a 5-minute chart. Boom. Big selling coming in here. 15,000 contracts traded, whereas before you're trading, earlier it was 10,000 was your biggest volume. Okay. Big negative delta, 15,000. Get this little green bar here. The next bar, boom. New lows, 15,000 again. Strong negative delta, 1,100. Stack selling imbalance. But what's happening? Things are changing. You still got some okay volume, 7,000, 6,000, 7,000. It's kind of going sideways, building up some positive deltas in here. Now, are you seeing a lot of buying imbalances? No. But are you seeing a lot of selling imbalances? No, not really. Now, just because you have absorption, right, a couple things can happen. You can go sideways, you can go up, you go down. And I'll talk about this later. One of the signs that I'm always looking for is looking for some sideways action with inside bars. Again, I don't want to start getting into some sort of, inside bar course or anything like that. But really what I'm looking for is, do I have an inside bar? Inside bar. Once you start seeing inside bars, I'm kind of looking for some sort of reversal. Now, yeah, you could say, well, you have an inside bar here. How come you didn't get the reversal? Well, we haven't hit our low yet, per se. Oftentimes before you hit a low, right, you need that. Well, you haven't hit your low, for one. Your low of the day is this red line, but you need that big delta volume blow off, right? And you're seeing it in here, then you're getting this. You made your new low, you got your inside bar here. It's just sort of hanging around down here, but what's happening is delta's picking up, delta's picking up, delta's picking up. And what I'd be looking for is, you don't really see it in here, but it's kind of subtle, actually. You're going to be looking for the volume to start picking up, deltas obviously to start picking up, because here, you got delta of 1,000, but doesn't do anything. 200, 18 is nothing. 285, 595, 282. I'm looking for either a volume jump or a delta jump, and you get it right here, 1175. This is the trigger bar right here. I can't honestly say that this is a good buy somewhere in here. I would love to, but I'm not really have any sort of trigger till you get to this bar and the market jumps up. So again, no one can predict the future, right? The future is always unknown, and knowing order flow does not change that. But order flow does help the trader understand what's happening right now in the market. Once you understand what's happening right now, you can make better trading decisions about what's likely to happen in the future. So this concludes Module 1. In Module 2, I'll explain the different types of players involved in the market and how they trade and create absorption, accumulate, and distribute supply. So I'll see you on the next module. Bye-bye. Hey everyone, it's Mike, and welcome back to the Orderflows Absorption course, Module number 2, Understanding the Players. Now, before I begin, a brief disclaimer. This presentation is for educational and informational purposes only, and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right. Big traders, institutional traders, however you wish to describe them, are the boogeyman in the trading world who smaller traders like to blame when everything goes wrong. But nowadays there are so many different types of traders that can move large size in the market that lumping them together devalues their worth. And what do I mean by that is, now you have these firms that I wouldn't categorize them as large traders per se in the sense of a real money accounts. They are large short-term traders, scalpers. I'll say scalpers, but intraday traders that can move a lot of size. Now, even though they move the size, I would not categorize them the same as I would a big commercial trader or a big bank, because their timeline of a trade is much different than a more longer term trader, a real money account. Now, trading nowadays is anonymous, right? On the screen, you can't see who's buying and who's selling. It's impossible, right? You don't know the actual buyer, the underlying seller. Back in the days of the floor, you had an idea sometimes who the underlying customer was, depending on which house they're trading through. But on the screen, you don't have that luxury. You can't even tell if it's Goldman Sachs buying or selling. You can't tell if it's JP Morgan buying or selling. You can't tell if it's a Cargill, or a Stat Oil or BP that's selling gasoline or oil. Or you just can't see that. So with order flow, now you get to see the volumes now as opposed to a normal bar chart, and you can't guess the actual underlying trader. I mean, down to, what company is working for. But what you can ascertain is areas where big institutional players are active, right? And to me, I think that's one of the real benefits of order flow, that you can sort of make an accurate assessment of what type of player is active in the market, rather than just looking at a bar chart and not knowing, is there, heavy volume, like here, right? There's a prominent point of control down here at the low. It's telling me that there's institutional activity at this low, that I could be fairly safe in buying this low here. Now, at any given point in time, there are many different buyers and sellers in the market, trading different time frames, all having different opinions of the market now versus sometime in the future. And, not everyone trades a 1-minute chart. Not everyone trades a 30-minute chart, 4-hour chart, or a daily chart. There's every trader has a different time frame, has a different outlook of the market, where it is now versus where it is in the future. And, that's sort of what makes the market. And it just it kills me sometimes is, you talk to retail traders, especially you see this a lot in the forex world. They think everyone is on a 4-hour chart. They think everyone's looking at they think everybody in a bank looks at a daily chart, then looks at a 4-hour chart and a 30-minute chart down to a 5-minute chart, then makes a trading decision. That's not how it works, and sometimes trying to convince them otherwise is it's like banging your head against the wall. And you have to realize that there's some people, they don't even look at a chart intraday in the sense of trying to make a trading decision. They're looking at a daily chart. And then there's people that look at a 1-minute chart, don't even bother with a daily chart. So, don't sort of fall into this trap that, oh, this is how everybody does it, and this is the way I got to do it because so and so said it like that. And you have to have an open mind and realize, start talking to other traders, have interaction with other traders. And but what I mean by that, please don't go to a message board, a forum or something, and talk to some anonymous person on there who won't even, hides behind a screen name and thinks he's some market wizard when he's not, and he's probably just trading on sim. Usually the obvious way to tell is when they think they know everything. The successful traders realize how little they know. And to me, that's sort of the red light, so to speak. That's why I don't hang out in trading forums. Even though I have the Orderflows traders forum just to post charts on, but you go to these message boards and everyone thinks that they're the world's biggest trader and the world's greatest trader. They're not. The real successful traders don't have time to be hanging out at message boards, and oftentimes the people that are on those message boards don't know how to trade. That's why they go to the message boards. And then, they think they know stuff. People agree with them, and all of a sudden, next thing you know, they think they're a market wizard. You have to meet actual traders. Go to conventions, speak to traders in person, face to face, get to know them. Is it free? No. You got to spend money to do this stuff. But really, if you want to be successful, you got to put yourself around successful people, real people, not anonymous people on the internet that, what's your name? Oh, my name is Big Lips 99 on futures.io or whatever. It's, you have to make an effort to meet people, right? And nowadays it's hard because, everything's on social media and people don't have that interaction anymore, going places. So, if you ever have a chance to go to an expo, a trading expo or something, FIA, the Futures Industry Association has these shows every year, usually in Chicago and some other cities. Try to go there, and meet people. It doesn't matter if you're just a small-time trader. You go there, you meet someone from the CME, you get a free T-shirt at least, and and it's from there that you get interaction with other people in the trading industry that can really help you improve yourself. So let me ask you, which one do you think is the short-term trader? Is it this guy that puts his seeds in the ground and lets it grow slowly? No. Is it the guy that is just putting his bait in the water? No. It's most likely this guy, right? He's got the computer out, right, sitting on the phone, ready to blow his brains out. Short-term trader right there. Don't be that guy. You want to have a more relaxed and enjoyable time trading. If this is you every day with a gun against your head, give up trading, honestly. You shouldn't, there's a lot of other activities to do rather than trade. So what's the difference really between institutional traders and retail traders? Well, retail traders take trades based on profit potential. What's the winning percentage or profit potential? You can see them from a mile away. They're the ones that talk about, well, I can only take a trade if it's got a 3-to-1 risk reward ratio and it's got I've back tested it 20 years and it shows 82.1% win percentage. 79%, I can't take that trade. It doesn't meet my requirements. Come on. Institutional traders take trades based on risk evaluation. What can I lose is what they're asking. They're not saying, the trade will take care of itself. They understand that. What they're really doing is evaluating the risk. Can I lose on this trade? Yeah, okay, I might lose, a little bit initially, or conditions might change. It might start losing, but they know that what the upside is, right? They're not concerned that, I don't know if it's going to meet my 5-to-1 risk to reward ratio, so I can't take that trade. No, that's not how they think. And that's to me, that's one of the big differences between retail traders and institutional traders. Retail traders rather get so caught up in the percentage or in the risk to reward ratio that they miss out on a lot of trading that's going on in the market. And when you look at a chart, you should always be asking who's buying, who's selling. All right, we're up here at a high. You should be asking, do I think institutional traders are buying up here, or do I think they're selling up here? These are the questions you should always be asking. If you think that retail traders are the ones buying up here versus institutional traders selling, okay, well, whose side do you want to be on? You want to be on the institutional side. You don't want to be on the retail side, the herd mentality, right? Ideally, you want to be on, quote, the smart money side. But you have to be able to determine who's buying and who's selling to understand whose side you're going to be on. Now, while it separates retail traders and institutional traders, I'd then further define institutional traders. And I'd break it down between long-term traders and short-term traders. And, like I said at the beginning, right, people just sort of lump in everything that's not retail trading into institutional trading. But even within institutional traders, you have long-term traders, short-term traders. And what do I mean by that? You have these shops now that are basically very big local shops, in the sense that, a trader in there who's, in the old days, he would just be a local on the floor, and you'd just, he'd be trading his 500 lots of corn, which normally would fall under, you would think it's 500 lots of corn, he must be an institutional trader. Well, no, he's a day trader. He's got some leverage, he's got a big account, but I wouldn't necessarily consider him an institutional trader. That's why I break it down between long-term traders and short-term traders. Long-term traders are going to be the ones that are buy and hold, or sell and hold for a long time. Where short-term traders can buy in the morning, sell in the 2 hours later, right? They're in and out based on market activity. And short-term traders trade because they need to. They tend to trade more aggressively. They want to get in a position now. They're more prone to getting trapped in the market. Long-term traders can wait, right? They tend to trade passively. They're willing to wait for the market to come to them, and they don't get trapped very easily. That's not to say that long-term traders don't get trapped. Well, of course they can. They're human, and many traders don't differentiate between the different traders, right? It's almost as if they think everyone looks at the same chart. Like I said, long-term traders have vastly different market outlooks than short-term traders. Long-term traders have a macro view. Short-term traders have more of a micro view. They may take into account macro data, and what do I mean by that is, they can trade around a number, whereas a long-term trader is sort of, I'm not going to say oblivious to a number, because he will react accordingly if the number's out of line, but he's taking more of a long-term view than the short-term guy. The short-term guy will be out by the end of the day generally. So again, this is why I like delta charts. This is a delta footprint chart, a linear delta footprint chart, and you can see how everyone is just selling, right? You can see the selling, selling, selling. Now you could see this on a normal volume footprint chart if you're familiar enough with it. I think it just stands out a bit more on the delta chart, where you could just see everyone's hitting the bids, and it gets down in here, and you could just see how, for me, I think it's very clear. Maybe I've looked at these charts long enough where it's just sort of forming this base, and you can see how there's big passive bids, even though here everyone's just hitting the bids. Okay, it's eating through these big passive bids here. 1400. These are delta, so this is the difference between the volume traded on the left versus the volume traded on the right at that price. It's not diagonal, it's linear. And I mean, I could look at diagonal delta charts, not gonna be that much different, but what I like to see on this is how it's eating up through, and sort of leaves this footprint here. So you can see minus 1400, 500, 400, 400, 500, 900, 100, 400. The actual volume numbers are probably bigger. But then it gets down here and starts turning these green bars, right? And you look at these point of controls. They come up, market comes up, puts in a little higher volume here. It looks like it's about to take off, but boom, gets more selling. But you have big passive buyers down here. Right, point of control is lower, so you're putting in a lot of volume again down here. Pops up, looks like it's ready to pop, not quite yet. Gets down in here again, heavy volume. Point of control down here at the towards the bottom, and you look at this rest of this bar. It's green bar. Everything's on the offer side except this 175, the 75 contracts here. But it's just what I call it, sucking them in. It's like they're almost setting this trap for sellers to come in here, sell as much as they can, sort of give it this little fake bounce, let the sellers come back in here, sell some more down, but they're just all waiting in here. Now, this is where it gets interesting. So here, look at this volume, 52,000. So this is a 5-minute E-mini chart, 52,000 here, big negative delta, okay? Get this little green bar, a little bit of a bounce, 30,000 volume, still heavy. Bounces up green, positive delta, okay. Sellers come in, boom, hit it down again, minus 3,800 delta. But look at this volume, it's a lot lesser. It's 27,000. So you went 52,000, 30,000, 27,000, and you get down here to this low, 21,000. Okay, positive delta, 1265. 1, 2, 3, 4 bars. Volume is getting lesser. So even though you have these green deltas in here, positive delta, there's still selling pressure, but it's getting lesser. Right? It's getting lesser. You get a little bit of bounce. There's another push down in here, a little bit of a bounce, but the overall trade that's happening is getting lesser and lesser. Then you get down here, this is delta 48, negative 48. That's nothing in terms of normally your bars have 1,000, 1,500, 2,000 contracts trade. Get a big volume in here, 31,000. Okay, it's the only time it's been bigger than that is when you had this bar here, 52,000, and it just hangs out here, right off the low, right in the low, point of control right in the middle. So all that selling, it's like we bounce up a little bit, more selling. It's absorbing. All these sellers are coming in here, but there's buyers absorbing that. Right? Look at that. Delta is only minus 48. It might as well be 0. And it's just you could just feel it, right? You could just feel how it's trading a lot of volume, but market's not going anywhere. It's not going any lower, right? Instead, it starts ticking up. You get the higher point of control. Bar closes, comes back down. Still holding this previous point of control here on the low. It hits this pocket here. People are still selling it. Maybe we could go lower, just as here, right? Oh, you hit the low, everyone's coming in. Oh, new lows. You just hit a new low. 1, 2, 3, 4, 5, 6, 7, 8, 9 new lows. But you trade 31,000, doesn't go any lower. Volume lightens up here, 18,000. Tries to make this push right here down 23,000. It's decent. It's not high. It's not low. It's closer to higher than lower. But there's people in here absorbing it. You could just see it in here, right? You got the lower point of control than the previous bar. It's a green bar. This is these two point of controls, this bar and this bar is something I talk about in the point of control course, actually. Very bullish, very bullish. So you got 1, 2 very bullish point of controls in here that often acts as springboards. Then you can see how the market went from 98 all the way up to, over here, it's trading 10, 12 already. But the signs were in here early that there was, the longer term traders coming in here looking for an area to buy. How do I know it's longer term as opposed to shorter term? Well, it's a fine line, honestly. It's, for me, when I'm looking at lows, I'm looking for areas. That's where a longer term trader is going to be buying probes, basically. The short term traders are the ones that often probe it, trying to see, how far they can push it. Okay, but the long-term trader is sitting in there. He's just lying in wait. Honestly, the long-term trader is buying all the way down here. These big volume numbers in here. This from here 600. Here 1400, 700. They're all working bids in here. The long-term traders. Then they start coming in here, right? Notice how we're putting in heavy volume and the market's not moving. To me, that's the sign that you have longer-term traders in there, because they're the ones absorbing all the activity. Short-term traders would be coming in, lifting these offers. This area in here, this is where I think the shorter-term traders are coming in, like this big run up right here, all offers being lifted. Down in here, this is where the long-term traders are. So the most important part of market understanding is recognizing when different time frame participants are active. Markets are dominated by short-term traders who are more focused on price. Longer-term traders realize that the markets have moved too far away from value. That's when they become active. They come to the market to compete alongside the short-term traders for opportunities. What's important for you to understand is that the market's balance has shifted. It's no longer dominated by just short-term traders, right? The big short-term traders are the ones that move the markets intraday, but the long-term traders are the ones that help define the trend. Okay, and so don't fall into the trap of thinking that it's only the day's range is defined by the what do you call it, the day time frame traders. It's not. It's actually helped defined by the long-term traders. So when you have the long-term traders competing with the short-term traders for opportunities, that's when you see the market start to trend. If you get down in here, right, short-term traders are thinking, we're not going any lower. Long-term traders are here. They start competing. But the long-term traders that want to get long, they're competing with the short-term traders. Forget about the retail traders. Retail traders don't make much of an impact, honestly. Their volumes are quite small relative to the large short-term traders and obviously the long-term traders. So when the long-term traders and the short-term traders, institutional side, are competing for the same prices, that's when the market starts to trend. And again, you can see that in the order flow if you know what to look for. It's difficult to isolate a trade being done by a short-term trader versus a long-term trader, but when you take into account market structure, it becomes clearer, right? If you just look at a bar, you're not going to be able to determine. But when you take a market structure, okay, we come into a low, seeing buying, if you start seeing aggressive buying. If I was looking at a volume footprint chart, I probably see some imbalances occurring, at certain areas. Then I know, like I said, short-term traders tend to be more aggressive than longer-term traders. Longer-term traders start buying, they bid over, they start lifting the offer bid. What I mean is market 6, 7, they pay 7, work a bid at 7, because market's now 7, 8, right? So they buy all the 7s, and they turn it bid, then they see, it's 8 trading, they buy all the 8s, 8 bid now. That's what causes the market to move. Now, the bigger short-term traders, it's 7, 8, they buy the 7s, they buy the 8s. They don't necessarily turn it bid and sit there. They're just more aggressive in the sense. Now, who is the longer-term trader? Well, it's a position trader, right? It's a commercial, it's a portfolio manager. It's real money accounts. What's a real money account? It's going to be a pension fund. It's going to be a sovereign wealth fund. you watch Billions and you hear, about the sovereign wealth funds investing in funds. Yeah, but also the sovereign wealth funds also have their own trading departments as well, where the traders call in and place orders, take market positions like that, and in addition to giving money to Bridgewater and um, all the other big funds like that. So a long-term trader doesn't have to trade a market on a given day, but when he does, he can be more cautious and passive, right? He can let the market come to him. He doesn't have to get filled today, right? I would see it a lot, talking to the equity guys. Oh yeah, this is a JP Morgan. They have an order from, this real money account to buy a certain stock. Well, they buy what they can today. They don't want to push the price. Okay, if he doesn't get filled today, they're just going to work it tomorrow. I would be there talking to one of the traders there, and I'd hear his buddy on the phone say, "Okay, so we'll just continue to work that bid at such and such a price, or you'll continue to work that offer at such and such a price." If you don't get filled, fine. It's they're willing to wait. Then they readjust and say, "Okay, well, yeah, let's lower the price, or let's raise the price of our bid." So they're also trying to capture market generated opportunities undetected. So what I mean by that is, that's what all these execution algos come into effect. They're trying to get execution alpha, right? They're trying to save. They know that they have to buy a certain amount, and they don't want to impact the market, right? So they're going to get a little tricky with it, work bids, lift some offers, and like that. They're trying to get a good price on their fill, a good average price. Now, when the longer term trader becomes a little more anxious, he starts becoming aggressive, and his actions start to be seen by the short term traders, who then also start to trade alongside the long term trader. So, if you're looking at a bar chart, okay, this is just your normal candlestick crude oil chart. Well, are long-term traders active? Actually, no. Why? The way you can tell on a bar chart is that the market's going nowhere, and you got short ranges. Market's opening and closing at the same price. Basically, a lot of those doji candles, in small ranges, small real ranges. Between the not necessarily the high and the low, but the open and the closes. Now, here's soybeans. You can see how big down days, big ranges, big green, big red. That's how you can tell long-term traders are active, because they're the ones pushing the market. So long-term traders view buying and selling differently, right? So when there's long-term institutional buying at the end of a downtrend, that's often enough to start an uptrend. And traders are happy to start buying and see a trend upward, because they like to buy low and sell high. Okay, they won't get in trouble for making a profit in that sense. But when it comes to selling, they have to be more cautious, right? Long-term traders generally are always holding inventory and wanting to sell at opportunistic prices, right? If the market pops up, right, they want to sell before the market drops off again. But if they sell their inventory too aggressively, the market can drop quickly, and their profit opportunity will evaporate as prices revert back to value. So at highs, long-term traders are more cautious but get aggressive once prices start to go lower to a point. Right? This doesn't mean prices start dropping, they're going to stop. No, they might get aggressive and then stop. But usually when they sell, it's to take a profit. But at least in stocks, in futures, it's a little bit different. Whereas they can get short, but that's sort of a different aspect, unless they got some major piece of information, that they think the market is going to drop over time. Really, it's bizarre in the sense that a lot of these real money accounts are really just buy and hold. Long-term traders, buying and selling is going to change the overall supply and demand paradigm in the marketplace. It's just because of their size, right? It's funny in the sense that it doesn't. Okay, so, what happens? For example, crude oil, right? When I say British Petroleum, what they're doing in the market is going to change overall supply and demand. What it does, it doesn't. I don't say shifts it, in the underlying sense like that, but it's, people see that and changes the perception in the marketplace of what the overall supply and demand is. You know, it's not like they're turning off spigots to control the supply, but you know, if they're buying a lot, you know, the market might perceive that, oh my gosh, you know, you got the big petroleum companies are buying oil. What's going on? You know, is there a shortage? Going to be a shortage like that? But that's how it works. Okay, so when you're at a high, you know, the question you always want to be asking, are we going higher or are we going to start selling off? And you want to be looking for the signs of either one. So, you know, this is Euro currency. It's a 5-minute chart. So you got this big bar here, right? 1,500 in volume. This is 5 in the morning, Chicago time. It's 1,500 contracts at 5 in the morning, 5:30. You got some heavy volume in there. Look at this, 622 in the footprint, 278 at this level, just below this high. We came off a little bit, and then boom, made that new rally, took out those levels, made the new highs, got a divergence up here, came back up here, tested it, and then sold off. So what you want to be asking is, when you're looking at this high, is there a sign that we're going to go higher? Right? We took out the highs, made new high. What's going to happen now? Are we going? We start coming off here. Are we going to rally back up here and take out this high? We come back up here. We test it. We test it again. You know, there's volume. It did go bid there actually, but it didn't trade. You know, one tick above, and then it started selling off. So what's the signs in here? Well, first of all, you got this big volume in here, right? This one stands out. You know, 1523. Market didn't really go anywhere. Didn't go higher. What you had is, you know, someone bid, you know, a lot of volume here, 622. So this is going here. You got the big sellers coming in here, selling the heck out of this market. You know, there was a buyer here. Now, maybe he's working a cash. You don't know, something against it. But nevertheless, heavy volume, market should be going higher, right? You were trending up, got big volume, market starts going down. Then boom, you get big volume bar, push up. But look at these deltas, you know, 37, minus 37, minus 154, minus 60, minus 96, minus 215, minus 90, up here at this high. Now, we'll talk about this in a second, but sort of one of the things you got to be watching for is, you know, when you're making new highs, how is the selling occurring? Okay, and what do I mean by that is, you know, is there a lot of distribution up here? Is there inventory being sold? Okay, and when you got up here, there is 278, 622, so 900 contracts going through right here. Okay, just before the high. All right, fair enough. You get up here, you know, look at some of these. I start to look. The first place I would look is the point of controls. See if there's anything really major that sticks out. Honestly, these are kind of averages, kind of average point of controls. 155, 98. You know, 125, 103, 195, 141, 147. Then I sort of look at where they're sort of occurring. You know, you got this prominent point of control up here, which is indicating to me already supply based on this point of control. And I start looking down here at the deltas. Okay, what I want to look at, are they positive or negative? They're negative. How's the volume? It's good. It's above average, 1,100, 1,000, 958. You know, other than this one bar here is 1523, you don't really see anything above 900. You know, even in the bar that you broke up here is 900, but everything else is, you know, relatively lesser. You know, here's earlier, an hour earlier, you got a couple bars with some 900s, but everything else is 500, 600. But you're trading heavy volume up here relative to earlier. I'll say it's heavy volume in the sense that, oh gosh, we haven't traded this volume in days. No, relative to earlier, 1,000, 958. And market's not really going anywhere. It's just going sideways. So I know that there's volume being transacted, and it's slightly tilted to the negative side. 154, 60, 96, you know, 200. Then boom, you get the big push here. 1954 and strong negative delta, 194. Right before it drops off. This is that everyone. To me, this is up here. You have the longer term traders selling their supply, and then the short term traders are coming in here, and that's contributing to this volume here, and we get that push lower. You know, when you're trading at a low, that's the same thing. You know, what's going on in the market? Like, what do we know, so to speak? You hit that low, we rally up, come back down towards that low, prominent point of control. Okay. what's going on with the volume? We got the big volume push here, 2,900, 3,800. But look at this. Positive delta, positive delta, positive delta, positive delta, positive delta. You're getting positive deltas as you're making new lows on fairly strong volumes, right? 2,900, 3,800, 2,600. Finally get that little bit of a pop up. So I know that, you know, every time we're coming down here, we're pounding through here. There's counter buying in here. You know, people lifting the offers, people lifting these offers to turn it just positive. Positive. So there's buying coming in here. You know, people are saying, oh, you know, it's just a matter of, you know, can that buying, is it enough to support the market? You know, is the selling that's happening, is it enough to push the market lower? If it's not, what's going to happen? The market's going to rally, right? So every time it comes down in here, you know, you have more sellers in here. What I mean by more sellers is, you know, on the offer, right? Look at these. Why do you have positive delta? Okay, so like for example, this bar right here. Okay, compare 314, right? Look at these offers, right? 254, 200, 499, 363, 286, 196. You got very healthy offers, very healthy offers. But there's people buying those, right? So you got people offering it down, but people are still buying it. You got very strong volume here on the bid side, 371, 200, 198, 272. So you have people working bids, but they're also not afraid to be buying these offers. They know that we're coming into an unfair low, an unrealistic low. Finally get the bounce up. And then down over here, we got the prominent point of control. Look at this, 198, 131. You know, they're buying. This is their, for the long-term trader, this is their whole thank you for coming back down here and giving me more opportunity to get long before the market pops back up. You know, look at these volumes here. It comes down, the heavy volume here. Then it's just, you know, sort of average volume gets really dry. As you come down here again, you're making this next run down here at this low. Do you think this low is going to get taken out on volume of 500? 700? Most likely not. You know, you come down here, you're pounding through this 2,900, 3,800. Even here is 2,600 as you make that new low. But here it's, you know, it's like 1/5 the volume. So people are down, and, you know, the sellers are like exhausted. Oh shit, man, we've been selling it down in here. I had to cover here. Let's try it again. Let's take another run at the low. They're getting tired. And then they're met with the big passive buyers down here. You got the prominent point of control before the market rallies back up. Here you got some positive deltas, but nothing major. 36, 47, 8. You know, these are relatively small positive deltas. In here you get the nice big positive delta with a nice big positive volume before it pops right up. So when you get down to a low, ask yourself, well, what's the sign that we can go lower? You know, you always want to be looking for signs of lower activity. And, you know, just the first place I'm going to look for is the deltas and the volume for the bar. 2,400, okay. Made a new low, 3,800. Okay, small positive delta. You got a divergence. Then it's just going sideways. 121, 14, 89. I'm talking in absolute terms. 104, 27, 19. I'm not really not getting too excited about this market rallying on such small positive deltas. 19, 14. Yeah, 104 here. Even the negatives are still kind of small. To me, it looks like a market going sideways. If we come back down here and test this low, take out this low, I think it can go lower right there. I mean, obviously it does. Boom, that's where you get the big volume surge right there. As you take out the low, maybe some stops got triggered. Then here it looks like it's starting to bounce up a little bit. You got this bearish prominent point of control in here. So I look what's going on. Why do I got a big positive delta, 348. It's your biggest positive delta ever, or not ever, but on this chart at least. Well, why do you have the positive delta? It's because I know that there's some passive sellers in here, right? It's a prominent point of control, so it's telling me that there's resistance in here. I look at the chart, 101, 143, 76. You're at the top 31. So I know that there's sort of this pocket of sellers up in here. That's why you have a positive delta on the red bars, because market starts ticking up, but there's some sellers in there that are absorbing all the selling, all the buying that's going on. Then I sort of see this market go down, negative delta here, negative delta here. You got positive delta. Point of control is the bearish point of control sign, talk about in the point of control course. And then the market just drops down further. Again, I'm not sure I'd be getting short right in here. But if we're going to take out this low, I'd be looking for a breakout lower. Take out this low, also again be looking for a breakout lower. Long-term institutional selling takes longer than buying. Okay, long-term institutional traders are more cautious when it comes to selling than buying. Think about it, right? If you sell too quickly, and supply and demand paradigm, people's thoughts are going to shift, and other traders are going to pick up on it and join the selling, and then the market can start trading lower, and eventually everyone's going to sell at lower prices. It's like if you've ever sold stuff, for example, on eBay, okay, and it's something that a lot of other people were selling. It's what's called the race to the bottom. And say you're selling a Chicago Bulls coffee mug, right? And everybody else is selling the same mug. Well, to get more sales, you're going to lower your price. Well, then eventually everybody else starts lowering their price to capture those sales. And the next thing you know, what the coffee mug you're selling at $15, everyone's now selling at $9. And it's the same thing in the markets, right? If you start selling, dropping your prices a little too aggressively, everyone else is going to start catching on to that and start lowering their prices aggressively, and you're no longer be able to sell at such a nice yum profit. You gotta sell at close to break even, which is not really a good business model, but a lot of people do it. And you can see up here, right? This is crude oil, so we're at this highs up here, okay? And this is what you like to see, the market going sideways. If you got some selling to do, right? You don't want the market to immediately start selling off, right? You want to try and sell as much as you can, as close to the high as possible, right? It's almost like a game for traders that are trying to move sizes. How much can I get off without moving the market? Now, on a footprint chart, unless you're really in tune with analyzing the volume, I suggest going to a delta chart and seeing, take a look at how it's transacting, okay? And what you're looking for is, is there offers? Is there offers? Now, you're thinking, well, it's only 10 and 15 and 22. That's not much. Again, this is a delta chart. It's taking the delta between what was traded on the bid, what's traded on the offer. And, what it's telling me is, up here at the high, it's mostly trading on the offers. So there's supply up in there at the high. If we were going to take out this high, well, first of all, we'd be on the other side of the high, but you would probably be seeing some bid, market going bid over, right? Market, traders lifting the offer, turning it bid. Instead, it's running into resistance at the tops of all these bars here, before heading on down where you get the bar here like this with all the pretty much everything traded on the bid side, right before it goes lower, and I'll look at the volume, 8,000, right? That's your push. That's all the other traders coming in, finally realizing that there's somebody up here selling, some supply up here, and coming in and joining in the selling and pushing that market down lower. There's a lot of the price action traders, this is where they're getting short in here, but if you could read what's happening, you could be getting short 10 ticks above that area before, down here at 15, you'd be getting short at 25 and 30 instead of 15 and, well, I don't even want to say 20, but around the 15 area, you're getting in much earlier. Now, the reason long-term traders trade highs and lows differently is they have to, right? Long-term traders are going to be more inclined to place offers at high prices rather than hit bids, so as not to show their selling pressure to the market. This passive selling can be detected in the order flow. And they're more inclined to work offers into a rising market above the current price so they can take profits on inventory. They don't wait for the top to be put in necessarily before selling. They know there's going to be people buying. Okay, so they're happy to oblige and sell it to them. So these are, they have their profit target in mind from however long ago, and they have offers in the market. And for example, like market's going up, right? They're the ones. That's why you see sometimes when you're making new like life of contracts highs, you think, well, there shouldn't be any resistance up here. But then you look at the the depth of market, and then you look at the footprint chart, and you're seeing, wow, you're trading 5,000 contracts here, 2,000, 3,000 here, 3,000. What's all that resistance coming from? That's the long-term traders. And it's important to be able to realize that in a rising market, that's when a lot of retail long-term traders are going to be selling, because it's easier for them to sell in the rising market than it is in a falling market. Now, I sort of touched on this a little bit earlier, about 10 minutes ago, but I think I might have confused some people. But long-term traders are often the traders responsible for the way the day's range develops, right? When they're active in the market, often they will have a wide range. The market will have a wide range. If they're absent, the market's going to have a narrow range, right? Everyone talks about these narrow range days. If you've never read Toby Crable's work, I suggest get a copy of it and read it. It's the narrow range days. And what makes it so powerful, right? And Toby Crable was famous for the opening range breakout, even though people like Larry Williams and Tom DeMark had been working on it a long time before that. But they worked all together. They all know each other, actually. But what makes it so successful is when you have these narrow ranges, it's because the long-term traders aren't active. And then when you start breaking out, that's when the long-term traders are active, right? That's what's causing the trend, right? Because you go from the narrow range day to expanded range days. That's when, it's like a rubber band, right? You wrap it around your finger, gets narrower and narrower, then you let it go, then it unravels and takes off, right? And that's how the market is. Once the long-term traders start participating in the narrow range, they're not there. So it's important to learn to recognize their activity in the market in the footprint charts. And the easiest way to detect the long-term traders is through an increase in volume. So what's going on up in here, right? This is E-minis. Again, all the charts in here are 5-minute charts for continuity's sake. So look, you're making the new highs, 42,000. You're up here at your high, 29,000. You're still trading relatively decent volume in here, 21,000, 16,000, and it sort of dries up a little bit. 10,000, 16,000 again. You make that push. Look at this volume up in here, 1184, right? This is what I'm talking about, right? When market's making new highs, look to see, if there's that volume, right? On this move up, you can see it in here. This area up in here, 2,500, 3,600, 3,100. Market's chewing right through that. Even up here, you're seeing 2,000, 2,000, 2,000, 2,000. Normally, right, during the regular trade, you're seeing around 1,500, 1,000 to 1,500. But this is the supply, right? You got the longer term traders, they're layering in their offers in here. And you can see it even up in here. You trade 1184 on the high. All right, normally your high of a bar, you're looking at volume of 100, a couple hundred, if that even. But there's someone in here with supply. The market starts coming off. Even here, you're thinking, wow, look at this. All positive delta, no min delta, nothing, zero. Max delta 3,000, final delta 1912. The reason you have it is because you have a lot of supply up here near the highs, that people are lifting these offers. You got 388 versus 640, 0 against 1184. So you know that there's supply up in here. And then here, okay, big volume, big delta. Why isn't the market going higher? Why is it all of a sudden trading lower? That's not a good sign. And then here, you're getting some selling imbalances coming in, negative delta. Here, small, again, an inside bar, narrow range. And then people start coming in and realizing, hey, you know what? We're sort of at an unfair high. Start selling. Volume starts picking up as people, the long-term traders, they've been smart, right? They're the ones selling up in here between, between this high and this high, and then once you come back in here, notice how fast it moves. Big bar down, very fast, heavy volume. Remember, the long-term traders are often going to be the ones that cause trends and keep them moving in a direction. It's sort of like, adding lighter fluid to a fire. You start the fire, and it starts, it's okay, but you want it to move faster, so you add more lighter fluid. And if the long-term traders are participating in the trend, it's going to gain strength, right? You're adding more lighter fluid to the fire. If the long-term traders stop participating in a trend, the short-term traders have to pick up the slack. And when the long-term traders are active in the market, their buying is the catalyst to push prices higher, or the selling to push prices lower. And what do I mean by that is, a trending market with long-term buyers, right? You're going to be looking for supportive buying. You're going to be looking for aggressive buying. Where's the volume? Boom, 27,000, 22,000. Deltas, 8,000, 4,000, 2,400. Is the market going in the direction you expect it to with those numbers? Yeah, it is. It's when the market stops going in the direction on those numbers that you got to be aware of, okay, are they stepping back now, or what's happening? You really have to think, as a trader, you got to think about what's going on and put it together. On a nice trending market like this, right? Boom, big green bars. That's how you know if longer term traders are coming into the market. Are you getting the big range days? So the long-term trader is not just looking for a fair price in the market. Of course they are, but they're also looking for an advantageous price or an opportunity to trade at. Their mentality is completely different than a retail trader. Retail trader thinks, oh, I got to take this trade because the green arrow appeared, or the red arrow appeared, or we crossed this moving average. The long-term trader doesn't think like that. Generally speaking, the long-term trader is always going to be thinking whether the market is either trading above or below market value. Is the market currently trading where it's valued? Then they don't have an opportunity, right? And again, if you're familiar with market profile, you understand the whole concept of the value area. Where are you trading relative to the value area? Now, the long-term trader doesn't generally look at volume in deciding to trade. They don't think, oh my gosh, we traded this, got a bar with big volume. I gotta, everyone's coming, I gotta get active. They're already participating in that by working their offers on this move up. But what a lot of people fail to realize is long-term traders actually participate when there's light volume, right? They're the ones that provide the bids in the market when the market's selling off and price is getting exhausted. When sellers are trying to sell more to move the market lower, but it's the big long-term trader that is there to absorb everything. Just as the retail traders are coming in, everyone's buying, tripping over themselves to buy. Market's making new highs. Well, who are they buying it from? They're buying it from the long-term trader. And often at those extremes, you get light volume. Now, another way to look at it is, okay, here, right, we're making these big new lows. As you're making the lows, look at these volumes, 33,000, 35,000, 33,000, 33,000, new low, new low, new low. Then you come down in here, you're making the new low, 26,000, 19,000, 21,000, 15,000. You're making new lows on less volume overall, 26,000, 19,000, 21,000, whereas here you're doing it on 34, 33, 33. Well, do you think this new low is a strong low? Why? You got, even though you got the big negative delta, right, which is encouraging, and you think, oh, we probably make new lows, but overall, the overall picture is there's less people interested in selling down here than there was earlier, right? So it's actually a bullish sign. You still have the buyers there. You still got the guys working their bids down in here, absorbing all this. Here you got 1850, 1824, 1500. That's what's absorbing all this. That's why you got such a big negative delta, is because you got big passive buyers in here absorbing all the selling that's going on. Finally, the sellers are like, I can't do it anymore. You got the small inside day, and you got a big positive delta in here with some buying imbalances. All these people are like, I can't. We're not going lower. Let's cover it, take our losses, look for the next trade, and the market starts trading back up. So for the long-term trader, long-term institutional trader rather, what matters more is managing the position than finding the perfect entry and exit. Short-term traders, they got an advantage actually because they're quick and nimble. They can enter quickly and exit quickly without worrying too much about liquidity. They can wait for a trend to start before they get in. The longer-term trader is trying to catch a trend before it happens, and then ride it once it starts. It's going back to this chart, right? They're buying, buying. Okay, they're getting in down here to catch this trend, whereas a shorter term trader can recognize that we put in this low here. Okay, now I want to get in here to catch this trend. Whereas the longer term trader is, he's not looking at the trend for the rest of the day. He's looking at the trend for the rest of the month in that sense. So being a long-term institutional trader has its own problems that retail traders don't face. Retail trader has no issues with liquidity. Institutional traders' order size is big enough to create liquidity issues when getting into and out of a position. For the long-term institutional trader, already holding inventory, buying into a rising market is going to help him because the current price is going up. He's making money. But if he's long and looking to get out, he needs to sell into a rising market, not a declining market. Again, that's what I was referring to with the race to the bottom in terms of selling into a declining market. Ultimately what happens is you're going to lose money, whether you're selling coffee mugs on eBay or whether you're selling S&Ps. So don't compete with other sellers. Institutions need liquidity in the market. And it's easier to find liquidity if you're a seller in a rising market than a declining market. Think about it. What causes the flash crashes? Lack of liquidity. The market makers all backed off. The algo stopped. They all shut down. That's what caused the big price swings, right? But in a rising market, everyone wants to buy. Everyone's falling over themselves to buy. In a declining market, if it's what you're looking for, you need the institutions to be the ones buying it to stop the price drop. So where's price going to drop and stop is when you have the long-term institutional trader coming in there providing that liquidity. And like I said, on a rising market, you have a lot of volume because everyone wants to buy. So on a declining market, you tend to have less volume. And it's going to stop when there's, when you get the big buyers coming in. Selling into a rallying market, this is what it looks like, right? You see, look at this, making these new highs. Crude oil. Look at these volumes transacting here. Just at each level, you got, this is about 600. Here's 1,000. Here's another 1,000, 1,100, 1,000. You're trading good volume, whereas earlier, you're trading, maybe a couple hundred at each level. So as the market's coming in, rallying rather, the sellers, the long-term sellers are coming in. They're working offers. They're hitting these bids. This is very attractive to them. They're hitting these bids as well. You get that inside day, or inside bar rather, with a lot of sound imbalances. It's still a bit yummy for them up in here. They're hitting these bids. Finally get it to trade down here. Comes up a little bit. Again, you trade some heavy volume up in here and it comes down again. You're looking at this. Oh yeah, I got a stacked buying imbalance. I got all these buying imbalances in this bar. Strong delta, strong volume, everything. We're going to the moon. Well, what's happened is you have a lot of people, you have a lot of big sellers offering out supply up in here. You can see that. Look, compare the volume at the top of this bar compared to the volume down here. It's just much thicker up in here than it is down here. So it's telling me that there's, these longer term traders in here offering the supply out. So why is the difference between long-term institutional traders and short-term traders important? It's because the long-term traders tend to trade against the short-term traders, slash, I should say, the short-term traders slash retail traders. Long-term traders generally don't trade against themselves. I mean, they trade amongst themselves in the cash markets, but in the futures markets, they're not really competing with each other. Short-term traders create market excesses which result in highs or lows that draw in the long-term traders. And long-term institutional traders shift the supply and demand paradigm, which draws in the short-term traders. So what you have is, each one sort of complements each other. The short-term traders are going to sometimes push a market too high or too low, too fast. That draws in the long-term traders. Whereas the long-term traders, by accumulating or distributing a position, are going to attract the short-term traders in. So, they work together in that sense. So when the market's experiencing heavy volume, the long-term traders are showing their commitment and confidence in the market. Forget about the order book, forget about the depth of market. What matters is what's traded. Forget about trying to look there, say, oh, I see this on the offer, I see that on the offer. Oh, this, that. Orders going in. What matters most is what actually traded, and volume is one piece of market information that can completely change the supply and demand dynamics. A perfect example, coming down in here, boom, stack selling imbalance, make the new low, heavy volume, and then you just start going sideways. You got the inside bar, but what are you seeing down in here? You see positive delta, of course, but you're seeing the aggressive buying coming in here, right? You're seeing it in the volume. Do you see a lot of aggressive selling after this low has been made? No, what you're seeing is blue. Yeah, you should see some reds, but two selling imbalances in a sea of blue. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 13 buying imbalances versus 2 selling imbalances. What do you think is going to win? And of course, you got the positive deltas to go with it. So the $1 million question is, are longer-term traders smarter than short-term traders? In some markets, yes. But other markets, like individual stocks, I honestly doubt it. I have my doubts. Generally, in markets like futures or forex, long-term traders have access to information. The general public just doesn't. In equities, retail traders, I think, have they're more active than commodities. Commodities are you get a lot of, I think a lot more commercial activity in there. Now, in equities, when I talk about equities, I mean individual stocks. Retail traders have their own money at stake and can scrutinize all the corporate information about a stock. When you got your own, when you buy your Apple stock, you're doing your own research. Sometimes let me just say, a lot of these hedge funds, these stock funds, underperform retail traders sometimes. I know a lot of people that work for big firms. Yeah, I'm an equities trader. Well, what's your return? They're shy. I go run to the bathroom. Like that. They don't want to talk about it because they think they're smarter than other people. But the difference is they don't necessarily. They think, well, I'm on a conference call with the CEO, so I have privy to information. But I find that retail traders, at least in equities, have just as much access to the same information that the institutional trader does. But then when you start going into futures and commodities, when you're dealing against firms that are actually producing stuff, the end products, the Procter and Gamble's, the Unilevers that buy the commodity to make something, they know the whole distribution chain. Whereas the equity analysts, again, they sometimes they think that they're the smartest person in the world, and it's a different mentality. But the main difference is long-term traders are the ones who provide a lot of liquidity and start trends. Right, a trend in any market cannot be sustained unless there's institutional activity. So keep that in mind, right? Most of you that watch my courses and trade futures. So that's why I sort of wanted to differentiate the long-term traders and the short-term traders for you, so you can understand the difference. That even in institutional traders, there's long-term traders and short-term traders, and it does honestly, it's not something easy to pick up, and I think it takes time for you to really understand. But I think for some of you, the light bulb will go off. Others, it will flicker. Others, will stay dark. It takes time. Yeah, honestly, it takes time to look at a chart and sort of figure out what's going on. I guess the main takeaway from this lesson is keep in mind that in a rising market, you're going to have institutional long-term traders offering out. It's not that they necessarily wait till the market turns to start selling. They're selling on the way up, whereas the short-term traders will wait for the market to turn and then start selling. I guess is the main takeaway from this course. So that concludes Module 2. In Module 3, I'm going to discuss recognizing absorption, what are the early signs it's happening, so you can take advantage of it as soon as possible. So I'll see you on the next module. Thank you, and I'll see you there. Bye-bye. Hey everyone, it's Mike, and welcome back to the Orderflows Absorption course. This is Module 3, Recognizing Absorption. Now, before I begin, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right, absorption. Now, absorption is measured by analyzing passive trading activity. Most traders only look at aggressive trading activity, which is what moves the price up and down. But absorption can be seen in sideways activity. One of the drawbacks in analyzing passive activity is you don't know if it's profit taking or a new position. However, a trader in a position taking profits is more inclined to move his passive order to an aggressive order if the market starts ticking away from him. After a big move up, the first signs of aggressive selling is most likely due to profit taking than supply hitting the market. So when you see a move up and you start seeing the bids getting hit, usually what it is that's not supply coming into the market per se. Usually on the move up, when you see the big offers, that's the supply. But if you start seeing the bids getting hit, you start seeing the selling imbalances up near the high, what you're starting to see is possibly new orders, new positions rather, coming into the market. So let's take a look at sideways absorption. Okay, so sideways absorption is usually marked by heavy volume and price not making new highs necessarily or new lows, but mostly going sideways. So here you are. Again, it's the E-mini, it's 5-minute chart. And you notice we have this big sideways activity here. Okay, you have some volume in here. This bar here at the high, 13,000. 12,000 here. This big bar here, 18,000, 19,000. So you see these bars here starting, okay, after this big push up, you're looking at these bars here, 12,000, 12,000, 13,000, 12,000. Come in here, 17,000 again. You're in this area of sideways activity. You got some decent volume, right? You got some light volume, 7,000, 5,000, 8,000, but you got strong volume, 12,000, 12,000, 15,000. Market's not really going higher. Then you got the big heavy volume in here, 17,000, the big down red bar with a couple selling imbalances, stack selling imbalances in it. Volume is high. I mean, you had the big volume here, 18,000. That was your big push up. Now your big push down is on heavier volume than normal, but you're churning in here with above average volume. Normally your volume is going to be around 10,000, but here you're pushing 15, 12, 10, 13,000, 12,000. The market's not going anywhere. It's not going any higher, right? You're expecting this market to go higher. Now, obviously, one of the reasons why is you have, look at all this negative delta, negative delta, negative delta, negative delta, negative delta, negative delta. Every time it tries to poke higher, you have someone coming in there sort of putting their foot on that market, holding it down. Now, don't confuse consolidation with absorption, okay? Consolidation will happen on light volume, and it's going to happen usually in front of a data release or a speech or something, or big news that everyone's expecting to hit the market. And you can see here where it's going sideways. You look at this volume, 1,700, 1,400, 1,300. When normally you're pushing, several thousand, 2,000, 3,000, 1,900, 2,000, 2,005, 5,000, 5,000, 4,000, 7,000. Here you're just trading 1,700, 1,400, 1,300. Then obviously, it's 1 o'clock. Something happened here at 1 o'clock. You got the big volume expansion, 7,800. Another big volume expansion here, 15,000. This is congestion, or sorry, not congestion, consolidation. All these terms start sounding alike after a while. Consolidation is marked by light volume, and it's market that's quieting down because people aren't really interested in trading right now for whatever reason. Like I said, it could be a speech, there could be a data release, whatever. People are anticipating something to come out shortly that they're just waiting on the sidelines for it. And then obviously you see what happens. Boom. So understanding when a market is experiencing absorption is important, because you're in a trade and market starts trading sideways, it can be either a sign of absorption or accumulation or distribution. Now, if it's absorption, the market has a good chance it will reverse. Now, not always. It can pause and go in the original direction, but for me, the way I treat absorption is I use it for reversals, right? I'm looking for a market to reverse. So if it's accumulation, generally, or distribution, the market is going to resume its move in the original direction. Now, distribution, I'm sorry, I shouldn't have put that in there. It's a little misleading. Generally, with distribution, what you're looking for, people don't necessarily think of distribution as market selling off, going sideways, then market selling off some more. Usually when people talk about distribution, it's at a high a day, market selling off. But generally, accumulation and distribution, in general terms, people are looking for it to pause and then continue on in its original direction. Whereas for me, absorption, I'm really looking at it more as a reversal, but it doesn't necessarily have to be a reversal. So strong uptrends do not break easily, okay? As the market keeps moving up, it attracts additional buyers until the market reaches a point where it's trading too far above value, where traders start to notice how far away from value the market is currently trading, and where they can start selling. See what I talked about on the previous lesson about price exhaustion. So on this price action, traders late to the party start getting long, usually trend traders. Trend traders tend to be breakout traders, and push prices up where sellers are happy to sell more supply. Now, again, you always hear these fantastic returns of trend traders, but what you don't hear often is, trend traders are right maybe 20% of the time. Because why? Is because the market's not always trending, and what happens is, they get this breakout, then supply comes into the market and the breakout fails, right? You only hear about the times it doesn't, when it's a legitimate trend and it haven't reached an unfair high, but it happens more than people realize. So eventually the buyers dry up and the move starts ticking, and the move down starts picking up. That's a bad way to put it. Eventually the buyers dry up and the move down starts picking up steam, starts gaining momentum. I should change that, because you see move up and then pick up steam, but gains momentum on the downside. Momentum to the downside. And this is where you want to get short. Okay, so for example, a strong uptrend. Why you want to fight it? Why you want to fight a strong uptrend? Okay, I'll be honest, in here it looked like possibly this trend could be ending. And then it just goes sideways with the small deltas, 285. And then it picks up very strongly again here and keeps going up and up and up. Okay, this is, for your accumulation and distribution people, accumulation mode right in here before it keeps going up. Now, would I call this absorption? No, because the volumes are quite light still. 3,000, 6,000, 6,000. In here, to me, this is more signs of absorption occurring in here than in here. This is, to me, is accumulation. Why would I consider this absorption? Volumes are bigger. The net volumes are bigger. 22,000, 15,000, 16,000, 18,000, and then 16,000. I can see what's trading on the bid. I can see what's trading on the offer. I know that these are relatively strong volumes. Again, I'm not I don't really have any strong bearish signal coming in here to get short. Right, this bar here, look, possibly could be, you know, a good sell signal. Very strong negative delta, 1400, but the volume is kind of, you know, light relative to what it was earlier, 16,000. Now, if this was, you know, the volume was minus 17,000, I'd start to be a little bit more worried rather than the market going sideways for right now before continuing on. So notice here, right? I put the question, when did it break? Right, you're rallying up. Strong deltas, 94, 423, 1300. Look at this volume, 5,000, 10,000, 14,000. You know, you're averaging about 5 to 8,000 before. Here's 6,000, 5,000, 8,000, 5,000 again. 10, 14. Then it just starts pausing in here. Now I know by looking at the order flow, I got a nice point of control on the extreme up here, which is a very bearish sign. You know, everyone talks about like, oh, these, you know, the iron cross sell signal or something. When I see this, the only thing that would have made this like kiss of death for this market is if this occurred on the high. But you know what? It's one tick off the high. It's its own bar. And, you know, it's a red bar as well. I still got to respect that, even though it's not on the high of the day. You still got to pay attention to that. That's still a very important signal. So I know I got this volume here. I mean, what's happening? You got 800 traded on the offer, 400 traded on the bid. It was bid here. We went bid, trading bid offer. Well, it was trading bid, it wasn't trading the offer, but the market was bid here at 69, offered at 70. Just couldn't trade there because the sellers were in there hitting it. You know, previous bar, you got a selling imbalance. So even when it was bid offered here, people were hitting this bid, caused that imbalance. Went back in here, got up here, starts rallying, looks like we're going to come back up. People are still hitting that bid. That's why this one is so important. Then notice the volumes. It just goes, reverts back to normal, 5,000, 5,000, 5,000. Again, what am I looking for in here? Other signs. Well, this obviously, this point of control is a very bearish sign. Selling imbalance, selling imbalance, selling imbalances in here. You do have one buying imbalance, but this is actually a bearish buying imbalance. Why? Is because market starts ticking back up. You get this imbalance here, 85 against 477, goes bid, 194 against 3. People are selling that bid, and then it just drops off dramatically here. Comes down here, you get the green bar. Looks like it's coming back up. Hey, you got a stack buying imbalance. That's it. We're off to the races again. We're going to hit the highs. But lo and behold, boom, strong negative delta, back to strong volume, 8,000. Again, you know, what were you looking at here? Other than this bar at 9,000 and this bar, that big push up, you got 4,000, 4,000, 4,000, 5,000, 5,000. Big negative in here in the tenths of delta, minus 1,000, minus 1,000. Selling imbalances. Again, the trigger, understanding it, is this heavy volume up here at the top of this bar, right off the high. Even in the previous bar, 1145. So what are you looking at? You're looking at about 2,500 traded right here on the offer up here. Next level, also about 2,500. Next level, it's about 3,500. 4,500. So about close to 5,000 contracts traded here. Massive volume right up in here. It's understanding what's going on. People are selling it up here, right? And showing up here in the volume. You can see a lot in here, to a lesser extent here. So absorption is going to tell you when momentum is stopped. Like I said, right up in here. The market has been selling off, taking out lows. All the shorts are happily counting their money. You know, the market hits a level where they're passive buyers waiting for the market to come to that level, right? So what's happening when a market is selling off? Everyone's short. Hey, let's get short to join the party. Counting how much money they're calculating on their, you know, I look at my bottom line on my Ninja Trader or whatever and see how it is. But then all of a sudden it hits that level where there's big passive bids in there. People sitting on the bid, just waiting for them, you know, trapping them, you know, like I call it a sleeper cell. The buyers awaken and start buying more, not wanting to miss the buying opportunity at the low prices. The aggressive buyers start coming in and buying imbalances start appearing. Delta's getting stronger, but after a few bars, prices aren't really going higher. Delta's contracting and no imbalances for a while. What's happening? Momentum has stopped. Now maybe absorption. So what that means is markets come down in here, starts rallying up. Then possibly you're running into some absorption in here again and continue back up. Excuse me. So you coming down, buyers waiting in here. Look at this volume, 200, 130, 138, 181. You get down here, 173. Aggressive buyers start stepping in, buying imbalances, buying imbalances, buying imbalances. Very bullish sign in the point of control right here. Even here, these 5 bars is very, very bullish. More buying imbalances. You get the big volume push. Okay, can't go any higher. You get the inside bar, which is a sign of possibly market going sideways. Starts going sideways, but at that point, what I'm doing is is there a sign to get out yet? Not really. Still got some positive deltas. Volume is, this bar is nice, 2,000. This bar also nice, 2,000. So there is some support in here. It's trading. Oh, this bar is the 2,000. This one's 1198. Come down here, 126. Point of controls side by side. Again, that's also supportive or resistant in the market, depending on where you're trading. Start trading a little bit higher, it's going to be your support. But look at this. Selling imbalance, selling imbalance, selling imbalance, selling imbalance. Now, I've talked about this in the imbalance course. When you see selling imbalances in green bars, do you think that's bullish or bearish? Right? Selling imbalances should be in red bars, not green bars. And what that's telling you is you have supportive buying in the bar. Supportive buying. Supportive buying. Supportive buying. I prefer them to be lower than right up here at the top, but this one is still nice. This 133, the 15, it's kind of small volume. This 84 is very telling. But down in here, 74 against 18 towards the bottom of the bar, that's also very bullish. You've seen a lot of bullish signs in here of supportive buying. That's what you need on a trend, right? You need supportive buying, some signs of supportive buying. It's nice if you could get all the signs appearing at once, but sometimes, you got it here with the point of controls, supportive buying. It's very bullish when you have the point of controls in green bars lower than the previous green bar. It tells you the market tried to push lower, but there was supportive buying in there. Just as you have it here, green bar, market comes in, starts trading lower, but you have supportive buying. Market goes up, supportive buying in here. Supportive buying here, supportive buying in here, and the market continues up. That's what you need in a trend, and that's a sign of absorption. Buyers are absorbing the selling going in here. It's like a fish swimming upstream. It's like you're trying to go against the current. Don't go against that current. Don't think, oh my gosh, I got to stack, I got this 74, I got a selling imbalance, I got to get short. No, if it's a green bar and you got that selling imbalance in there, be very wary. Don't think the market's going lower. If it's a red bar with selling imbalances, yeah, that's what you expect to see. But if you start seeing green bars with selling imbalances, you got to question it and take it in context with what's happening in the markets. So here's what is this? Gold. Okay, most of my charts have been E-minis and crude oil, but I'll show you other markets. This is gold, and what do you have here, right? New highs. Like, remember what I was saying earlier, right? Long-term traders are going to be selling at new highs, right? As you're going higher, that's their opportunity to get out. Because if they start selling in here, notice how many bars it took to get up to this high up here, right? Well, not counting this one, 1, 2, 3, 4, 5, 6, 7, 8 to get down to this 13, 19 level. So it took 8 bars to get up there, but 1, 2, 3, 4 bars to get back down there. So it got back down in half the speed. Why? Because once people start selling, it's got more of a snowball effect. I think the downside moves faster than the upside. And notice all these selling imbalances, 1, 2, 3, 4, 1, 2, 3. That's very bearish. Double bars with basically multiple imbalances in it. And even on this move up, you're seeing these selling imbalances in the green bars. You have your very bullish signal. You would think that that's bearish, right? Oh, I got 31 against 125. That should be bearish. Why is the market going up? It's because people are supporting that market. 125, 135. Even up here, you see the 118, 100. As it's going up. But here, even as you're going up, look at these volumes on the upside, right? 400, 300, 297. 400, 300, as you're making out new highs up here, 400, 300, 200, 200, even up here, 200, 133, 117, going higher on relatively stronger volume, 4,000, 2,000, 2,000, 3,000, 2,500, 2,500, relatively, to earlier, you're looking at, a 900 to 2,000 area in between these bars, total volume. And then boom, you get the big slam down, 2,500. A little bit lesser volume here, a little stronger volume on this move down. But the sign was up in here. You could possibly be getting short. Market did rally back up, but why? It came back in here. You met some passive buying, 347, 180, 113, 199, 415, 190. So you got this supportive buying on the move back up. Look at this. This type of bar, I could do a course on sort of bar shapes. That's not something that many people really talk about, but this is the type of bar that's very bullish. Notice you got two price levels, each, 52, 13, 41, 67, 66. It's in the double digits. Here it's in the triple digits, 138, 192. That's a very bullish shape. If you were to do shapes as like women's body shapes, like down here, 150, 119, 114. The bottom price level generally is going to be very limited volume, just because it's based on where it is. It's at the low. But up here, 23, then 11. But if I'll do a video on that. People will say it's ridiculous, but you know what? Sometimes the simple things is what's most profitable. So again, it might be a little bit easier to see on the delta chart. This is the delta chart. It's the same chart here. This is just the delta one. This is the volume footprint. This is the delta. So as you can see, 119, 72, 25, 40. You're seeing some big pockets of volume in here. Just as you're going up here, right? The offers. Look at that. It's mostly trading on the offers. Mostly trading on the offers. Mostly trading on the offers. But when it turns, it starts turning in here. All bids, except for that one on the high. Mostly all bids except for one. That's where you're getting short in this bar here. To catch, it's a big move. It's $2, but hey, $2 in the gold is not that bad a trade actually. So what's happening at the high is aggressive buyers are coming into the market and lifting the offers, right, as the market's going up. So as the market's rallying, prices going higher, sellers are attracted to the higher prices and start offering their supply on the offer side on the way up. When the aggressive buyers are buying those offers from the passive sellers, that's reflected in the strong positive delta. So again, going back to the chart, aggressive buyers, right? You see positive delta. That's why, that's why it's important to keep your eye on the delta, okay? Because not always at the highs are you going to have positive delta. It's when you start seeing signs of negative delta, it can tell you two things. One, you could have negative delta as you're making new highs. Say there's a big buyer in here. Say someone's bidding, what is this, 13, 20 even for 5,000. Everyone's selling into that. You're going to have a negative delta. You got to look at the charts and understand what's going on. But generally, as you're making new highs, you should have the positive delta. And what they're doing, the aggressive buyers are buying from the offers, right? They're buying. That's how you get the positive delta. But like I said earlier, right, the long-term traders will be selling on the moves up. It's not necessarily the short-term traders. Short-term traders are momentum traders. They're going with the direction of the trade. Finally, the buyers are exhausted because of the excess supply. That's what stops the moves, right? When people talk about price exhaustion, the buyers can't buy anymore, right? They're loaded up to the gills now. They kept buying, and then now they got to stop. They don't have any more margin in their accounts to keep buying. They're already long, and the market's in their favor. They're thinking, oh, happy days. And then that's when the big short-term traders come in and whack that market down. All the retail traders are getting long. The smarter money gets short, wipes them out, and then the market continues back in its regular direction. So again, finally the buyers are exhausted because of the excess supply. The sellers sense that the prices are too high, And it's a good selling opportunity. The sellers don't want to miss out. So while keeping their offers in the order book, they start hitting bids at or around the highs of the day. And it's reflected in the negative delta and sometimes small positive deltas. So they're hitting those bids in here. It doesn't necessarily mean that they're moving their offer down, offering it down, offering it down, offering it down. They're just hitting the bids, hitting the bids, hitting the bids. And then the market snaps back. Okay, so here, what's going on? Big up bar, 12,000. It just stands out. Everything else is, if this was 2,216, it'd be about average, right? But most of these bars, 3,000. Everyone is getting excited. Everyone's coming in. What's happened? Trading that heavy volume up here near the high. The aggressive sellers start coming in, hitting these bids. They're still working the offers in here. 278, 190. Even in here, as the market's going lower, they're hitting the bids, but they're still keeping their offers in here. 180, 217, 720. Even in here, 533, 537, 723. That's what keeps the market going down. Just as you get down in here, right? You're going sideways. Look at this 719. This point of control, right up near the high, 562 against 27. Even when it was offered there, it was 719 traded. You got this volume going through, heavy volume right here. That's what's keeping this market from going back up again. Now, what happens when the market sells off is the sellers get triggered, right? Heavy selling volume comes into the market. Traders are tripping over themselves, hitting bids, and it's reflected in a strong negative delta, right? Overall volume of the bars above average. Then the buyers appear at the low prices. Demand has finally come into the market. That's what's going to arrest a move lower, is demand. And oftentimes you're going to see it with the volume on the bid side. That's why everyone talks about divergences, the order flow divergence, positive delta at a low. But what you also like to see is you like to see heavy volume as well traded on the bid side. Now that runs into a problem, right? Because with the divergence, really what that's measuring is the aggressive buying coming in. But if you have a green bar at a low and it's got negative delta or a small positive delta, pay attention to it. People sometimes they see a divergence at the low and like in the S&Ps, and they'll say, well, the delta is quite small. It's only like positive 60 when all the other deltas are in the hundreds, like 400, 500, 1,000. They say, well, it's got a small positive delta. That's actually the type you should pounce on, right? Because what it's telling you is the sellers were in there pushing the market lower, hitting those bids, but they were being absorbed by the traders, right? By the bidders there. That's what's causing it. And, imagine you have the low, and normally the bar's got a delta of 1,000, okay? But it's got a small positive delta of 20. You might think, oh, it's 20. It's kind of neutral. But what's happening? You're at your low of the day, and you got this small delta. Bars traded 25,000 contracts. You got a delta of 20. Well, chances are, the bid volume and the offer volume is 12,000, 12,500 against 12,500. But more importantly, what you had was people there bidding that market, supporting that market. That's why you got the small positive delta. Let me see. Let me pause this for a second, see if I can find an example. I don't have one in here, but let me see if I can pull one up real quick. Okay, so this is what I mean. Okay, so this 5-minute E-mini chart. Look at this low of the day. Look at the delta, plus 125, right? It's almost, your smallest delta in the... Look at the volume, 12,000. It's decent volume. Previous high volume on this chart, 18,000. Bar here, 12,000 as well. But look at these deltas. 125. This is 1,000, 800, 263, 113. But 900, 1,900, 1,300. You get down here. What's happened is why you have such a small delta. Well, you have a lot of negative delta in here. People are selling this 1272, 1279, 1,000. On the way down here, you don't have that sort of volume. You got, here you got 1,100, 1,600, but you got 700, 400, 900, 400. But the second time you came down here, The bidders were here. They're ready to support this market. That's why you got a small delta, is because you got a lot of negative delta down on this part of the bar, that by this upper part of the bar, it's a lot less, in the sense that people are being aggressive now. So down here, they're very negative, right? Look at the min delta, minus 1200. And the bar finishes at plus 125. So early on, very negative delta, but it was absorbed. All that selling was absorbed here, and the market starts ticking higher. People start lifting these offers, start lifting the offers. Bar finally finishes, not enough time to really turn it a strong positive, but still, it's a small positive delta. Why? It's because you had that big negative delta in here. So don't be thinking, oh, it's only 125. It's so small. It's kind of neutral. I don't want to pay attention to that. Actually, that's the one that you should pay attention to. So getting back to some of this selling pressure, right? So here's the chart. Sellers tripping over themselves. People can't get enough of this. They're selling it, selling it, selling it. Look at this here. They're all excited. Market's selling off. Hey, let's sell. Yeah, minus 1900, or sorry, minus 1600. Volume is 7,000. Then goes sideways. People get excited again. Oh, we're coming off. We just took out this swing low here. Boom, look at this heavy volume, 500, 300. Each of these levels is 500 to 800. Bar's got 10,000 volume. Big strong negative delta, minus 1600. Everyone is, I gotta sell. We're breaking out. We broke out by 2 ticks, and the market snapped back and rallied. Positive deltas coming in here. The aggressive buying coming in. You can see it in there. Now, maybe it's a little bit more obvious on the delta footprint chart of sellers tripping over themselves here. Look at that. All sellers. This is, to me, this is what retail sales look like, right? Not the indicator, but retail selling, rather. Let me rephrase that. Coming in here. Then you get these small inside bars. Look at this bar. It's got 5,000 contracts traded, which is half of what the previous bar was. Delta, again, is small. It's plus 111. But it's not small because it didn't trade much volume. Here you got this bar, 2,500 contracts traded. It's got a bigger delta, 165. Here you got twice as much with a smaller delta. So what it's telling me is, early in this bar, you had smallish delta, negative delta. You had minus 136. But there was some absorption going on in here, right? You got that inside bar. Again, watch for those inside bars after the big push down or the big push up. But again, if you're looking at the delta footprint chart, right, you see all selling, right? These are kind of mixed bars here. You got selling on both sides, buying and selling both sides. Then in here, I mean, look at this pockets in here, 144, 104. You're seeing the supportive buying. That's what you like to see on the way up. So absorption, again, doesn't usually occur at one price level. People like to always talk about support and resistance. They think of it in one price level. Absorption is usually spread out over several price levels. But again, don't fall into it's got to be one price level. People always like to try and project prices to a particular level. You have to project it to a particular area. I always find it fascinating how people use these Gartley patterns and things like that, bat wings, and they'll say, oh, it's predicted it to the tick. Well, so what? If it got 1 tick away, it's a complete failure. Say the market moved 300 ticks, and then, the target was 300 ticks, and I got 298 ticks there, then reversed. Does that mean it's a failure? No, you got to think of it in levels, areas, rather, than one particular level. Now, one of the easy ways to determining absorption is happening is, of course, watch the delta. The delta will increase either positively or negatively, but price won't move with it, right? That's what I was just explaining earlier. So you're coming down in here, heavy volumes in here, you at your low, you got 5,000. This low is 11,000. So you got some decent numbers in here, 7,000, 8,000, 6,000, 7,000. Where's the market going? It's going nowhere. It's going sideways, right? That's when you got to start paying attention to the next level of stuff. Deltas. Look at the deltas. Getting stronger here. Getting stronger in here. You know, you do have, well, you got a strong negative delta, you got a strong negative delta. Yeah, one bar. What you got, you know, if you can string together 2 or 3 bars of strong positive delta that's growing, I think that overrides, you know, a bar of negative delta. Imbalances, what are you seeing? You're seeing the buying imbalances more so than the selling imbalances. Well, people say, well, you got 2 selling imbalances in here. Yeah, okay, fair enough, but we couldn't go any lower. And then I start seeing delta pick up again. You know, I'm not saying I'd be buying down here at this low. I'd probably be buying somewhere in here coming off this low. That's a legitimate buy. You know, where's your stop going to be? It's going to be down in here, you know, at the low, or maybe a ticker, you know, maybe a little bit above it. You know, we got this open space in here to play around with. You got these point of controls, you know, higher. It's starting to look more bullish than bearish. But again, what's going on in here? You got decent volumes, but the market's going sideways. 8,000, 6,000, 6,000, 7,000. It's just sort of going sideways, but starting to creep a little bit higher, right? That's what you want to be looking for. The sign in this case is in the delta. Okay. Here, right? We're making new highs. This is wheat, okay? I figured I got to throw in a couple other markets. I got a prominent point of control up here at the high. You got a ratio and divergence. But here, right, you got divergence failed. Is this one going to work? I don't know. But when I start adding what's going on in the market, I start seeing, okay, well, I got a prominent point of control on a wide bar. You know, here you got a prominent point of control. This one I got to overlook because it's only 3 price levels. Same with this one. This one's a long bar, right? But look at this volume, 669, 115. So imagine what's going on, right? You got people offering supply up in here. They didn't have it at this level. You know, in grains, it trades in quarters. But look at this. You know, here you got 133, 332, 206, 182, 218. Here, 269. Even when it's bid here, right? 569. So you got sellers coming in and hitting those bids. Now you're up in here, right? You're at your high, 1399, 1658, right? You got positive delta on a big down candle. You should be scratching your head saying, what's going on? Why do I got positive delta? It's quite decent on a big red candle down. Then you start looking at it, right? Oh, I got this buying imbalance, 316 against 37. Someone's offering supply in here. Here, imbalance here. So I know at this level, you know, if you do the math, that's, you know, over 1,000 contracts trading at that level on the offer side, mostly. You know, that's a bearish sign. You know, even in here, you know, you still got this red bar, right, with positive delta. Okay, you know, people say, well, you got positive delta, that should be bullish. Well, it's actually, in this case, it's more of a bearish sign, right? You got the buying imbalances. Why isn't this market going higher? It's because you got someone offering the supply in there. Sort of runs contrary to normal thinking, right? You're thinking, oh, I got buying imbalances, I got positive delta, but the market's not going higher. Yeah, that's the whole point of absorption, right? You got to be asking yourself, what's going on, right? If sometimes what doesn't happen versus what is expected to happen is more important when it doesn't happen, right? You're expecting this market to go up. Positive delta is increasing. You got decent volumes in here. Positive delta, imbalances. What's going on? Why isn't the market going higher? It's because you have someone offering it. They're absorbing all that buying. You know, everyone is looking at this. Everyone's thinking this market should be going up. Let's buy it. Let's buy it. But there's a big seller in there absorbing everything. And finally, the market fails. You know, this is one of those trades where, you know, you get short, you just have a stop, you know, a penny away. You know, not, I'm going to say one tick, but, you know, you got to give it a little bit of room. You may get past it, you know, right in here, like you do here. Here you get past it by 2 ticks. But still, you know, this is a trade. You know, if you're getting short here at, what is that, 471 and a quarter, yeah, you got to stop up here, 472 and a half, so about a penny and a quarter. But what's your risk ratio? You know, you're getting short at 471, all the way down, you know, into the mid 460s. You know, that's the type of trades that give you low risk opportunities. You know you got a seller in here. that you can't get past. You've been trying to get past for 5, 10, 15, 20, 25, 30 minutes, and you can't get past it. You want to fight it? You want to buy it? Try and buy it? Or you want to sell it? You should be selling it. So when looking at absorption, you have to look at it occurring over a period of time. I think it's difficult to see absorption occurring on a very short time frame, sometimes like 1 minute charts. I think you can. I know I look at 1 minute charts or 3 range charts. I think it's a little difficult. But if you're looking at a 1 minute chart, it has to be a market that's got decent volume. If you're trading, say, nat gas on a 1 minute chart, you're definitely going to have to look at it over a period of time rather than one bar. I think with very liquid markets like crude oil, E-minis, on a 5 minute chart, you could take it on as easily 1 bar, but even on a 1 minute chart in a very liquid market, you could string together 1 or 2 bars and get a decent look at, is there absorption going on. But a 3 range chart, I think, is kind of difficult. 4 range, pushing it. Again, it's got to be a market that trades decent volume. On short time frames, you can see transactional moves by funds, whereas on longer time frames, you can see the strategic decisions. So again, it doesn't mean that you can't see absorption on short-term charts like a 1 minute chart or a 4 range chart, but you got to put them in context. You got to use more bars than just one. So again, 1 or 2 big orders during a 60-second period can skew the data that you're trying to analyze. So just keep that in mind, right? This is wheat on a 5 minute chart. On a 1 minute chart, it's not going to look. I say not going to look. It's not going to give you much to go on in terms of market direction. Because honestly, on a 1 minute chart, a lot of the bars are going to look like this in here. So keep that in mind. So this concludes Module 3. In Module 4, I'll discuss accumulation and distribution and how it relates to absorption. So I'll see you on the next module. Bye-bye. Hey everyone, it's Mike, and welcome back to the Orderflows Absorption course. This is Module 4, where I'll be discussing accumulation and distribution. Now, before I begin, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right, so a major difference between accumulation and absorption is how the trading takes place. Now, absorption is noted when there's lots of passive activity occurring in the market. Accumulation occurs when there's more aggressive trading taking place at the beginning. Okay, and what is aggressive accumulation? Well, as prices start to increase, so does volume and delta, right? When the trading herd begin to sense that the trend is underway, they start coming to the market. At the same time, the passive accumulators start lifting the offers. The slope of price starts to steepen. The trend is underway. Next stop is euphoria, which I talk about in Module 6 in the trading setups. So let's take a look at the charts, see how it looks. So aggressive accumulation, buying imbalances, that's aggressive accumulation. That's the sure sign of aggressive accumulation. Obviously, the positive deltas, also another sign of aggressive accumulation. Now, where's aggressive accumulation I think more important? Well, I think it's more important near the lows, right? Now, people are going to say, well, that's not really accumulation, at your highs. Well, think of it in this, people are accumulating a position, right? When you think about accumulation, you really want to be accumulating stuff when it's, at the lows. But just because, you're at highs, don't think that we're not going to go higher, because we very easily go higher. People sort of fall into this trap where it's a two-way thing, okay, with retail traders. Either retail traders love buying breakouts and because they think the market's going to keep going up infinity, right? And there's the other sense that they're always looking to short it. But if you're a long-term trader, you're not necessarily looking at, oh, we're trading at today's highs, I don't want to be buying it because I'm going to wait for it to come off. No, they're going to be buying it. They're going to accumulate the position thinking the market's going to go higher and higher. But again, aggressive accumulation. For me personally, I'd like to see aggressive accumulation near lows, just as I'd like to see aggressive distribution, which is the opposite of accumulation, at the highs, right? I want to see the selling imbalances come in at the highs. Just I want to see the buying imbalances at the lows, selling imbalances at the highs. And again, you're going to see it. If you don't see the selling imbalances, look at the deltas. What's the delta doing? What's the delta telling you? You're at the low here, positive deltas. Okay. I know that people are lifting the offers more than hitting the bids. That's what I like to see. How's the volume? Is it light or is it average or is it heavy? If it's average or heavy, that's a good sign. How's the volume? Well, other than the big bar here up at 16,000, these are very decent chunky volumes here. You got 7,000, 7,000, 6,000, whereas earlier you're trading 4,000, 5,000, 3,000, 3,000. All of a sudden you're trading almost double that in here, 7,000, 7,000, 6,000, and it's strong negative deltas. Now, passive accumulation, trends begin when they're slow and steady buying. Slow and steady wins the race, right? Traders are careful not to show their hand by buying too much at once. There's no volume bursts, okay, with passive accumulation. And what I mean by volume bursts, right, when I'm talking about passive accumulation, it's absorption, basically, right? This is where institutional trader has its advantages. I guess I could change that from passive accumulation to absorption, but I look at it the same way. They can layer in their buying and even do opposite trades to give the market the impression there's supply at low levels, right? Now, I don't subscribe to this theory of, you gotta sell 100 to buy 1,000 like that. I've never, other than about 1 or 2 traders in my life, never really met anybody that did that in the markets. It's one of those gray areas. Is it illegal? I don't know what the actual ruling is on it, but if I want to buy, I'm going to buy. I'm not going to be playing games with them to try to jimmy the market. I'm not going to try to sell down sell 100 contracts to just push it lower a couple ticks, attract some sellers in, and come in and buy some more. There's people that talk about it, but honestly, it's one of those things that it just doesn't make sense. As for me and most other traders, when we're working, all our trades that we do, we got to explain, right? And it's a lot of the people I work with, the integrity is, well, why would you manipulate the market like that? So I don't fall into that market, but into that way of thinking. But there's some people do. They say, well, I'm trying to disguise what I'm doing. There's other ways you can disguise than try to be disingenuous to the market. So what does passive accumulation start to look like? Well, you're down here at your lows. You got the positive deltas. But look at this big bar down here, the big red candle. Down here at the bottom, 1,100, 1,200. 1,000, 1,000. You come down in here, it hits this pocket, right? You got the big strong negative delta. Why is the market going any lower? Well, you got some buying starting to appear here. Some more buying in here, more buying. Then it turns aggressive with the positive deltas as the market starts going back up. You went from your passive accumulation to your aggressive accumulation. You take a look at it here, right? You can see how it just comes down in here. Big buying area here. You can see it a little bit in here as well before you hit that low, but really what I'm looking for is when it comes down into this low here. But again, like I said earlier, right, you're going to have, as you're coming down into new lows or testing the lows, look for the supportive buying in here, just as if you're going into highs, look for resistant selling. Comes in here, and then as you get down in here, look how it changes. Mostly aggressive buying. All this bar is almost all aggressive buying. This bar is mostly aggressive buying. Now, if you're looking at a volume chart, now I didn't really talk about this one very much, but this is a volume footprint chart. So it just gives you the total volume. It puts it on one side, so don't think it's all negative or all positive. It's just the total volume at each price level in a bar. And notice as you get down here into this low, look at that. 2,000, 2,000, 1,600, 1,500. Right, even here is 79. People say, well, you got price exhaustion. You got 79, 1,502, 1,600, 2,100. You can, yeah, you can argue that, but really what you're looking at is this pocket in here where the market just sort of came in. That's what I was saying, is like the sleeper cell. So it gets activated, and then people start buying. They did this bar here. This is an interesting bar, right? Thin volume is a big green candle, but you got this big pocket of volume up in here, right? Value area is higher up in here. Obviously, this is where the majority is starting to go higher. It's migrating higher. So passive support. Why do I have accumulation there? That should be okay, so passive accumulation is a form of absorption and occurs when aggressive big selling volume appears, but price doesn't move lower. Prices don't move lower. As the market is selling off, passive buyers absorb all the selling by the aggressive sellers. Now for a passive buyer, it's tricky because you don't want to absorb too much, because then you give the market the impression of support in the market, right? And the reversal is going to occur as sellers back off, knowing they have reached an area of buying. So you can see it down in here, depending on which sort of chart you like to look at. There's your passive accumulation, passive accumulation, passive accumulation. Passive resistance is the opposite, right? It occurs when big aggressive buying volume appears, but price doesn't move up, right? This passive distribution, which is the same as passive resistance, is a form of absorption as well, right? When you think of resistance, think of distribution, right? You're running into an area where you have supply, right? That's what causes resistance, is supply. And it's when people are distributing it out, what they're doing is they're working offers, right? That's your resistance. It's a form of absorption. What's happening? Price should move higher, but because it should move higher because of the aggressive buying lifting all the offers. But traders with supply offer it out to those buyers, right? Everyone's willing to buy, but you have willing sellers, right? That's what everyone overlooks oftentimes, is the opposite side of the trade. They all think, well, I got aggressive buyers. That's very bullish. Well, yeah, it is, but take a look for a second at the selling that's going on. If the passive sellers are able to distribute their supply without much effort, if there's a pool of aggressive buyers, right? That's what I was talking about earlier, how the long-term traders, they will distribute on moves up, right? They don't wait till the market starts turning to start to distribute. I don't really like that term, distribute. Let me just say, use a term. Let me rephrase that as, that's where they start selling their excess supply, is on the move up, right? So if you're wondering why the market can move lower on positive delta, that's why. It's because you have people offering it out, right? Big offers. People are lifting it. The aggressive buyers are buying it. You got +1 every time they trades on the offer in the delta. So then what happens? The buyers finish. You got the positive delta. Market starts ticking lower. Bar closes. The red candle, positive delta. That's how markets move lower on positive delta. The positive delta occurs early, and then it just drops down. And here's positive delta. Look at this. Can move lower. Positive delta, positive delta, positive delta, positive delta, positive delta, as we're moving lower. Why? Look at these buying imbalances in here. Buying imbalances. What you have is people offering it out, offering it out, offering it out, offering it out, offering it out on the move lower. They're offering the supply. People are coming in, buying it, thinking, hey, this is great. Oh, wow. We were just trading, they think the market's going up to 08, and, they bought at 04. I'll say, hey, it's offered at 03. Again, I buy another one. Offered at 01, buy another one. That's what's happening. But the seller's probably got a lot of supply in his back pocket. He's not showing it all, but he's putting, distributing it out there on the move down. That's how trends happen, right? You got your resistance selling. You've got your passive distribution, so to speak, occurring there on a trend down, just as you'd want to see passive accumulation on a trend up. Now, when long-term sellers start offering a healthy supply, the selling will shut off the buying activity, which causes the market to reverse. And what that means is, the aggressive buyers are buying, but what you have is you got the big guys, the really big guys sitting behind them. All of a sudden they come up. This is like in those old movies when they, from the trading floor where the guy's just sitting there reading the newspaper, and he just comes, all of a sudden he looks up, sees oil prices trading high, he comes in to the market, starts selling corn, at these high levels, market starts going down, and he sits back down. That's what's happening. When the sellers believe the market has reached an extreme high in the trading session or even the trading range, sellers recognize the market's overbought and they start supplying at the bid. The move up will end and a move down will come in and the move will reverse. Here, crude oil, market's rallying. Okay, now they're starting to distribute. Boom, market's going down. The big up bar, people are starting to distribute in here, imbalances. They're holding it down. This is a chart I showed you earlier. Actually, it looks, these charts. Honestly, a lot of the charts look alike, because you see the same thing all the time in the markets. It's not like, how to say, it's not like a aberration where it happens once in a while. I mean, you could look at these charts day in, day out, and you see the same things happening day in and day out. So when long-term traders distribute to short-term traders at highs, there's a very high probability the high will hold. Okay, again, anytime you're at a high or a low, you should be asking yourself, are we going higher or are we going to reverse? If we're at the low, are we going lower or are we going to reverse? What's the chances of that happening? Now, accumulation does not always result in a move up. Okay, that's where people that live and die by Wyckoff methodology, they swear by it. No, it's accumulation, got to go up. Well, if accumulation is underway and prices moving down or sideways, you don't know yet if the accumulation is going to be enough to move the market higher. Yeah, it should be, but what's the difference between accumulation and distribution? Then you need a sign, right? If you're at a high, now the basic thing is, right, if you're at a low, everyone's going to say, well, it's accumulation, or if you're rallying and you pause, they'll say that's accumulation. But say you're in the middle, right? If you're at a high, you're going to say you look for distribution. You're at a low, you're going to say look for accumulation. But what if the market's trending up? Okay, going sideways, do you got accumulation or you got distribution? Market can easily sell off, and people say, well, you got distribution there, or market or rally and say, well, you got accumulation there. You need a sign. You can't trade after the fact. A lot of people look to the chart and say, there's accumulation here, or you can see how the market was in distribution mode. It's always easy to Monday morning quarterback the market, right? So what's the sign the market can move up? We're going sideways here. What's the sign? Look at the imbalances. Look at the deltas, right? That's the clues. Where's the big volume? You look for the areas of big volume here. Here. Obviously here is a big one, but that's the 3 o'clock close. I'll talk about the closes later. But what you're looking for is what's happening in the market. My gosh, you're looking at this fish, man. Is this market going up or down? I can't make heads or tails. Look for the signs in the deltas. Yeah, you got your big volume bar here. So, granted, this is a doji, big volume, 17,000. Doji candlestick, guys, you know what that means. Market indecision. Market could go up and market could go down. Okay, well, let's take a look at what's happening in the delta. In the next bar, positive delta. Next bar, positive delta. So you got a couple bars with positive delta. That's more bullish than bearish. Point of controls. Okay. You have any imbalances? No. So, put a gun to your head. What are you going to say? Accumulation, distribution? Honestly, I wouldn't say either. I would probably be looking to stay out of this because it's too choppy, right? Don't be trying to see things in the market that aren't clear. Stick to the ones that are clear, right? That's the problem with, everyone talks about over trading. You're trying to read too much into what's happening in the market sometimes. That, yeah, I can make the argument that it's bullish, but then if it goes down and fails, I wouldn't be surprised. Just because I got an argument that is bullish, it's not a strong enough argument as it is here. This one is much stronger. Stringing together all the positive deltas, even the one negative delta is quite small. You got the buying imbalances in there. It's happy days. Here, this one is like, oh gosh, man, I don't want to be trading. And there's no reason to. It's not clear. If you're looking at the big volume, okay, so this is the volume chart. The volume the volume at price footprint. You know, this is the same chart here that it is here. But again, you know, this is where some of the stuff is going to come in handy for you. Look at that. You're probably not noticing it in here. Look at this, 4,000. Where else do you see 4,000 in any of these bars? You don't see it at all. 2,800, 3,600, 2,9, 2,6, 2,4, 2, 2,1, 4,000. Right below a 2.7, and you got a couple 1,200, 1,600. So you know in here there's heavy volume at this low. That's really the only clue. But again, you have to have trained yourself or look at a different chart to see things. You know, it's you look at a chart like this. Honestly, I probably wouldn't have been able to pick it out until I look at a chart like that to see it more clearer. You know, over here again, you got that big bar. Now this is 3 p.m. 3 p.m. is when the cash closes, and that's generally when you're going to have your most volume in a bar at the 3 p.m. cash close. So whether you look at a 1-minute chart, a 5-minute chart, no, it's 70,000. Gosh, it's 70,000. That's because it's the cash close. Everyone likes to try and peg the cash close in the futures. The big traders, you know, people that are working cash against futures. But really, the only sign in here, again, it's hard to see, but you know what? If it's important enough, spend the $100 on an extra monitor, for goodness sakes, and throw up a volume footprint, a volume chart, this chart, in addition to your footprint chart, so you can see the stuff like this. Or maybe you want a delta chart, a linear delta chart. You know, it's the price of computer monitors is ridiculously low, but if it's going to give you a trade like this, it pays for itself in a short time. Again, this is stick out volume right here, 4,000. The 2,779 is already on the big side, but then it's massive right in here, 4,000 on a doji bar, on a bar of indecision, and the market goes up. So if short-term traders sell to long-term traders at a high, chances are the market will keep going higher. But honestly, this is very tricky to see in the order flow. And basically what you have is you got weak traders selling to weak hand traders selling to strong hand traders is what that is. That's what that translates into. What do you think is going to win, the weak hand or the strong hand? Well, the strong hand is going to win 9 times out of 10. But again, it's kind of tricky. See in the order flow, it's probably not something that you're going to want to try to see, because you know it's like you'll probably see it when it's not happening. You gotta get used to seeing it, right? So trending market's going higher, failed divergence, failed divergence, failed divergence, failed divergence. And again, I had talked about this earlier in one of my videos. When you start seeing groups of divergences that failed, that's a sure sign of a trending market, especially if it happens early on. This is cash open here, 8:30, and you're seeing it already by 9 o'clock, 10 after 9. You already got 3 failed divergences. But let's try and see, you know, if you can see who's selling to who. Is it easy to see? No, of course not. But what you can do is you're looking at these imbalances, right? Buying imbalance, sorry, selling imbalance here, selling imbalance here, selling imbalance here, selling imbalance here. You're seeing supportive buying here. There's a selling imbalance. So you're making these highs. Someone's bidding it up, right? And you're not going to get big bids on the smaller trader side. You're going to get big bids from the longer term institutional traders. They're the ones that are going to be working big bids, not the retail traders. So when you start seeing at your highs, you're seeing these selling imbalances and the market's still going higher. I know that there's support in this market, and look at this, these three imbalances right around the same level. They're still going higher, selling imbalances, right? The sign of retail traders are the buying imbalances at the highs. But when you start seeing selling imbalances at the highs and the market's not selling off, it's telling you someone's supporting that market. So the retail traders are selling to the longer term traders there. Okay, again, who's selling to who? New highs. You're going up there. Look at this. I could just, to me, it's a little bit easier because I'm so used to looking at footprint charts. But again, if you're looking at this and you're not used to it, you might want to switch to the delta chart. Okay, maybe not the delta chart or the pure volume chart. Look at this volume: 4,000, 3,000, 3,600, 4,600, 5,421, 4,441. Again, all that is just the linear volume. It's going to show up on the one side as opposed to in the middle. Can't, because that's where the price bar, that's where the candle is. If you're looking here, you can sort of see these pockets in here. Support, support, support. And look at these numbers. Minus 1396. These are delta numbers. Minus 1200. Minus 700. Normally, you're seeing volumes in the hundreds. Less than 1,000, but you're getting these big numbers here. 1300, 1200, 772, 646, 898. So there's supportive buying in this market. So who do you think is doing that supportive buying? That's the longer term traders. Shorter term traders are lifting the offers. Okay, but again, you got to understand what is average volume, whether you're looking at a delta, whether you're looking at volume, or you're just looking at a normal footprint chart. If you're just looking at this, you can see these volumes stick out. Even here, 2,500, 2,500, 2,600. But then look at this, 2,000, 3,000, 2,000, 2,500. Some heavy volume being bid here. The retail traders, they just tend to lift the offer. It's not to say they can't work bids, but their collective size is much smaller than the bigger institutional traders. I don't believe the fact that some traders like to say, well, retail traders only buy and sell at the market. No, they work bids, they work offers just like everybody else. It's harder in these markets like the S&Ps that have such big size, because you throw in a bid, next thing you know, you got 500 in front of you. You might not get filled, and that's why people tend to lift the offers. But still, people are patient sometimes, and they'll work bids. Now, when long-term traders take the offers from short-term traders, the market can keep going higher on less volume. Now remember, everyone says about volume, rising prices should be accompanied by rising volume, right? That's Dow theory, states that, a bullish sign of the market is higher prices with higher volume, but not always. All right, look at this volume going up here, this move right here. 1100, 1100, 1300, 1200, 3,500. This is a new high here, 1270. So on this move back up, it's got less volume. Earlier, you had some decent volume. 2,000, 4,000, 2,000, 2,000, 3,000. You hit your high here at 2,400, 2,500. Comes off, starts going back up on lesser volume. What's price doing? We're making these new highs. The volume's lighter here. You get up here to these highs, 200, and here's 400, 300, 300, 400, 400, 669. Here you got heavy volume, 1,700, 600. Back here you're trading 700, 600. Volume is much lighter here. Granted, it's just after the futures. Once the futures close, it's a euro currency, right? And this is happening at 2 in the afternoon. Volume does dry up. You got to understand what's the times, right? Because people, they think, well, the market trades until this time, that trading volume should be consistent. Okay, here, this market, this is gold, right? This is at 10 in the morning, 10, just before 11. We're making these, going up here on highs, move back up to the highs on smaller volume. That's going to be more important than here. After the 2 o'clock close is here right? That's why you got that big volume, 1791. That's when the floor used to close. Obviously, now with electronic trading, it's still open, but that's why you see big volume go through at 2 o'clock in the currency contracts, is because that's the old close. That's when people in New York tend to close their books, basically, at 2 p.m. Chicago time, which is 3 p.m. New York. But we're still going higher on slightly lesser volume. It's partly due to the fact that traders are, the big traders are sort of done for the day, but still, keep an eye on it and watch it. But here we're going higher on less volume, right? Well, we're not supposed to do that. Dow theory says we're not supposed to do that. Well, watch what happens when we get up to these highs. Pay attention. Look for the signs. We're going up there on lesser volume, but look at the deltas are getting stronger negative up here as you're getting up here. 400, 200, 200, you got a small delta of 20. I'd be looking, potentially for that sell to come in. So accumulation patterns. Watch max delta over the last several bars. Distribution patterns. Watch min delta. Now, that's not something I really touched on earlier. If you have my delta course, I got a whole section on max and min delta, I believe. It's important, right? Because is it in concert with the move, right? So you can see here what's happening. We got to look at these min deltas. Minus 160, minus 114, minus 246, minus 138, but we're going higher. What's that telling me? It's telling me you have supportive buying in this move up, right? Look at this volume down here. Where's the volume in these green bars? Towards the low. So every time you open up, trade higher, come down into the lows, you got a lot of activity. Market rallies up, market comes down, a lot of activity. Market goes up, market opens up, comes down here, a lot of activity, a lot of activity, a lot of activity. So I know that there's supportive buying in here. Okay, so this is, on move. I say, keep it relative to what's happening in the market. So once you understand accumulation distribution, you can start to form a trade setup. Accumulation distribution by themselves is not a reason to get long or get short, I don't think. For me, it's more of a starting point. When traders are accumulation mode, are accumulating, what are they doing? They're working bids, right? Generally, they're willing to lower bids if they think aggressive sellers will go there. Passive buying, passive accumulation does not move prices higher. Passive accumulation is the bids, right? They're absorbing what's going on, the selling going into the market. So when accumulation mode moves from passive accumulation to aggressive accumulation, the prices start to rise as buyers think that the last seller has sold, and sellers become exhausted. And then the buyers start lifting the offers. Okay, so before I end this module, I just want to go back to this slide here. Accumulation patterns. Watch max delta over the last several bars. Distribution patterns. Watch min delta over the last several bars. I just want to explain this a little bit further. So distribution. Watch what's happening in the min delta. Do you have strong min deltas in here? Do I think the market's distributing in here? First of all, okay, what we'll be looking at is obviously the final deltas, but we're watching these min deltas. Here, look at this. Here it's 0, 0, small, 52, 2, 33, 45. But all of a sudden up in here, right off the high, minus 500, 153, 331, 240, 888. I know that there's selling pressure coming in here, even though the market's not going down yet. Right, that's important information. Now let's see here in the accumulation, right? What's going on here? Coming down into the low. Do I think there's accumulation? Well, here we got 1500, 1987, 2600, 3000. Do you have anything else like that? Not really. Over here you got 3000. Here you got 4000. But everything else mostly is negative selling. These are min deltas: 2000, 700, 2000, 4000, 5000, 3000, 1500. Well, this is E-mini. This is 8. The first 15 minutes of trade, you tend to get heavy volume, but still, watch what's happening. It's closing this bar here. 26.28 is your max delta. Final delta was 25.77. That's a very bullish sign as well. So I hope that clears it up a little bit for you, so understanding, when I say look at them in relation to previous bars, are they high? Even though it may settle here, like here at 1500, it only settles at plus 800. I know that early on in that bar, there was some signs of life, the aggressive buying coming in there early on in that bar. But then, it was met with, obviously, some more aggressive selling. The selling wasn't quite done yet. That you got the delta down to 802 from 1546. So this concludes Module 4. In Module 5, I'm going to discuss reversals and continuation. Now, not all absorption leads to a reversal. It can also lead to a continuation of the existing trend. In Module 5, you're going to learn the differences to look out for. So I'll see you on the next module. Bye-bye. Hey everyone, it's Mike and welcome back to the Orderflows Absorption course, module number 5, Reversals versus Continuation. Before I begin, brief disclaimer. This presentation is for educational and informational purposes only. It should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and it's not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right, so most traders, right, they consider themselves trend followers. Honestly, most of the traders that you meet online say, I'm a trend follower. That's the easiest way for them to describe their trading, because trend followers tend to lose more, have more losing trades than winning trades. So I sort of feel sometimes that these traders will say, well, I'm a trend follower, so I don't need a high winning percentage. But the one thing that I find common with them is they all rely on price-based indicators, which is based on information after the fact. As you know, my feelings on price-based indicators is to take into account too much stuff in the past rather than what's happening now. Now, humans are what I consider herd animals, like horses or most animals. They tend to move in packs, and humans are no different. You see it. The way the retail traders act is this herd mentality. Now, what I like about order flow is it doesn't only use price. There's also volume, aggression, and time. And that's going to give you, a trader, the opportunity to take advantage of a move earlier than the herd, right? And what you're going to be looking for is the move. You got your continuation. You want to have your signs of the continuation and your sign of reversal. With order flow, it's going to tell you why this divergence worked versus this divergence, why this one failed and this one worked. So absorption in a trend, right? As a trader, the most frustrating part of trading is watching the market make a big move while you're sitting on the sidelines. We've all been in there. We're like, should I buy or not? Then the market makes that move and you're sort of kicking yourself. By the time you get into the position, you either buy the high or sell the low. And you're left wondering, is there a better way to trade? And while it's nice to buy on pullback, sometimes the market just doesn't offer you a pullback to buy into. And you can only trade what the market gives you. You can only trade the opportunities that the market gives you. I put the word "what" in there. You can't force trades. When you try and force a trade, you're taking a trade that isn't necessarily there yet, right? You got to let the market reveal itself to you. Okay, so just go back to this chart here. Okay, so why is this a reversal sign? Well, if you're looking at the order flow, this one just screams out at you, actually. Point of control, prominent point of control. Look at the volume that's traded up here. Very heavy volume. These traders are stuck. They're long and wrong. Look at this volume: 1,300, 1,000, 1,200. Even on this move up, do you really see volumes like that? Not really. Where the market's reacted, on the move up, you do see some heavy volumes like in here. Now, this heavy volume in here, to me, is support in the market. Even though we hit that high, you got the divergence. You rotate around this level, right? You got the big stack buying imbalance. You come back into it. You got support in here. The aggressive buying that was here, still here. People are still buying this area in here. Even in here, just above this stacked buying imbalance, you got that supportive buying, right? You do have the divergence though. So we got ratio, you got a divergence. You don't have the ratio, the bearish ratio, but you're seeing more signs of support in here. Then the big aggressive buyers coming in as you're taking out the highs. The sign, even though you don't have a divergence here, you got positive delta, big strong positive delta, 1400. So why are you buying such a positive delta? I'm not buying a positive delta. In fact, I'd be looking to sell it, right? What you should be doing is saying, well, okay, I got positive delta at the high, but why? And didn't the market go higher? Why is it a red bar? Well, I know up here I have resistance in here. I got some absorption. Everyone, these are trap traders. I talked about that earlier, where you have traders getting trapped. There's often a sign of absorption, and here you have it right there, clear as day. Why do some highs work? This one works, this one doesn't. Well, I gotta be looking in here. What's going on in this market? You got the small delta. Okay, maybe thought, okay, well, maybe this could be reversing. But if you're watching what's happening in here, look at this volume in here. You have very strong supportive volume right in here. I mean, fortunately, this one failed really quick. So, even if you got short, honestly, if I'm looking at this high, I'm seeing this bars coming in here, small delta, I'd be willing to take that shot to get short, get stopped out. Okay, fair enough. I get my next high, I got my divergence, so I got my negative delta, I've got my ratio, which is also a sign of, in this case, is a sign of price rejection, price exhaustion. But if you're looking up in here, next bar, very small positive delta, 93. What's important about this bar that you could take away is look at this max delta, 1939, ended up at minus 600. Okay, so it went from positive close to positive 2000 early in this bar. We're trading up here, a very strong positive delta, and it turns fairly decent negative delta, minus 600, as the market starts trading down. And look at these deltas in here. Well, this one's small, but it went from 1400, positive 1400, to ending up at only 93. So it gave it all back. This one's kind of mixed. Then big, strong negative delta. You can get to be short. There's absolutely no reason not to be short anywhere in these three bars in here. If you're not convinced of this high, ratio and divergence, and even this next bar, plenty of opportunity in these bars, plenty of reasons to be getting short. And then look at that, boom. The bottom just falls out here. The one bar moves from 53 down to 43, a 10-point move in the S&Ps. Boom, it's all right there. It's just, that's why I say you can only trade the opportunities the market gives you. The market's giving it to you on a silver platter here. So once you determine the direction of the trend, the next step is determine if the trend is sustainable, right? How are you going to determine if the trend is going to continue or not? Well, watch the deltas. That's the first sign of the trend continuing or not. Look for supportive buying as well. That's another key. Right here, you got the aggressive buying. Well, do you have supportive buying? Well, I see selling imbalance in here, selling imbalance on these green bars. Point of control towards the low. This is a bullish sign in the point of control. Here, you got a bullish prominent point of control, right? Like I said, what's the market telling you? You got a stacked buying imbalance that held here. Another stacked buying imbalance that held. Now you get up here, you start going sideways. Things are changing, right? You have your trend. You got every sign in the world telling you that, this trend is legitimate. But once, trend eventually is going to end, and you're going to be looking for some signs of possible reversals. You're starting to see it up in here. But really in here, going higher on negative delta, right? That's bullish, right? I've told you that. That's bullish. Go with the price action of the bar. That's your supportive buying. What's happening is people are hitting these bids, but you have a buyer in there supporting the market. It's absorbing all that selling that's coming into the market to try and move that market lower. People are bidding that market up. So not only does volume help you identify a trend, it also helps to confirm the trend, right? And it's one thing to say, oh, there's a trend, but you need some confirmation, right? Just as you have here. Yeah, I think we're trending. Well, I'm not sure. Okay, well, you look at the volume. What's happening? You know, the volume's in the bar, the volume's, you know, below. You know, here you got a nice healthy move up. You got nice positive, not positive. You got nice healthy volume, 1800, 2000, 2000, 3000 as you're going higher. So the volume's increasing as well. Heavy volume, I just talked about, at certain price levels, define support or resistance in the bar, right? You got your supportive buying. Look at these heavy volumes in here. 400. You know, in this bar, what do you got? You got 150 here. You got 218. So you know you've got some supportive buying in here as well. Now on the downside, people don't really think of absorptive buying. Yeah, that's a term. I was trying to think of the term to describe it. Buying, absorption, absorptive buying. You know, it could go either way. But you know, on the downside, you're gonna be looking for, you know, at the lows, is there volume being traded on the bid side down here? Yeah, there is. As you're coming down to these lows, look at these volumes. You know, 50. Get down in here. You know, here's 100. That's not that much, but look at this volume in here. 100, you know, in the hundreds. You get down in here in close to 200. 200 here, 181 here. You know, 207. So I know there's support down here. It's found a level of support. Somebody came in and said, you know what, 113.08, 113.10, I'm a buyer. I'm bid. That's holding that market down. Again, you're seeing the bullish sign here in the point of control, but you're seeing the positive deltas as well. So look for that absorptive buying, absorptive selling. The resistance selling, I guess, would be the better way to describe it. But look at these volumes here. 1200, 1200. You don't really have much here. 800. Where's their heavy volume? Here's 800. Do you have any sort of volume like that here? No. 500. You know, here you got 500 as well. Here's 700, 400, 800. It's more resistance selling. Here, people offering it down. 800, 400, 800. Yeah, I mean, obviously they're selling it, you know, they're hitting these bids as well. But I mean, look at this, right? You got this bar here. The delta is minus, what is that? Minus, I think it's this one here. Minus 734. Okay. But when you look at the volume, I mean, you got this big volume in here of 1200, 500. Which normally on these bars down, you're not getting that sort of volumes. You know, 800 is bigger, you know, 700, 800, but someone's offering it here. Someone's offering it here as well as hitting the bids, right? You got this big volume and you think, why you got such a big negative delta? Well, you have someone offering it out as well as hitting the bids, hitting the bids, hitting the bids all the way down, 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 down. So when coming to resistance with strong volume and the market goes sideways, and still shows strong volume, that's a sign the market still has some upside capacity to it. Don't get short just yet. You know, you want to get short after coming to resistance with strong volume. But once you start going sideways, volume decreasing is a sign that buyers are drying up and becoming exhausted. You know, you gotta look for the sign. This is the sign that the market is ready to sell off, right? Just because you hit the high, don't imagine, you know, it's one thing to look at a chart and say, well, we hit this high, I can get short now. No, because it could just go sideways and then go higher. Look for the signs that, you know, the interest is no longer there. So basically, you know, you come up into this high here, you got heavy volume, 2000, 2000, then it just sort of goes sideways. You know, volume is kind of light. And then you're running in here, this bar here, 1000. Okay, all the other bars, 500, 400, 300, 400, 400, 500, 400, 600. It's kind of listless, you know. You're running into an area of consolidation. So you're gonna look for a sign, and here's your sign. Boom, the big seller's coming. Minus 115 on the delta. The volume, you know, the min delta is minus 338. The volume minus 1181, and people have said, okay, you know what? You know, we're not going higher anymore. Now I could trade the reversal. Right? I mean, you could have, you know, maybe you could find a reason there. I don't want to dissect this part in here, because to me, the sign for sure to be getting short is right here, this bar here. I mean, you got the bearish ratio as well, but that heavy volume is the sign to me that sellers have awakened up and said, you know what, We're tired. The market's not going higher. We had our chance here to go higher. It's not. I mean, how many times, let me ask you, how many times have you bought like this, right? You've bought this high or around the high, market's come off, you're holding it, thinking the market's going to come back, and starts coming back. Hey, we're coming back. Then it starts selling off. This is where you get out. Then the market falls over. Right? You're happy to get out here before the market falls off, because you're happy to get out here because you know you're not going any higher. This is where the volume picks off, right? You got your lesser volume in here. Everyone's waiting for the market to come back up and rally, but it's not. It's not making that rally. Okay, so when a market moves into congestion, it's hard to determine direction, right? I just showed you, right? We came into congestion, and it's hard to determine yet. This is your sign here. So oftentimes, buyers and sellers are evenly matched, prices trading in a narrow range. Okay, now this one I put in here. This is a Fed day, actually. This is March 20th. Obviously, you got the big move up there after the Fed news, but you know, forget that part right here. We're coming into this area in here, congestion, right? I talked about this earlier. Consolidation, rather. Look at the volumes. 7,000. For the hour before, the volumes are much lighter than it was earlier. Here, you're above 10,000 is kind of your average. Here, below 10,000, close to 5,000 is more of your average. So it's a lot less. So when we're coming into congestion, I should add / consolidation here. It's hard to determine the direction. Well, again, I wouldn't be trying to decipher what the Fed's going to say based on the price action in the S&P futures, but rather just wait for the Fed to make their news rather than trying to figure it out. But again, forget that this is, put your hand over this area over here. When you're in consolidation, it's hard sometimes to figure out which way the direction is going. What's the signs of consolidation? Well, smallish deltas. I mean, here you do have some big negative and some big positive, but we're not going anywhere. Volume is lighter. That's the other sign of consolidation. Point of control is more or less around the same level. That's also a sign of consolidation. So for consolidation, look for point of controls around the same level. I'll just write that on here. Signs of consolidation. Can't type. Consolidation. Lighter volume than normal. Lighter volume than average, I guess. POCs around the same level. And delta, you should have how to phrase it. I don't want to say small deltas, but sort of meaningless deltas, like big deltas in one direction. Okay, well, I'll write that. Small deltas or big meaningless deltas. Now what I mean by big meaningless deltas is you got the big deltas, right? 1,000, but then it comes back with small deltas, minus 1,000 small deltas. The market's not going anywhere. You should have some sort of movement after that fact. Okay, and if you don't get that, that's a sign of consolidation. So these three here are big meaningless deltas with little follow through, little to no follow through. Okay, I can't type. Little to no follow through. So back to absorption continuation. After a big increase with a weaker volume pullback, you're going to see some absorption and continuation. Okay, now what do I mean? What it looks like on the chart. You're selling off, market rallies back up, gets slammed again. Okay, volume drops off, right? You got your heavy volume sort of drops off here, rallies back up, heavy volume comes back in, market continues in that trend. So when a market's been selling off and there's a bar with heavy volume followed by a bar with weak volume, shows there's limited buying. I look for the lows to be taken out in the market to trade lower. Now, of course, what I write here, this, I say, like, for example, okay, market's been selling off. There's a bar with heavy volume followed by a bar with weak volume. Okay, now that doesn't mean it immediately has to follow it. there might be a bar in between or something where you get your weak volume. But again, trading is not an exact science, right? It's not like, that's why I think engineers are attracted and programmers are attracted to trading. It's because they think they can solve the problem with exactness. In trading, oftentimes there is no exactness. And what do I mean is, for example here, right? So you're selling off, right? You got your big down bar here, then you go sideways for a while with lesser volume. You're averaging very decent volumes in here, 13,000, 15,000, 2,000, 20,000, 17. Okay, then you get your small and your reversal, 12,000, 12, then boom, 16,000 again. Okay, then it goes sideways again, 10,000, 8,000, 11,000, 10,000, 9,000, then wham, 17,000. You're looking for that sign of the selling coming back into the market. This is your pullback here as you're about to go lower. So at a high, when there's heavy volume at the high and the next bar exhibits light volume, the sellers did not yet come into the market. So watch to see if we break out the new highs and continue the trend. It's often a sign of profit taking, or it could be indicative of traders not sure if the trend is real. Okay. If the market doesn't revert back to the mean, as most traders would be looking for, the trend is real. And what do I mean by that is, all these mean reversion traders, when we're at highs, they're always, they're looking for the market to sell back off again, come back down into the lows, and revert to the mean, or not to the lows but rather to the mean price. And best way to show it, I guess, is, let me get an example here for you. Not sure if this next chart is the one that I want. Okay, so here we got, we're at our high. We sell off, hit our high again. Now, in the order flow, this is not a high I'd be looking to buy, honestly, just on the pure order flow. But, anytime you come back to a high, you're going to be asking yourself, are we coming up to the high or not? What do you get? You got your heavy volume right here, 14,000. Look at this relative to the previous bars. People are coming in. No, we're not interested. We're selling this bar here. We're selling these prices up here. That's why you got the high volume there. So, I said, when we're at a high and there's heavy volume at the high and the next bar exhibits light volume, what you're seeing here is actually the opposite, right? You're at your high, you got your light volume. Next bar is the heavy volume. Sellers are coming into that market. So if you got heavy volume on the sell side, do you think the market's going higher or lower? Well, it's on the sell side. We should start going lower rather than higher. Okay, so here, here's our high. We've sold off. Get sold off to an area of heavy volume in here, 16,000, 16,000 again, 16,273, 16,932. But then you just go sideways on light volume. Okay, so yeah, you had your sellers, but it was met with some decent buying in here. Go sideways. Honestly, I would not be looking to trade either one of these bars. Maybe this bar I'd be looking to get short, but if I was short, I really wouldn't like it. The fact that we pull back up through this imbalance, I don't like that when you do that with imbalances. And I don't like when you get a red bar, the stack selling imbalance, and followed by a green bar. It's got a higher chance of failure, especially when you trade back into it like that so much. I really like it to just sort of hug that area. But nevertheless, we sort of go higher, drift back up to the high on light volume, right? Do you think we're going to hit that high for going up? Earlier we're hitting this high on volume above 10,000. Now we're going back up on volume less than, around 9,000, 7,000, 9,000, 9,000. And the sellers come in. We've got the volume coming in and saying, no, you know what? We're not going any higher. Now, absorption often leads to sideways price action. I hate to admit it, but I like to say that order flow is not going to predict every market turn in the market, because oftentimes the market just goes sideways. There's sometimes there's no way you can control that. And thing to remember, keep in mind, is you can go sideways with absorption before it continues in the move or it makes the reverse. And the signs you got to look for is when the market gets to highs or lows, watch the delta. As the market is making new highs, look for green up candle bars, up bars with extremely strong delta on green candles above average volume, followed by a red candle with negative delta, or small positive delta. As the market's making new lows, look for a down candle, down red candle bars. Yeah, it's a bit confusing. I should just say look for red candles or look for green candles. I think start putting in all these things, people get confused. Look for green candles. Again, most people nowadays use candles, but some of the old timers they never really made that switch to candlesticks. They still look at the normal bar charts. But I like candles because I'm a visual person and it's very visual. So as the market's making new lows, look for a red candle with extremely strong negative delta above average volume, followed by a green up candle appearing with positive delta. So we're at new highs, but watch the deltas. Okay, you're at new highs here. Why is the deltas negative? That's not a good sign. Okay, why this and not this? All right, you have a low here. Market started a rally, came back down, made new lows. Well, go back to what I was saying earlier, right? Look for the red candle with extremely strong negative delta above average volume, followed by a green candle. Green, yeah, I'm confused by that too. By a green candle appearing, if my English was correct, with positive delta, right? That's really what you want to be looking for. And yeah, you can see, well, here, you got you got the red candle, you got some decent volume in here, 25,000. Now granted, forget this part here because this is before the cash open, so this is your cash opening here. You got the low, you got strong positive delta, positive delta, positive delta. But what's happening in this market, right? You have that absorptive selling, that resistance selling, absorptive selling, resistance selling in here. That's why you got that positive delta, 1528, but the bar's red. People get so trained on looking at these numbers, sometimes they forget to look at what's happening in the actual bar, right? You guys say, what the F? 1528, biggest, strongest positive delta, but the bar is red. Why? It's because everyone's trying to buy this. Everyone's trying to buy this here. But you have the resistance sellers in there. Market makes that new low. And then you start seeing the green bars coming in here. Notice the volume is lesser. The volume now is half. We're sort of undecided here. You got point of controls at that same level. This bar comes right down to that point of control. This bar here right down to that point of control. You got the positive deltas. You don't have this divergence of bar and delta color. It's everything is red that should be red. Everything's green that should be green. Really, this is sort of the sign. If you were looking to buy this in here, yeah, you could have bought it, but if you bought it, you could have got out in here at a scratch or a small loss and gotten short, because this is a very bearish, very negative bar. This is the resistance selling, the absorptive selling, so to speak, in there. But again, it's kind of hidden. You got to look for it and make sense of that. But let me just go back here. So again, making new lows, look for the red candle with extremely strong negative delta. New lows, extremely strong negative delta. It's got the above average volume, followed by a green candle appearing with positive delta right in here. Now, the other thing that's a bit different in here is, this bar it is bullish. It's an engulfing pattern. This one is an inside bar. People ask me, when you're trying to mesh order flow and candlestick charts, I prefer the inside bar to the engulfing bar. I think to me, this, because when I see the inside bar, I see absorption. I'm automatically drawn to absorption when I see inside bars, as opposed to engulfing patterns. Engulfing patterns, I think more people are looking for that. People sort of disregard inside bars because the market's going to go sideways. When I see inside bars, I'm looking for some sort of signs of absorption. I'm looking for some more market direction. Now, when the market reaches an area of consolidation due to absorption, it does not mean that there will always be a reversal. Again, sometimes you're expecting a reversal, it doesn't come, honestly. And the market can trade sideways and then eventually continue its initial direction, right? we all like to think that, well, you hit absorption, the market should stop and reverse. Not always. You know, it can go sideways and then continue its original direction. You know, when the market comes into an area of absorption, one side of the market thinks the trend's going to continue, the aggressive traders. The other side thinks the market's ready to reverse, the passive traders. So here we went sideways before selling off. Right? Sideways, new low, sideways, sideways. Now, you know, we all wish that there would be like the nice V-shaped patterns, you know, come down and rally back up. But unfortunately, you know, the market is not like that. You know, it's like dating a pretty girl, but, you know, maybe she got some personality flaws. You know, that's what the market's like oftentimes. But again, you know, look for the signs, right? You hit your sign up here, right? You got your high, got the strong negative delta. Yeah, maybe you're not convinced. Look at the imbalances in there. 1, 2, 3. Look at this in here. Volume slam. Sellers are triggered. You know, they're thinking, hey, who bought this market up so high? You know, and then they start selling it down. Selling it. You got the imbalances in there. Strong negative delta, 3,000. Volume, double, 11,000. And it just sort of goes sideways before continuing back on down. You know, just as here, right? You're coming in, you're making these new lows. You got the inside bar going sideways. Big down bar again, strong negative delta. Here you got 14,000, but here you got 8,000. So it's lesser. It's not half, but it's, you know, maybe 40% less. You got this bar 9,000, still decent volume, you know, relative to what you're looking at earlier. Okay, but you got a small positive delta, 189. Here you got delta, positive delta, red bar. Here you got buying imbalances, 4 of them, 5 of them in this bar. Okay, you know, you're really looking at this point for this market to take off. It rallies a little bit, not much. You know, you got some supportive buying down in here. When you come up in here, you got resistance selling. But for me, more or less, I look at this, you know, it's just a market going sideways, even though it's trading basically between 59.15 and 59.40. You know, what is that, a 25-cent range? You know, it's for me, it's a market that's going sideways. I'd be looking for it to rally up in here, up to this prominent point of control. But once you hit that prominent point of control, you know, I'd be looking for some sort of sign that the market's going to sell off. But, you know, it doesn't. Yeah, it does. You know, not much, 10, 15 cents, just as it was at rally. You know, yeah, 10, 15 cents. So not much. For me, that's a sideways activity, even though all the signs are giving me, you know, longs and shorts. Again, you know, absorption can lead to sideways action where the market can turn or resume. You know, remember, when absorption occurs, a reversal does not always occur. It still depends on what happens in the market, right? You got to manage the trade. That's what sometimes people forget. And I want to scream sometimes, is because, you know, I talk to guys and they tell me, oh, you know, I got into this trade and it was working, then reversed and stopped me out. And I'm like, well, why didn't you get out? You know, if the signs were there that the market was reversing, you got to get out. Don't let the market take you out if you can see what's happening in the market and you're smart enough to get out on your own. Again, the key part is the part that gives confirmation that the market will go sideways is the following bar, being an inside bar. You know, I always love these inside bars. You know, it's sort of a secret, I'll say a secret of mine, because basically what I'm always looking for, right? When I make a new high or new low, what's the next bar after that? You know, is it an inside bar? It's got me more interested than if it's an outside engulfing bar. I'm looking more for the inside bar, right? Because that, to me, is more of a sign of absorption is coming, and we can go sideways or we can reverse. You know, or we can fail, but generally we either go sideways or reverse. I could deal with sideways, you know. I could deal with cutting a trade at break even plus a minus couple a lot easier than I can, you know, getting stopped out and taking a big loss on the trade. Big loss, but taking a loss on the trade. You know, sideways, it's frustrating, but, you know, if you got 2 out of 3 chances to make something on the trade, I'd rather take that. So again, the trend is your friend. I mean, I say that in every freaking course, you know, every video, everyone on the internet, I think, always says that as well. Of course it is, but before a trend occurs, it needs to start. But how's it start? It needs a push, right? It's a little bit of momentum, needs to build up. This is where absorption comes into play, right? Normally you would not think of absorption as momentum. But what's happening in the market, right? The market moved in one direction, then it met either support or resistance, which then pushed it back in the opposite direction with early momentum, right? When it hits the other level, right? If it goes from the low area with absorption at the low to an area with absorption at the high, that's your momentum on the high, right? Your early momentum that the trend is reversing. So this concludes Module 5. In Module 6, I'm going to discuss absorption trade setups. And you'll learn clear-cut trade setups that you could add to your trading arsenal. Again, I don't think you should take each one and say this is it, it's written in stone. You should take them and build your trading plan from. So I'll see you on the next module. Bye-bye. Hey everyone, it's Mike and welcome back to the Orderflows Absorption course, Module 6, Absorption Trade Setups. Now before we begin, a brief disclaimer. This presentation is for educational and informational purposes only. It should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Alright, so the 6 setups I'll discuss here is setup number 1, the dead cat bounce. Setup number 2, irrational exuberance. Setup number 3, capitulation. Setup 4, price exhaustion reversals. Setup 5 is absorption pullbacks. And setup 6 is absorption breakouts. Okay, so the first setup is what I call the dead cat bounce, and it occurs in downtrend when buyers appear at a low. The price rallies a little, goes sideways, and selling reappears, and the market continues lower to new lows. The outlook for the market is still terrible. At a high, people don't refer to it as an inverted dead cat bounce, but it can happen at a high, and when it does, it's aggressive sellers appear at the high, prices fall off, then goes sideways, and aggressive buying reappears. The market makes new highs. Now this is a trade set up for continuation. Now we've all heard that, if we've all watched TV and we've all heard commentators say, oh, this is a dead cat bounce. They're expecting the market to go lower. Now, what I find as being the telltale sign of this type of move is stacked buying imbalances appearing just before the new high is taken out, stacked selling imbalances appearing just before the low is taken out, and the market has already made a new high or low, so it's coming back, right? It already made the high. It starts bouncing up a little bit, and then you see another round of selling. So made a new high or low, established, and circles back to that. Circles back to test it. Now you don't always get those imbalances, stacked selling imbalances or stacked buying imbalances, but when you do, I like to watch how the market comes into the low. So the key is the pause after the low is made. It could be profit taken, as it could be the long-term traders not wanting to overpay if it's going to a high. As a trader, you don't know what the reason is, and when I say, it could be profit taking. Imagine a market that's been selling off here, right? It's been selling off. Everyone's been short. We hit a low, we bounce a little bit. People that were selling are taking some profits here. Okay, they're lightening it up. And then another round of selling comes in, and the market sells off again. So for this type of setup, it's really, you have to apply what you know about order flow, right? It's not just an automatic setup that you can just tell right away that, oh, this is a dead cat bounce, and you can get short right up here at the high. You don't know, right? You don't know. So what I'm looking at is I see the market coming down. It's coming down on decent volume, starts going sideways. I do have this bearish point of control right up here near the top of this bar, which is a bearish sign. Obviously you still got the positive delta, but it's a red candle, so that's also a bearish sign. Then I start coming into this low down here. Okay, I see one selling imbalance. Now granted, it's a 5-minute chart. You don't get a lot of imbalances all the time on a 5-minute chart because there's a lot of trade going on over that 5-minute period. As you start coming into the low, I notice how we take out this low. You also have this imbalance. Now, there's probably some other imbalances as this market's trading. This one's stuck. You finish that bar. You got 1, 2, 3, 4 imbalances. Now, would I like to have some sort of other sign, like a big stacked imbalance in here? Yeah, but like I said, you don't always get what you want in the markets. But based on what I'm looking on this bar, okay, I know that's bearish. I have this inside bar, which is also, I'm waiting to see how this market reacts. This is a sign that the market's pausing. You have the inside bar. Got this bearish bar here. I know I'm coming down into this low. If I wait until this bar closes, I really have the confirmation. People say, well, you're waiting for the bar to close. You're giving up an extra 2 points. Well, yeah, if the trade is not here necessarily, you don't have full confirmation until this bar is closed. You have a bit of confirmation here earlier in this bar at 10:05. Once this bar is closed, yeah, you could feel fairly confident that there's more to this move. Okay, so here you got your first bounce here, heavy volume. You got your inside bar, takes out this low. Yeah, okay, honestly, I'm not convinced that this is really a dead cat bounce in this one bar, just because you have one inside bar. But when you get down here to this low, you do rally up. I mean, you do have this divergence. You got this nice little rally, okay? And you're thinking, well, this is it. This is our rally up to new highs. But if you start watching, keep your eye on what's happening in here. Yeah, you have the strong delta here. These 3 bars, kind of bullish. But then it goes sideways in here. Then boom, you get the big selling comes in again. The stacked, or sorry, the multiple imbalances in here. You're starting getting the lower point of controls. Then watch as you get down towards the low. What's happening? Do you have price exhaustion or what? Instead, you got that stacked imbalance going right into the low, and you take out those lows and make new lows, go sideways, make new lows. Now the dead cat bounce is not something that you're just looking for the quick hit. It's going to take a while. It's got to circle around, comes in, takes the lows. Now you got to remember, right, when you're trading breakouts, you don't always just take out the low and immediately go low, 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 low. You take out the low, you might bounce around, go sideways, bounce up a little bit, take out the low, go sideways, bounce up a little bit, take out the low. So if you're trading with, a very tight stop, say you have, your entry down here at 58.60, you can't have a stop here at 58.65, a 5-tick stop, because you're going to get pullbacks, right? You got to remember, the market's been dropping. People cover their shorts, market starts to rally a little bit. It looks like it might start rallying higher, and then it circles around and comes back down. So you got to manage the trade. Look for signs in the order flow, right? This wouldn't be getting short on this bar here or this bar. This is what I'm looking for on the bounce. You got to get a bounce first, but then you get your trade opportunity. So you're coming down in here, low, 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 low. You hit this low, you got the inside bar, sign of sideways activity. Start going sideways, sideways, sideways. Then you get this bar, right? The low is here. You get this bar, 1 tick off the low. Selling imbalance, selling imbalance, selling imbalance, multiple imbalances in the bar. Remember, I treat multiple imbalances, 3 or more imbalances in a bar the same I would a stacked imbalance. That's why I have this box drawn. That's why I use my software and I have the box drawn around the bar to tell me there's multiple imbalances. You take out the low right here in this bar. You trade lower by a few, 3 ticks, 4 ticks, and then you go sideways, you bounce up a little bit, and then you get the push down again. So, as you get the breakout, but then it goes sideways, it circles around, and then takes out the low again. You're bouncing here, right? People are looking for a low, but the selling is not done yet. But overall, the outlook for the market is still negative. So here, right, you get the big push down. This is gold. You get the big range expansion bar here. Multiple imbalances near the top. You hit this low, positive delta. You start going sideways. Then you come in here. You hit this low. Right as you hit the low, you get that stacked selling imbalance in there, and you make new lows. Now, where would you be looking to get short? Well, as soon as you see a stacked selling imbalance, do you have to wait for this bar to close? Well, you can, and you get a little bit more out of the trade. It does make a new low and make a new low. I mean, that's the problem with you're trading breakouts sometimes. You may get a breakout, but it's not like a breakout that's going to become some massive runner, right? Because when you hit a dead cat bounce, people are already looking for lows, right? They're looking to position themselves to possibly get long. So sometimes there's not a big capacity to get low. So how can you trade it? Well, you can trade a pull back up if it bounces up again, or you got your trigger, you got your stacks down and balance. You should be watching what happens when you take out the low. I mean, there's different ways to trade it, right? You get short right after the new low is made, or most conservatively, you got to wait for the low to be made. But I don't like that. I think when you're trading breakouts, you got to be a little bit more aggressive than conservative. Like I said, you did get a further breakdown over the next couple over the next bar over several ticks, but technically, yeah, you got the breakout, but it didn't really go anywhere. Or you could play a pullback up towards where the previous low was, right? Because previous support becomes resistance, so that's going to give you a low risk entry. And then you manage your trade from there, right? You have a trade plan in place. I know a lot of people, they discount the simple stuff in life, but previous support becomes resistance. Previous lows, when you test back up to it, is going to become your resistance, just as previous highs become your support. So you get the big down bar here and the new low. Get your inside bar, start going sideways. Get the push here. You already got 1, 2, 3, 4 imbalances before you even hit the low. Take out the low, and you just go lower. So for me, one of the triggers on a dead cat bounce is I'm always looking for an inside bar, right? Sometimes you get them. Sometimes they look like this, though. This is not an inside bar where you just take out the previous low by a tick or two. This one is like 2 or 3 ticks, but as long as majority is in there, usually it's a lot neater, like this type of inside bar, like this type of inside bar. But I'm really looking for that because that's I need a sign that the market is going to go sideways for a little while to get a bounce back to test that low again. Now here's one. Okay, you're coming into the low, you got the stacks down and balance in here, and you just blow right through the low again. If you had to stop somewhere down here near this low, okay, now I wouldn't consider this type of bar here a trigger for a dead cat bounce. Can you take a trade here? Yeah, you can if you're a breakout trader. This bar wouldn't be the dead cat bounce trigger bar. Let me rephrase that. This bar would not be the bar that, this is the down bar that you got to look to for, I'd be looking for the dead cat bounce. This bar should be lower here, basically, is what I'm saying. When it's up here like this, it's, even though you did come back down and take off the low by 2 ticks, this is not what the type that you're looking for. The market has already rejected these lows in this bar, actually, and is already starting to rally. You start coming back down here. This bar, if this bar took out the low, and closed down here, then you get this inside bar. And this inside bar was, closer to the low than closer to the high. I'd possibly be looking for a dead cat bounce, but this is not what a dead cat bounce looks like at all. So don't try to see too much into them. Like I said, look for this inside bar here, right? Look for this inside bar here. That's for me the sign. After you get that big push down into the new lows, look for an inside bar right after. To me, that's the sign. That's the sign that you should be looking for. Now, I didn't put dead cat bounce at the high because you don't refer to dead cat bounces at highs. But it would be the opposite of what you're seeing at a low. Now, the setup number 2 is actually more of what I consider a dead cat bounce at a high. It's sort of the opposite of 2 things. One, capitulation, which I'm going to talk as the next one, and a dead cat bounce. But anyway, irrational exuberance. For those of you that are old enough to remember back in the 90s, gosh, I think it was 96, Alan Greenspan was giving a speech on December 4th. I think it was December 4th, but it's funny because I remember it was the speech I came into and it was fucking going nuts in there. It was, everyone was selling everything. And I'm like, what happened? Like, oh, Greenspan gave a speech. I'm like, yeah, so what? And he said, the term they said was the market's, got irrational exuberance, meaning, it was overpriced. He said, what did he say? He says something to the effect that irrational exuberance had escalated asset values, and the market just got hit. The Asian markets, Globex, S&Ps sold off massively, and this is when S&Ps are still trading 400. So you're down. We hit limit, I believe, overnight, and then when Europe opened up, no one knew what happened, honestly, in Europe, because they just sort of woke up, and all of a sudden the markets are down, slammed, and everyone is not panicking, but everyone is like, what's going on? And when you don't know, sometimes you just sell. But what happens is it occurs after a sharp rise in market price attracts hot money to the market, week long, so to speak, which causes the market to rise even based further on nothing special. But think of Bitcoin, okay? FOMO, fear of missing out. When you had that big run up in Bitcoin to almost 20,000, people describe that as irrational exuberance, right? And once traders realize we're in an exuberant market, traders come back to reality, the decline is very, very dramatic. Exuberant rallies are difficult to sustain because the value of what's being traded is so far out of line with reality. It's almost like, Beanie Babies. You could think of all these bubbles, right? When people think of bubbles, they think of the term irrational exuberance. Now, the opposite of exuberance is capitulation. Fear is overtaking greed, and traders cannot withstand any more pain. They just want to get out. Sometimes you can go from irrational exuberance to capitulation very quickly, and capitulation is the third setup. So when you have capitulation, everyone just wants to get out. Their loss is blown beyond their expectation, right? We've all probably been there. I'll admit it. I've had to capitulate on trades. I had the sugar trade years ago, back, I think it was 2010. I knew sugar was going to go up, and I had bought it, and it didn't go up. It just went sideways. It went up like initially the first day after I bought it. And I was telling all my trader friends, this is it. We're going to go from, we're going to rally, we're going to double or triple in price. Eventually, it did work out, but initially it didn't. And it just took a lot of heat, and eventually I had to sell. And, to me that's capitulation. We hold on to a trade too long, and then we got to get out. And the institutional traders wait for this moment to either go long or cover their shorts, because obviously institutional traders oftentimes are the ones that are on the other side of the retail traders. Basically, the herd of the crowd is the last to act, right? This is a reversal setup. So with irrational exuberance, when the buying starts to dissipate and the herd buying becomes exhausted, there's no more buying to move the markets higher, as the bigger players have been distributing their supply on the move up, right? Other aggressive sellers start coming into the market and hitting bids. And I remember what I was telling you, right? When your market is rallying, you have the institutional players often selling into those rallies, right? And then, they don't necessarily just come in immediately and start selling. They don't just all of a sudden wake up, alert on the top of the computer starts flashing saying, oh, red alert, we're overpriced. We're outside of value so much, sell. It's not like that. But, for the bigger short-term traders, they realize that, and they start pushing it down. That's where this is where coming, recognizing the big, the big short-term traders comes into effect. So rational exuberance, right? It will look like this, right? You got the big up bar followed by the big down bar. But you notice on the big up bar, right, you got the buying imbalances, you got the heavy volume, the very big positive delta. But then immediately next bar, selling imbalances, multiple selling imbalances, the big negative delta, the big red bar. Now, would I like to see it close lower than the previous bar? Yeah, that's nice. It doesn't have to. But really sort of what you're looking for is this flip in what's going on, right? Notice the max delta 4337, min delta minus 21. Closed at 3,269 here. You got min delta minus 5747, max delta 31, and we closed the delta at 5722 minus 5722. So it went from all aggressive buying to all aggressive selling in terms of delta, and we closed lower, right? Everyone was buying. Oh, we're going on new highs. Oh, wait, whoops. I'm sorry. I shouldn't have hit the buy button. I should be short. And then come in and everything sells off. Here it is again, right? You want it to happen on very good volume, ideally. Now here you don't have the the stack selling imbalances. You have the stack buying imbalances going into the high. You know, everyone is excited at these prices, right? It's nice to get the stack selling imbalances or multiple selling imbalances in the red bar. You don't necessarily have to. That's not a killer, you know, a trade killer if it doesn't appear. As long as you got a nice strong negative delta, you know, that's important. And volume, you know, it should be decent. You know, 14,000 here, you know, outside the big up buying here, 20,000, you know, you're getting bars in here, you know, 14,000, it's a little bit less than average. 16,000, 19,000, 15,000, you know, 17,000. So it's decent. You know, it's not the end of the world. It's not such a small number. It's not like 8,000. It's still healthy. But you're looking for basically that reversal, right? If you were to break this bar down like this here, right? This is the delta bar, right? This is the same chart here, okay? So I talk about having a different chart, an additional chart up to help you see these things. You know, here, look at this high. It's mostly all aggressive buying, right? You got one here, 109, 45, 21. And then this bar, the red bar, all sell, you know, other than the top two bids here, or top two offers that traded here, everything is hitting the bid, everything, every price level here. So it's like the mirror opposite of the big bar up. Now you have this bar here, but people say, well, don't you have it here? Well, this bars, you do have this counter trade down in here, down in here, down in here, and up here. You know, it's a little bit more evenly split, whereas up here is really slanted to one side. You know, people say, well, what about this one? Well, this bar is, market's already coming off here, right? You're ending up almost as a doji in this bar, which is already a sign of a reverse potentially happening. You get this bar is kind of mixed. You got some selling up near the top, some selling up down near the bottom. So it's a mixed bar. You know, then you just start going sideways again. Then you get that big push up, the last big push up. And then people say, nope, sell it back down. Okay, so this is also a delta chart. This is a different market. This is crude oil. And again, what you're looking for is a bar like this, right? The big delta up, big volume up, 9,000. And then people come in and say, wait, big delta down, minus 792. Do you have any delta, any positive delta stronger than that? No, you don't. You even got the stack buying imbalance in here. You can't see it this price level, but on the order flow, on the underlying order flow chart, there's a stack buying imbalance there. That's why you have this green going across. Volume is decent. It's not 9,000 that you did earlier, but you got 6690, which is still strong for what you're looking at before. And majority of this, everything is on the bids here. You do have a little bit of counter trade, but again, big delta up, positive delta up, followed by stronger positive delta down, and then the market goes sideways before it eventually falls down, falls over. Again, this is similar here. You get that big bar up, the big volume bar up here, 16,000 volume. You hit this bar, closes right on the high, opens up a new bar, trades a couple ticks higher, get the big selling coming in here. Now this bar, you know, I'd look at it and say, yeah, you know, maybe, you know, you do have a divergence, you do have a little bit of counter trade, and you might not be convinced yet. You know, it doesn't have to be that you get the big up bar, you got to have the big down bar. if you were to merge these two bars together, right, this bar and this bar, all of a sudden it's going to look like this. People sometimes don't think in that respect that, well, let's look at it over the next two bars, right? Take them together, and you're going to have this big down bar with mostly hitting the bid. And look at this volume, this delta, minus 1066. So when you're not convinced on this bar here, you wait for the next bar for further confirmation that, yeah, okay, I'm leaning towards short on this bar, but once this bar comes in, then you should be convinced. That's the thought process that you have to go through. Go through it. Don't say, well, this one didn't. This bar only got 422. Doesn't meet my expectations, so I'm not going to take the trade. But then when you start seeing, well, the next bar, well, it had even stronger negative delta, twice as much on basically the same volume. So I know that the sellers have appeared. You could get short. Where's your risk? If you're getting short, somewhere in here in this next bar around 50, where's your stop? It's somewhere up in here, at 65 towards the high of this bar. Because if we're going to start going higher, you don't want to be short. So, if you're getting short somewhere around 50, you got to stop, maybe around 60, 65. That's what, 15 ticks. But you're short at 50, down to where? Down to the 20s. It could go lower, which it did. But, that's how you got to think, right? Don't just limit yourself to, to this one thing. Say, it's got to be in here. It's got to be in here. If it's not, then it's a failure. This one has a fail. Now, to me, this is the bar that sort of triggers the irrational exuberance. We're going higher. You've got, volume of 8,000. I don't consider this one here, even though you got a big strong delta of 725. The volume is just average. Here you get the big push up 8,000. Then you get the red bar coming in here, with the stack selling imbalances. Strong negative delta 644. I'll be looking for the market to sell off. It doesn't. It just goes sideways, sideways. You already got two bars. Market's going sideways. If you're short and the market's going sideways and starts going back up towards the high of these two bars here, that's not a good sign. It takes out that high, it fails. This bar up here, you're high because volumes jump because cash just opened. So obviously you're putting in some relatively small volumes. All of a sudden you're looking at 11,000. I mean, when I say cash, I'm talking about the cash of equities, because this is crude oil. But during those certain times of days, you got to realize when you're going to get some sort of volume pushes. And people nowadays work all sorts of exotic products. This market against that market. So if people are working S&Ps against crude, and people do these weird things, combinations now, these weird spreads. So I'm not surprised to see a volume push right up at 830. Now, again, this bar is already starting to come off. For irrational exuberance, the trigger bar should close higher, much higher, like when I say higher, closer to the high, then rally up and then sell off like this, like here, right? We're closing right up here near our high, right on our high. But this one, it rallied up, then sold off. Then you get this bar here, which again is a bearish bar. I mean, you could make the argument, oh, you got some irrational exuberance here, but this is not how I would categorize it. Sometimes it's easy to say, yeah, this is it, but it doesn't necessarily meet the requirements I'm looking for, right? The green bar ideally should close higher, because now when you get a bar like this, you're already sort of looking at a reversal type of bar. Now this one, when I first put this up here, I was looking at this bar, and I say borderline because there's a lot of borderline. I don't have the heavy volume here, right? This small little high here, and then the next bar, it's an engulfing pattern. I'll say engulfing pattern, but it's an outside bar already, so it's already closing below the low, which already is a bearish sign. Then you get this bar right here, right? 15,000 contracts traded. But again, it's not the type where it closes up near its high, right? It's already sort of reversing, and then obviously you get the big down bar here. again, on very heavy volume, big negative delta, but this is not really what I would consider irrational exuberance. I'd still want this bar to close up here at the high. This bar over here, 16,000 contracts, it closed up. This bar, negative, strong negative delta, 3.6. You got a couple of selling imbalances out of this one, or these two here, or this two right here. I'd consider this one closer to irrational exuberance, but this isn't a high, right? This one, we're coming back up towards the high, and that's the problem. Then it sells off a little bit and just rallies back up and goes sideways because you're already running into the close. Now, one thing to keep in mind is, people say, well, look at this volume, 61,000. Well, that's at 3 p.m. Chicago time, which is when the cash market closes. So you're going to get a lot of orders there. And honestly, depending on what the market is doing for the day, sometimes you're going to get a lot of big market on cash close orders, and people have these algos that start them early. And depending on how big the order is, they could start 15 minutes early, they could start a half hour early, because really what they're trying to do is target where it's going to close. Okay, so imagine, right? You're coming into the close, oh, I got 5,000 E-minis to sell or 10,000 E-minis to sell. They'll start spreading it out. All right, imagine if they're selling it here, and we close, where we close here? Like, I forgot which bar, this one. And they're selling on the way down because they know they're going to, their order is so big, they're going to push the market down. So they start it early because they're really trying to target this price. So, maybe their average price is, a point better, and then the trader looks like a superstar. Now, this, would you consider this irrational exuberance? No. This is something else. You got your big up bar here, right? People say, oh, you got your big up bar. It just has a decent up bar here, but this one is more telling because the volume is much stronger, 24,000. Even though here, when you're looking at 15,000, you're thinking, well, it's 15,000. It's, it's much bigger than it was earlier. This bar, this red bar it should be more towards the inside, because what you're looking for is irrational exuberance after the green bar. Here market still runs up another 2 points, right? This is another type of short. This is a ratio and divergence, which to me is the bread and butter trade. I always talk about the ratio and divergence. Even the move from here to here is good, but to catch this type of move is, that's just icing on the cake. Now, again, irrational exuberance. This one, I have the question mark because would you consider this irrational exuberance here, this high here? No. And then it's a bit drawn out here. Now again, this is E-minis. This is, notice the time, it's 4 in the morning. You have this big run up here. Now this is a very bearish sign by itself. I would not consider this irrational exuberance because, even though you have, the big strong volume, 1600, it's not overwhelming. It's not like a hit you over the head type of volume. Back here you got 2,300, 2,400, 2,300. You got enough bullish information already in this bar. I wouldn't be looking to extrapolate this as saying, well, this is irrational exuberance. I've got extreme point of control here. I've got a ratio and divergence. To me, that's already the sign to get short. And then the market sold, immediately sold off. But even if you miss that, you did get a little bit of a pullback to catch more. But can you get short here? Well, you have a divergence. You got a prominent point of control. But, I'd like to have a ratio as well. But this is the bread and butter trade. But I would not consider either of these necessarily irrational exuberance. Like I said, sometimes you want to see things in the market for whatever reason, but it's not really there. So, just be careful on what you're trying to describe. Okay, so that's setup number 3 is capitulation. It's the opposite of irrational exuberance. It's a reversal buy setup. And it's really easy to see on a chart. You know, big red bars, heavy volume, lots of selling imbalances, a strong negative delta. Near the end of capitulation, the market turns when sellers become exhausted and the last seller is sold. Passive accumulation appears almost to arrest the market from dropping further. Now, the difference between capitulation and dead cat bounce is capitulation, the market's not going to drop further. This is where this is where the drop ends. Okay, once traders think the bottom is formed due to signs of passive accumulation, the next phase is aggressive accumulation. And what makes capitulation such a juicy trading opportunity is it occurs when the herd is collectively wrong and get out. Right, the herd, you know, the retail traders, the public, so to speak. And if you believe that the herd is always wrong, this is your prime opportunity to trade when they're most wrong. Right, spotting capitulation early is key to a more successful trade. You know, if you enter too late, you join the herd as they start buying back in, and you're competing with them for the offers, right? Because, you know, if you come late to the party, you're not going to get a pretty girl. Capitulation and exhaustion occur at ends of moves, not in the beginning or middle. Oftentimes, you see the market start moving in a direction, then it just really picks up steam and ends in capitulation or exhaustion, depending on the direction. It's usually punctuated with volume spike, which is indicative of FOMO, or fear of, that's actually not FOMO, fear of missing out, or fear of holding a losing position. I sort of combined capitulation and irrational exuberance on the same page there. But for capitulation, it's fear of holding a losing position. Capitulation has two unique characteristics: a sharp, almost vertical price drop, usually occurring over several consecutive down bars closing on their lows, right, with the heaviest recent volume with strong negative delta. Okay, we've all seen these big bars like this. Boom, close right on the low. Strong negative delta, strong volume. Boom. And here you don't have strong negative delta. You got strong volume. Here you got strong negative delta, strong volume. You get your inside bar. Notice it starts going sideways. Aggressive buying starts coming in. 600 positive delta, 340 positive delta. You're seeing the imbalances on the bars before the market starts taking off. Now, this is the bar I showed you earlier, right? When irrational exuberance, I was saying this is not irrational exuberance. Now you get this capitulation here. This one's tricky. Honestly, it takes guts to buy after a bar like this. This is such a big bar, from 54 down to 41. For someone to come in here, I think that's gutsy. Me personally, I wouldn't do it. I said that's too much. But this is what capitulation looks like. Then you come back here with, you know, a decent, strong positive delta. Even in here, you got buying imbalances in here. So you know, you did cover back most of that move lower before you went lower or sideways to start drifting sideways to lower. But again, you know, this is what it looks like. I prefer it to be a little bit more methodical than one big bar like this. I prefer it to happen, you know, push lower, rather than wham, get everything down there. Really, that takes guts to stand there and buy it like that. Because, you know, you buy it like this and you get another bar like that down. Next thing you know, it's 10 points against you. I like a little bit more methodical activity in my trading. Like here, you got big bar down, another bar down. Okay, now I start seeing I'm starting to see the signs, right? I'm starting to see the imbalances. I do have a divergence. I do got ratio. And yeah, I start feeling a little bit more safer on this buy back up, right? If I'm buying in here, in this next bar after this bar with the imbalances, where's my stop going to be, or where's the area I'm going to be looking that if we test to possibly get out, is where the point of control is on this bar, right? You see how we came back down to within about 2 ticks of that point of control before moving back up. Okay, look at the volume on the green candle on the low, 9,000. It's a nice healthy volume. Now notice you got your capitulation here, then you just sort of go sideways. then you get another big push down on, again, healthy volume. Now what's interesting is this big push here, 14,000. This big push here, 8,000. So it's 6,000 less. So it's like 40% less volume, which, going back again to the basic volume analysis, the volume on the big push lower to new lows is less than the earlier push low, which again is a sign that, well, less people are participating on this move down. Then you get the buyers coming in here. Even though it's a smallish delta, you got bigger volume than the previous one. So I know, you got a little bit sign of absorption going on in here. And the market starts going back up. Here is where you start seeing the aggressive buying coming in. So realistically, you'd be looking to get short somewhere in here. I wouldn't be getting short necessarily right off of this bar, but this bar here with the multiple imbalances is, to me, is the area to be getting long in, from the 25, 27 area, get up to into the 40s before you get a bearish sign in here. Crude oil. Pushing lower, strong negative deltas, 800, 925, 800, 424, 752. But then notice here, you get down in here, it's only 20. Then on here it's positive 70, right? Then 169. Now with capitulation, right? Like when I was talking about rational exuberance, right? I was looking for a bar, ideally, that's going to close somewhere, the high and the low are relatively evenly matched. With capitulation, I find oftentimes you tend to just overexert, right? Because the selling, markets sell off faster than they rally. And you sort of get this knee-jerk reaction. Everyone is selling, selling, and then boom, it snaps back really quick. I'm willing to forgive, if you overshoot the low of the red bar a little bit, just because I know that, the way people react in selling is, they just got to get rid of it. Then I look for the aggressive buying. I look for obviously the first thing I want to look for is buying imbalances, but if I don't see it, I'll be watching the deltas. This is actually the delta surge here. But by this bar, positive delta 559, is telling me that, this low can hold. And I'll be looking for it to go higher. It just goes sideways though. Okay, so here, let's take a look at this. So, this is where it gets tricky, with capitulation. People say, well, this is capitulation here. Like you see this red bar all hitting the bids, followed by all buying. This is the opposite of what I just showed you on FOMO. But with capitulation, this market is working its way down, right? It's just working its way down slowly. Really, with capitulation, I like to see the sharp drop, right? Like this. Like not a market that's sort of working its way back down. I do like this, the way it looks on the chart, where it's all selling, basically all buying. You got the strong negative delta followed by the strong positive delta. This is a delta flip, actually. You got 0 to 0 here, all negative versus all positive. Obviously, you got an inside bar. It indicates market might go sideways a little bit, so I'd look for another sign. But this, I would not consider this capitulation, but I'd consider it something else. But it's still a very bullish sign to look for. So it's a mirror image. I'd be looking for, if it's capitulation, I'd be looking for this bar to be a little bit higher, and I'd be looking for the sell-off to be more dramatic than that. This is it. This is the same thing right here. This is the this is the volume footprint chart. This is the delta chart. And again, I prefer it to be, a straight down price drop, dramatic. This is a market that's just sort of coming in for a landing, like an airplane coming in for a landing. Airplanes don't just drop at 45 degrees in for a landing. They sort of just glide right in before taking off. It's bullish. It is bullish. I'll give it that much, just based off of what you're seeing in here with the deltas. But I wouldn't consider that necessarily capitulation. It's not like, oh, I'm just taking too much heat. Oh, we get a bounce up. come back down. I can't take it anymore. Then you get that push. You take it, look for this. If it was real capitulation, maybe this bar would be bigger. Now, I just threw this in there because, like I said, there's certain days, you don't want to be trading. Would you consider this capitulation or this capitulation? Well, honestly, I I wouldn't be looking to trade on a Fed day. Here you got the big down bar, big strong negative delta, and here he's followed by the positive delta. Market just goes sideways, and you get the other push down here. Do I consider this capitulation? No, I don't necessarily see the aggressive buying coming in here. I still see a lot of passive accumulation. And then over here, maybe somebody, would, if you start to see a lot of buying imbalances in here, people will say, well, yeah, how could you not buy that? And then look, you get rewarded here. I would not want to stand in front of this period right in here. So, for me, if it was capitulation, I'd be looking for a stronger delta there. This one, people say, well, 11 o'clock, it gives you 2 hours before the Fed announcement to trade. Well, okay, but I know that the volume is going to be lesser. You can see how at some point it's going to dry up. You can see here at the last hour how the volume is. Here you're trading anywhere between, here's 9,000 to 27,000. Then in here you can't even get above 8,000 contracts in here. So everyone is at this mode of just wait. So don't get there's certain days of the trading calendar to stay away from. Now price exhaustion reversal. Let me drink something first. Occurs when there's declining volume or delta going into a higher low. At a high, buying is decreasing or drying up. Prices simply become too high and buyers no longer interested in getting long, as the capacity for a further move up is extremely limited. At a low, sellers are exhausted. No one is interested in selling so cheap. As the opportunity for prices to drop further are limited, there will be no chance to cover the shorts at lower prices. Conversely, at a high, traders holding supply are not yet ready to start offering the supply because they're not yet convinced it's high enough. At a low, demand is not yet built up enough for traders to come in and start being aggressive. This is a reversal trade setup depending on existing price trend. So, what does it look like? You're looking for the reversal. Now, the first low you have here, would you consider this the exhaustion? No, I mean, look at it. Traders aren't getting exhausted yet. They're still selling massive amounts. The selling is getting stronger. 300, 2889, 3054 in the delta. Okay, you make the new low. Here, you got strong delta, right? That's not what you're looking for. What you should be looking for is this low here. It's coming into new lows. Volume is, the delta is 1500. Then it's only 700 and starts reversing. You do have a nice point of control towards the bottom. I don't have the PLC trader turned on, but I know that is a prominent point of control. And then you see the delta switch is positive 2000. That's a good sign in there of potential low here. I would not consider these lows because you happen these lows on the strong negative delta. What I'm looking for is the deltas to get weaker coming into the low, not stronger. Now this one failed, right? It started out okay. You're coming up into this high here, right? You got your deltas contracting 1700, 1500, 300. Then you got the big strong negative delta 1100. Here it's still a strong negative delta, even though it's weaker, but it's still strong 700. And then you just come right back with the last big gasp of buying in here. Positive delta 2000, positive 1100. Selling comes in. This one is. This is what drives people nuts in the markets is you get your sell signal and then you just poke up, then you come down and they're right. Imagine you're short in here at 63, but you get stopped out up here at 64 and a half, then it goes down to 59. So the operation was a success, but the patient died. Okay, so now granted, you're looking at delta here. Okay, not necessarily the volumes, because this is right when the cash opened, but the deltas are going to get bigger once the cash open. So cash opens, and you see the delta is positive 2,600. Then you get the inside bar. So I'm not really concerned with what's happened here. I'm really concerned with from here over, and you don't get the follow through big buying. You're a little bit lower here, and next bar minus 700. Then next bar minus 5,000. So where's the, you're going from big positive delta to small delta to negative delta to big negative delta, and you can see as you just go lower. Where does this market trade back to? Trades back to this point of control here of the big bar down, right? The big selling bar. That's where your resistance was in the bar, and that's where you trade back up to before continuing on down lower. Here we go. Now again, as you're coming down here, people say, well, what about this low here, right? You got minus 1,500, minus 748, positive 927 with the red bar. It's telling you got positive delta. But if you what I was talking about earlier, look at how the bar is forming and what's happening. Why do you got positive delta on this red bar? It's because you have offers up in here, 1,600, 1,046, 1081. So people were buying this. Again, this point of control setup is a very bearish setup right in here with the higher point of control on a red bar than the previous bar. So don't get too caught up in thinking, oh, we're starting to rally. Look, we got that positive delta. When you look at the bar, it takes you 2 seconds to look. Oh yeah, I know why we got that positive delta, because it's very bearish up in here. You ran up into a pocket of sellers, people with offers in the market, to push down the market, to hold the market there. And you can see how we rallied back up to that level before we sell down. Then you get down in here, all right, you got 889 minus 1,300, then minus 252. That's a green bar. Okay, well, that's runs the opposite of what you just learned right here, right? You got the negative delta on the green bar, so it's telling you that there's supportive buying in here. Down in here, people are selling those bids before it really turned around and started rallying back up. There was someone absorbing the selling. And then you can see the next bar, big strong positive delta, and it works its way up. This is going to give you a low risk buying opportunity in here. What should you be getting short in here? I wouldn't be looking to get long off of this bar earlier, this red bar, but I'd definitely be looking to get long off of this this green bar here with the negative delta. Can you get short in here? Yeah, of course you can. Unfortunately, it just trades right back up there and stops you out, most likely, because I'd most likely have my stop right just above, a tick above that high, and then it makes that move lower, then gives you a nice bullish sign down here, and you catch that move back up. So when there's large buying by funds at the bottom of it, at the end of a downtrend, the activity often has the power to change market direction. Not always, but more often than not. Okay, so you see how we're just selling off. Get down to that low. Look at the deltas. Getting a little bit weaker. You do have this push here, minus 700. Then you get down to minus 20, plus 70, plus 169, plus 559. The buying is coming back in here. The aggressive buying is coming back in. You get up here towards the high. Notice you get the big delta here at 1,000. Then it gets small, right? 139, 76, 93, 304, 121. So at this point, it's already getting weaker. The negative deltas start appearing right before the market sells off. Now, this one here, this high, right? We're going up. We got strong positive delta, 1,100, 1,700, 86, kind of small, minus 459. Would I be looking for this market to start selling off? When I'm looking at the market up until this bar, yeah, honestly, I am. You come down in here, you have negative delta on the green bar. Okay, I take a step further, look at the bar. Okay, well, I know that. Why do I got negative delta? Well, there is some volume in here absorbing the selling. Okay, maybe you're not convinced, but by the time you get to this next bar, you're convinced already that this market probably has some capacity to go higher, which it does. Then you get up here, this is your next trade, right? People say, wow, I totally misread this. I'm gonna wait for the next trade and see if it works out. Don't. You got to be there. You got to take the next trade. So you got 679 on this push up to new highs. Make the new highs. You got positive delta on the red bar, so I know that there's some resistance selling up there near the top of this bar, most likely. Bar is red, then boom, minus 1400. Now, would I be looking to get short off this bar initially with the positive delta? I mean, you can. It's a bit aggressive, but if you wait for this bar here to confirm it, the aggressive selling is taken over. You're talking a move from 60.10. I'm not going to say down to 59.90 where you have the prominent point of control, but maybe somewhere in here, below 60. But this is your sign right here. The delta is getting weaker. You got the red bar with the positive delta, which is bearish as well. Then the big strong negative delta appearing in here before you get this little move lower. This one just went sideways on you, right? You got your big volume push, delta push up here, delta small, positive, the big negative delta, and it just sort of goes sideways. This one, I called this coming in too hot. This is, it's similar to capitulation, right? But this market it's like I said, markets sell off very fast sometimes, faster than the way they rally. It's coming down in here, boom, 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 everything's new lows, new lows, new lows, new lows. But it's getting a bit lesser. The deltas, 4,000, 2,300. Then you get the big positive delta. It just goes sideways on you. I was long in here, and I'm a half hour later, and I'm still around break even. You get out. This one, I think the market was just coming down too fast, too quick, too soon. But I'd still be looking to take the trade, in here anyway. But again, after you take the trade in the market, you get long. Market comes off, comes back, just hanging around. Market's indicative of going sideways, like I said, is point of control is right or punched around the same level, which you see here. Then you get that push down again, and then it sort of comes back up. But this trade just didn't work out. Again, similar crash landing. People say, well, isn't it capitulation down in here? Well, I would consider capitulation if these deltas were a lot stronger, 2,500. So it's a lot less than 3,000. It's very similar to this one in here. But this market drop is just too fast, for my taste. And to look at this as a reversal. Now, if you got down in here and, one of these bars off this low was littered with buying imbalances, I'd probably be looking to take the trade. But when a market drops very fast, I don't want to say I'm hesitant. I'm scared actually to just all of a sudden start have a reason to buy. I really need a strong reason to buy. Then then like this, where the delta is minus 2,000, minus 100, plus 400. Because I find that oftentimes when it drops like that, you get the big volume, the big negative deltas, it's still might have a little bit left to it. I need more convincing to be getting long in here. And I don't like the way these bars are shaping up. This is almost a doji. This one, we opened, rallied way up, closed right down near where we opened. Even though the point of controls are bullish by itself, I really need to see the aggressive buying in here. The buying that you saw earlier is no longer there, right? Why isn't this bar closing up near the high and rather down near the low? So it's telling me it's just doesn't look good for trading opportunity. So setup number 5, absorption pullbacks. It occurs in trends when the market is moving in a particular direction, not at a new high or new low yet, but pauses for whatever reason, goes sideways before continuing in its original direction. Look for volume to pick up. or delta, volume or delta. This is a trend continuation setup, right? Everyone says you got to ride the trends, right? You got to ride the trends. Well, look for it. Okay, so here the market's going up, 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 pauses, comes back down, rallies back up. Well, what's the sign? You know, look at the volumes. 9,000, 10,000, 15,000, then 9,000, 8,000, 5,000, then it pops back up again. 7,992, another 7,000. So there's still room left for that move. Okay, here, so you got your high. You start selling off. You bounce a little bit here, right? The trend now is down. I'm not looking for this as a necessarily as a trend back up. I'm already establishing that this is my swing high based on, you know, things in the order flow, right? Negative deltas. This point of control is bearish here. Obviously, I got the single print here. So at this point, I've already considered it's reversing, right? So then I'm not looking to buy here for market to go back up. I'm already looking for this market to start selling off. But again, you know, maybe you look at this chart, you see something completely opposite. You say, oh, Mike, you know, you got to be buying there. You got a delta surge here. Well, yeah, the delta's picking up, but it's, look at this. The highest is 113. It's not higher than any of these other previous numbers. So, you know, if it was 1,300, I might be looking at it different. And then you get the big volume surge here, 23,000, and the market continues on down. You know, it's, yeah, it would look different. Like I said, if these numbers were different, 1,000, right? It's less than the volume on this move lower, 9,000. Okay, so you hit your low here, right? You got the big down bar, you got your up bar, your big volume down, decent volume back up, and it's just sort of going sideways, sideways, sideways. And people say, well, hey, you got a big volume down here, okay, but you got, you know, big volume up here. So, you know, these these sort of wash each other out. You know, would I be looking for a move back down in here? You know, it's possible, it could, but do you have really any sign that it's possible that it can? Right now, you don't. Right? You don't really get a sign to be getting long that this market is starting to rally till about here. Right? There's not a lot of buying imbalances in here. You know, you're looking at this, the market is sort of going higher, green bar, negative delta, negative delta. What's it telling you? There's supportive buying in here, supportive buying in here. Point of control's higher, which is also bullish. You know, when you start stringing together point of controls going higher, obviously that's, you know, value in the bar is moving higher as the bars move higher. It's a bullish sign. Then you get your big positive delta here. You know, you're getting in this bar ideally at 58.70, and it's got to move up to, you know, above 59 bucks. But again, there's not much information in here. The market's just going sideways. There's not much till you start seeing it in here with these deltas, with the green bars telling you the support of buying. But really, I wouldn't be looking to get long, you know, a strong confirmation until this bar here. Now, again, you know, sometimes you know, I put this chart on here because oftentimes, you know, people like to look for stuff that, you know, probably isn't there yet. You know, would you consider this a pullback? You know, this market's going sideways. Okay, you're going to consider this a pullback, or you can consider this a pullback? I wouldn't consider either of these at this point. You know, for me, the market hasn't established any trend in any direction, right? If you're looking for a pullback, you should have established a trend, and it's just nothing. There's just nothing happening. You know, people say, "Oh, yeah, I'm going to try. I think there's a pullback here, or I think there's a pullback here." Well, you're in a very tight range. You know, there's not an existing trend to get excited about to look for a pullback. Now, this is you know, here you have established trend, right? We're going lower, rally back up. Would I consider this a trend or not? Well, you know, I'd be looking, I'd be more concerned with getting long here than getting short, I wouldn't be considering this a pullback at this point, because in my mind I'd already be thinking I want to be long, and I would miss the trade. That's what makes trading so unique, is that people could look at a chart and have two different outlooks. I wish I could say, well, yeah, I shifted my idea to all of a sudden think that this is a pullback to get short. If I was long in here, which I would be more inclined to be long than looking for a pullback in here, I'd be like, hey, this is my low. I'm going to be buying in here. I got the signs that the market's going higher. There's very bullish signs in here. You get to this inside bar. Now again, inside bars you got to be careful with, because it often might trigger some sideways activity or potential reversal, or obviously it can be continuation. When you get down into this bar here with the big volume, 15,000, that already, that's the sign. If you were still long by that, this bar would stop you out right here. But even that, I still wouldn't be looking to be getting short off of this bar. Instead, I'd be, as this market's moving, I'm looking at this bar, I'd be wanting to get long already. You got your ratio, bullish ratios on the way up. And, sometimes you're sort of caught in a trade already that of one type, right? This is, for me, this is a very bullish setup that I'm not necessarily looking at this point like, oh, this is a short setup here. I'd be stopped out, even though, when you start looking at this, then I say, okay, yeah, that's probably a pullback. We're in a downtrend. I tried to buy it. I'm wrong. You get that big volume here. But I wouldn't be looking in here as this a pullback being set up, not until this bar comes in. But once this bar comes in, I might be considering to get short. But really, I'm so hypnotized by this initially that I'd be looking to get long, and I would take the losing trade here and get stopped out here. Now, this is that Fed day again, right? I showed you that earlier. Your pullbacks, right? You hit your high. Honestly, Fed days are days I don't participate in the market. It's just not. It's just too much volatility. I mean, you get fantastic moves, and some people say, "Well, how could you not?" There's so much moves. It's like, the way I describe it is like trying to pick fruit on the tree, right? There's so much low-hanging fruit oftentimes. Just go for that. Don't try to pick the one way out, even though it's a beautiful apple sitting out way at the end of the branch. Don't try and climb out there and get it, because oftentimes you'll fall. But you got your divergence, you got your prominent point of control, market's selling off. Comes back up a little bit here, and then you get slammed on this bar. Would you be looking to trade a pullback here? I'm not that convinced yet, but you get that big volume down in here to make it look nice. Again, sometimes people try to look at these things and say, well, yeah, you got this little bit of a pullback. Nah, they try to justify this move here. Like, yeah, how could I have caught that move? Well, I got this little bit of a pullback here. Not really. There's nothing in this volume to tell you that. Okay, so you have your downtrend established. You got your big up bar, but then you get your bearish bar here. Okay, now again, when I say it's borderline, what I mean is, sometimes you don't want things clouding, your trade idea, right? Because you got your big sell-off, you start rallying back up, but you have this bullish bar here. So when you're long, right, you're not looking for that pullback of the move down to continue on down lower, right? You're looking for reasons to be getting short. Now, you get back up here, right? You got the big strong negative delta. It's bearish in that sense. This one is decent volume, 26,000. Obviously, it's not your 50,000s in here. It's a bit less, but relative to the previous two bars, it's still a bit strong. I'd prefer it to be a stronger volume. The delta is all right, but I'd prefer it to be stronger volume. 26,000 is still a bit less than what it was earlier. That's why I have it as borderline. Again, I'm not really necessarily looking for a pullback at this point. Now, I say borderline, or is this a pullback here, right? You got your big move down and going sideways. You start going up, then you got the sideways activity. Again, people like to say, well, you got this pullback here. No, this is just market going sideways. All right, the volume is lesser, 18,000, 17,000, 24,000. It's small volume relative to what it was earlier. Here you're in the 30s, here you're in the mid 25s, and all of a sudden you're trading 18,000, 17,000. Then it starts increasing. I would not consider that a pullback, not at all. And I'd want a lower low in here if I was looking for this market to be going up. If I was to be looking for this market to continue on down, obviously I'd want to see negative deltas in here and a strong volume red bar, right, for this market to continue on down. It's one thing to look at a market and say, well, yeah, like now, right, you're looking at this chart and the market went up, right? You can say, well, yeah, it's possibly a pullback. But when you put your hand over this right hand side here and the market sold off, bounced up again, it could very easily, instead of going up like this, have gone down. But what's the signs, right? Instead, you're seeing all the positive deltas. That's why I'm not even thinking that this is a pullback to go lower, right? Because we're just overwhelmed with the positive deltas in there. Now, I touched upon this earlier, but I just want to point this out. Now, be careful, right? When you're trying to analyze volumes around cash open and cash close, that's the time when you have the most volume, like here, right? 3 o'clock, 1500 hours, 3 p.m. Chicago time is when the futures cash close is, right? The actual cash market closes at 3 p.m. Chicago time, but the futures still trade. So that's when you're going to see a big volume spike, 57,000. And sometimes you see it occurring a few bars prior, not always. But don't say, oh my God, we have 50,000 contracts traded. There must be something. Well, it's the cash close. That's why. Okay, so try to avoid getting caught up in that cash close number. All right, so the last setup is the absorption breakouts. Now, it's similar to a dead cat bounce and inverted dead cat bounce setup, but the difference being that an absorption breakout doesn't need to occur immediately after a new high or low. Similar to accumulation distribution, occurs when the market has been moving sideways and coming out of a narrow range. This is a trend setup, right? So what's happening is you're breaking out and you're expecting the market to continue in that direction. The problem with breakouts is knowing when the breakout ends. Okay, it can break out a few ticks or it can break out a few hundred ticks. And that's the problem. I used to be a big breakout trader in my early days when I first got started. I would buy breakout and think the market's going to go to infinity, basically. And oftentimes it doesn't. It can continue 5 ticks, 10 ticks, 20 ticks, 100 ticks. And unfortunately, it doesn't always go on forever. It's going to eventually stop. But still, breakouts do provide great trading opportunities. So what you're going to look for is at highs, you're going to look for aggressive buying, imbalances ideally, and passive buying following. So what that means is, people are lifting the offer and turning the market bid, supporting the market as you're taking out those highs. At lows, look for aggressive selling, and then the passive selling following. What I mean is people hitting the bid, ideally if you can see some imbalances, great. If not, it's not the end of the world. But then what you want to see is the offers, big size offers, holding the market down to put a cap on people trying to buy the market to move it back up. So on the chart, this is how it is, right? So you take out the high, you got your buying imbalances in here, great. But then you notice it's followed up with big bids here, 1,000, 1,600, 1,000, 1,100, right? Normally you're not really seeing big volumes like that. You see some in here, 1,800, 1,500. This is a market that's going higher. It's already exhibiting the supportive buying on this way up. Even in here, you're seeing some big volumes in here. This is a 4,000, this is 1,800. And you're going to see, positive deltas. That's what you want to see, right? You want to see the follow through buying in forms of bids supporting that market, right? That's your sign that this market can go higher, right? Because if you have bids, who's bidding big size is the big players, right? Not the retail traders. Retail traders were making new highs. They start getting excited. They start lifting the offers. But like, normal moves, right? You're seeing volumes in the 600s, 800s, 500s, 900s. All of a sudden you're seeing big supportive buying at 1,000, 1,500, 1,800. 1,000, 1,600, 1,000, 1,100. That's telling you that there's people supporting this move, longer term traders supporting this move. Here, you're taking out this high. Look at the volumes: 2,500, 2,000, 3,000, 2,000, 1,500, 1,900, 2,000. Right? Normally, you're seeing volumes in the 900s, 1,000 would be considered big. But as you're taking out this high, you have the aggressive buyers following through, the big passive buyers following through in the market. Here, you don't have the imbalances that you have here in this chart, but you still have that passive buying supporting that market on the move higher. Here, all right, you got new highs. This green line is the high. You got the aggressive buying, the imbalances. And then look at the bid size, 200, 75, 200, 392, 246, 208. So you get some supportive buying coming in here, following the market to hold up market. Point of control here at the high, the bar, point of control here as the market moves up, up, up. Now on the move down, right? Obviously, you've seen this chart before. I've told you about this ratio and divergence. But take a look on this move here, right? What are you seeing? Look at that right here. That volume. To me, this is the giveaway here. This 1,037. Even in this bar, 1358, 1102. Even here, 1155. Even up here at the high, you got some decent volume. When I start seeing heavy volume, it's like this, sort of concentrated at the tops of these bars, right? I already decided we're going lower. Right, I got my ratio divergence. Then when I'm looking at the top corners of these bars and I see some nice chunky volume, that's telling me there's offers in the market. That's why these bars don't go higher. It's because there's offers here. There's sellers in here. Doesn't necessarily mean they have everything showing in the order book. No, the people, they like to reload, right? They let the market. They're selling it down, let the market breathe a little bit, sell some more. Let the market breathe a little bit, sell some more, and then whap, it just gets slammed. Now, here you got your breakouts go lower, but you're not necessarily seeing these resistant selling. You're seeing big passive buying. You're seeing signs of accumulation, right? You get up here. This is not really the breakout anymore, right? You should be seeing this volume down in here, right? This is the problem with breakout trading. Yeah, breakout trading, it broke out. Well, technically it broke out. Yeah, it worked, but you only broke out a few ticks. And instead of seeing the resistance selling, what you're seeing is a lot of passive buying and off those lows. So not a good sign. Here, right? You're breaking out. Now notice this bar here, right? You broke out these new lows. You got a lot of volume in here relative in this bar, right? Up in here, right? Everyone is more interested in selling. Now you do run into some passive buying in here, okay? This one, again, this is the problem with breakout trading, okay? You break out, very aggressive selling going on in here. It's almost, like a stop got triggered. Or something got triggered in here. You met this passive buying, market rallied back up. Where did it rally back up to? It rallied back up to this area where you did have some resistance, okay? Then you slam back down. This is not what I like to see on a breakout bar like this. I'd much rather see stack selling imbalances coming in down here, not up here. You just run down in here with more volume to absorb all the selling that's going on. So again, don't get too excited. Sometimes, we're breaking out. Look at all these stacked imbalances. You got to watch what's happening. Are you coming into an area of support or not? And then where's the follow through selling in here, right? You have this void, all these zeros, right? That's why I say it's probably like a stop got triggered and just knocked everything out. And then it came back in and filled that void, right? What you should be seeing if this market was truly going to be selling off immediately to much lower lows, you should be seeing the zeros and then heavy offers in here. Heavy offers as the market's going down, and you're not seeing it. You're seeing it more on the bid side than the offer side. Okay, this one, it's a little hard to see. Some of these charts are scrunch. I've been trying to readjust the the font size, but as you're taking out these highs, what you're looking for is sort of like this step, so to speak. This is what people call steps. But when in the steps, look at the volumes here, right? You got 4 figures, 1,000, 1,200. Over here you got very small volumes, 900, 800, 100, 500. Here you got 1,700, 1,500, 1,000. I'm always looking at the volumes on the bid side as you take out these highs. Is it stronger than what the volumes were on the bid side earlier? Okay, here, 1,100, 1,600, 1,600, 1,500. Because that's your bidding, right? That's the bids, what's traded on the bid. So I know that there's some strong bids in here, some strong bids in here, strong bids in here. That's going to be sort of what's forming your steps to go higher. You should already be long, right? At the latest, you should be getting long in this bar up here at 46. Now you do have a ratio and divergence. Market goes sideways. It's interesting because this is your only positive delta in this whole move up, or sorry, your only negative delta in this whole move up. But really the signs were earlier here, 9 o'clock here, 9:10. You got your big pocket of supportive buying, another pocket of supportive buying, another pocket of supportive buying here. So you got 1, 2, 3 already before you get to this big jump up. Here you got your breakout, breakdown rather, making the new lows. I like that you got the heavy volume here. I like that you got your heavy volume here. You break out, you make the new lows. Unfortunately, it only goes down to 42.25 before it rallies back up. Again, this is the problem that breakout traders face, is you get your breakout, but it's not juicy enough. That's why, over time, I've become more of a reversal trader. I think reversals offer bigger capacities than breakouts, but that's just how I feel on it. Now, would you consider this a breakout? No. Where's your supportive buying in here? You don't necessarily have it. Even up in here, you don't really have big supportive buying. Like here, 1,800, 1,300, 1,000. But even up in here, you're not really getting it. Here you get 2,000. Get your ratio divergence. Already market sells off. Again, this is not the type of breakout that I'd be looking for, because you don't have the supportive buying. There's nothing over 1,000 up in here. Again, very similar. It's a breakout. Technically, it made a new high, but this is not what I'd be looking for. Where's your absorption in here? Where's your absorption buying in here? Yeah, we'll say, well, it's decent. It's 300, 300, 300, 351. Yeah, but look at these regular bars. You're getting 400, 600, 500, 600, 600, 200. It's not standing out. It's not standing out. And here, right, you went sideways. It's a breakout, but why did it go sideways? Well, first you got your inside bar, but look at the volumes in here: 1,200, 600, 300, 750. Where's your big absorptive selling, right? Your big resistance selling here, you got 700, 1,000, 700. At the area where the point of control is, are you seeing the big volumes to sort of keep it lower here, 500, 600? You can't. You got this little light volume, 682, right? It's not. You should be filling this in with heavy volume, and you're not. Then you start going sideways. Again, I've talked about this. Sideways activity is usually indicative with the inside bar. So you gotta put these things together and understand what's happening in the market. This is what used to kill me as a breakout trader. And granted, when I was a breakout trader, my knowledge of markets was much less. But yeah, you get your breakout, and then it just go a couple of ticks and do nothing. Then come back and stop you out. Now again, this is why I like looking at a delta chart, is because sometimes you see things just really stand out. Like here, right? This is a very bearish bar, all hitting the bids. You got the big offer there, even a little bit earlier, hitting these bids. You got a decent size offer here, 126. Again, that's not what the actual volume is. This is the delta, the difference between the volume on the bid and the offer. But when I see big, it's what I call a delta bulge. When I see big bulges like this, it's telling me that there's resistance in the market here, here. But by this bar, I should already be short. So at least I could capture something. So like I said, you're trying to trade the breakout, you get short. Does it break out? Yeah, it goes down from 65 down to 45. Not necessarily the greatest trade, but still, notice where the market comes back to. It comes back to these areas where the bulges are, right? Comes back. This one comes back to this bulge here. This one comes back to this bulge here. You got your breakout here. But you're running into supportive buying, right? Where is your strong offers in this bar, in this bar, in this bar? You do have some here, 131, 73, 84. Mostly transacting on the bid side, but then it just goes sideways. Yeah, it breaks down 05. So there is some capacity for this trade, but again, it's not the greatest trade. Again, I wouldn't be getting short and then holding it through here to get down to here. Really, I'm looking for, with the breakout, right? You're looking for the market to just fall over, right? Not go sideways from 7:30 to 9 o'clock. But again, if you're short somewhere in here, yeah, when you start getting back up in here, this is the worst feeling. You're short at, you get short at 7:20, 7:25. 8 o'clock, you're still in the position, and it's sort of going against you. Even though this is kind of bearish looking, you do have some resistance up in here. You can see with these deltas that there's some selling going on up there, passive selling, before the market sells off. But you're trying to trade a breakout. You're looking for that breakout to just drop like a rock. All right, so this is the last chart here, I think. Strong offers traded at high indicate supply explains why the high was short-lived, right? So you hit your high. These are trap traders up in here, right? All these guys buying this high, thinking the market's going higher, right? This is what you talk about when people say trap traders. Now, I do like that you have the supportive buying in here, and this is the problem with breakouts, right? Is you run into these areas where the breakout just ends, right? All these people, they're buying it here. They're all excited. They're buying it. They're all bidding. 272. That's your highest volume in the delta anywhere in here. I think, there's 246, there's 243, well, there's 278, but 272 on the offer side. So you got a lot of aggressive buying going on up in here. Why isn't it carrying the market higher? These are the questions that you should be asking, as a trader. Look at the deltas. It's getting weaker. 616, 536, 313 turns negative, 200. Okay, that's not a bullish sign anymore. You know, even though you can say, well, you got smaller deltas indicating supportive buying. Okay, yeah, I understand that. You have this aggressive buying here. Where's the follow through? This bar price action, it's closing down, not down, but it's closing lower than where you were earlier, right? It's still a green bar, but it's still well below the high that you were at earlier, right? You need that follow through. You want to see it. Then if you don't get it in this bar, fine. Look for the next bar. Are you coming up near the high? No, you're still well below the point of control. And then you start looking at this bar here. You're seeing negative delta. So you're seeing the supply delta, 135, 165. You're looking in this bar, 141. It's all on the offer side. Even in here, this one's being offered down. Look at that, 26, 22, 100, 129. People are hitting this bid before the market sells off. All right, so this one, this is not a trade setup, but I just put this in there. This is an old market delta thing that I've always had in my mind. Trevor came up with this years ago. Point of control in the top 33% of the bar's range and positive delta indicates buyers buying at higher levels. What's important to watch is what happens next. Does it continue in the next? Right? Point of control, top 33%, positive delta. Right? What's happening next? Right? That's not a good sign. Right? Usually you'd want a higher bar. Right? Are you taking out this high like here? Point of control, top 33%. Point of control, top 33%. Next bar is up. That's good. Next bar, well, it's a little higher. Next bar is up. Okay. Point of control on the top, no, it's lower. It's going sideways. Point of control, top 33%, but we're well below that now. That's not a good sign, right? But I put that in there because that's something to when you're assessing point of controls and deltas. Watch that, right, for trends. That would be bullish. Okay, this one is bullish. For a bearish sign, obviously you'd be in the top 33%. Next bar would be below the point of control in a red candle. But flip it over for a market selling off, right? Point of control in the bottom 33% with negative delta means sellers in control. So just a few things to highlight, right? When sellers aggressively step in to supply the market at an unrealistic high, the market tends to drop back and return to the value area as its first target area. Now, stop placements. People always wonder, well, where do I place my stop? Well, you place your stop where the reason for the trade is invalid. If you get into a trade because it's exuberance or capitulation, your stop should just go just below the high or low of the move. If you get into a trade because the market is consolidating, you're trading a reversal, place your stop just above the recent high or low. If you get into a trade because the market's consolidating, you're trading a breakout continuation, place your stop just above the recent high or low. Now, the hard part of being a trader is deciding to get out of position when you reach what you think is an area of absorption. The tendency should be to get out, but long-term traders are not always right. Don't think that just because someone's a long-term trader, they're automatically 100% right. No, long-term traders have losing trades as well. The market can continue in its original move, right? Just because a long-term trader is long doesn't necessarily mean that the market's got to keep going up. Just remember, at that point, you can always get back into a position if needed. You could just have been a long-term trader taking profits. You won't know if it's a high or low until some time has passed. Unfortunately, you're not going to know a high is made until the next bar is formed, confirming that that's the high. You take a position at a high saying, I think this is the high, and we get short. Okay, well, you're not going to know until the market starts moving, right? Period. Sometimes people lose sight of that. That's why I put that in, even though it doesn't really. People say, "What? Of course you're not going to know until time has passed." But again, sometimes people they don't know. They get a little excited. That's why I always say, wait for bars to close for confirmation. All right, so this was a long module, but hopefully you got a few golden nuggets out of it. So this concludes Module 6. In Module 7, I'm going to show you how to put it all together, help you become a better trader. So I'll see you on the next module. Bye-bye.